Ladies and gentlemen, please welcome your host for the event, Lavisha Darad.
Good morning and welcome to the second edition of Moneycontrol's Global Wealth Summit. At a time when the global investment landscape is being reshaped by continuing geopolitical flux, AI-led disruptions, tariff tensions and shifting supply chains, the Moneycontrol's Global Wealth Summit is focusing on opportunities, challenges and emerging trends which is shaping India's growth story. India's growing global economic influence, its unparalleled scale for wealth creation and the complexities is shaping the growth trajectory, making this a pivotal moment for conversations around the global capital, markets and the future of finance. Before we begin, a quick thank you to our partners, IDFC FIRST Bank and our presenting partner and Reliance Industries, our associate partner. And as we go through the day, we'd like you to share our key takeaways on social media. So do click, post, and tag us using the hashtag MC Global Wealth Summit 2026 and tag @MoneyControl.com. Once again, welcome to Moneycontrol's Global Wealth Summit 2026. Ladies and gentlemen, to formally set the stage for the conversations ahead, it's my pleasure to invite someone who has closely tracked the intersection of policy, markets, and global affairs for years. So please welcome Dr. Nalin Mehta, Managing Editor, Moneycontrol, and Chief AI Officer, Editorial Operations, Network 18, for his welcome note to kick off the Global Wealth Summit 2026 with a big round of applause.
Morning, ladies and gentlemen. When we launched Moneycontrol's Global Wealth Summit last year, the theme was the next phase of wealth creation. The question we asked was simple. Where will the next big opportunities come from in a market being reshaped by policy, new business models, and a new generation of investors? A year later, today, that question has become far more complex. War in the Gulf and Iran's pushback on the Strait of Hormuz has made the global environment far more unpredictable. Energy routes are being disrupted, supply chains are shifting, AI-led disruptions continue to reshape the business landscape, and geopolitical risk is reshaping global markets, national economies, and capital flows. So this year, our theme is the capital reset. What does all this flux mean for India, for investors, for the markets, capital flows, and for asset allocations? The IMF's latest update projects global growth at about 3.3% for 2026 and sees India growing at 7.3% for FY26. India's own latest projection just out last week is for about 7.6% growth, which is a strong signal of resilience. Yet, at a time when we are seeing the greatest oil supply disruptions since the 1970s, countries opening strategic energy reserves like never before, and the certainties of the past disappearing, the question for this summit today is sharper and more pertinent than ever. In a world of sudden shocks and fast-moving markets, what does smart wealth creation actually look like? That's what we are here to explore today, and I think it would be fair to say that we're living through a period where uncertainty is no longer an exception. It is the operating environment. Although history tells us that wealth has always been created in uncertain times, not in spite of them, but because of how investors respond to them. Now, India today, of course, sits at a fascinating intersection. Never before have Indian investors had so many opportunities, so many products, and so much access to capital markets. Wealth creation in India matters not just for Indians, but for the rest of the world. Just 10 years ago, we were the world's 10th largest economy. We are now the world's 4th largest, having doubled in size and on track to becoming the 3rd largest. Just 10 years ago, our equity market was the world's 10th largest. We are now the world's 4th or 5th largest by market cap, having quadrupled in size. Just 10 years ago, we were doing less than 100 IPOs in a year. Last year, India saw the highest IPOs in the world, about 370, and the 3rd highest IPO proceeds of any country globally at $22 billion, which was more than China last year. But more than the size, it is also the culture and nature of wealth creation itself in Bharat that is shifting at a breakneck speed. I think it's worth reminding ourselves this morning that India has over 21.6 crore or 216 million demat accounts. That's more than the populations of countries like Mexico, Russia, Japan, or the Philippines, compared to just about 22 million in 2014 for context. India's change is being driven also by a new generation of investors. Almost half of assets under management in mutual funds today are now outside of the big 5 cities, and about 1/5 are coming from outside of the top 30 Indian cities. So how do global investors negotiate these breathtaking shifts in Bharat? What are the opportunities and challenges of the Indian markets? What about new asset classes such as REITs and older ones like gold? What's the long-term view on India, and what should investors do? Above all, how do markets and investors navigate today's complex and volatile world where things change minute by minute and tweet by tweet, social post by social post? So at Moneycontrol, it is our business to track these questions on a daily basis. With over 50 million unique users a month and over 1 million paying subscribers, we are India's largest digital financial news platform and among the top 15 digital news platforms in the world. We are delighted to have brought together today a fantastic collection of global investment leaders, fund managers, titans of the industry, and thought leaders to deliberate on all these issues. Later today, we will have the SEBI chief, Tuin Kanta Pandey, gracing this occasion with a keynote speech. The Gujarat Deputy Chief Minister Harsh Sanghvi will also be here to talk about his vision for growth and investments along with iconic investors from around the world. We couldn't ask for a more powerful set of movers and shakers to think through questions around wealth and growth in India. And I hope we find as many answers as there are questions. Thank you very much for making the time, for coming to the Moneycontrol Global Wealth Summit, and let's have a great day. Thank you.
Thank you, Nalin sir, for that wonderful address. And now we begin with the session that sets the global frame for everything that follows today. Global markets right now are being shaped by several disruptions, as you can see on the headlines, including the wars, the oil shock, the AI-driven productivity reset, and the retreat of the US from its role as the world's guarantor. Some of these changes will pass, and some will fundamentally reshape the landscape. And knowing the difference is what separates a reactive portfolio from a resilient one. So what should investors do? To guide us through this discussion, please welcome N. Mahalakshmi from Moneycontrol, and joining her is someone who has tracked macro, geopolitics, and global capital for 4 decades. So please welcome Jonathan Wilmot, Global Strategies, Alethea Capital, with a warm round of applause.
Good morning, everybody. Thank you, Ravisha. Jonathan, first of all, thank you very much for making this trip to India. And given the kind of news flow we've seen over the last week or so, I was really worried whether you will be able to make this trip at all. But thank you so much for braving this and keeping up your promise. Really looking forward to this discussion. So before we get into the thick of the conversation, one interesting fascinating thing I found is that you've partnered this firm called Alethea, which is what Google named a mathematical equation for an agent in Google DeepMind. Did you or your firm, the partner firm, know what we know now 10 years ago, 2017, when the firm was launched? Or was it just the Greek word unconcealedness or truth that the firm was hoping to do?
Well, I'd like to say that Google are following our lead, which is nearly true. But before I go, thank you so much for inviting me. It's a great pleasure to be here in the world's most populous country, in the country that is waiting to be the next economic superpower in Asia. And another reason for being very happy to be here is that I share one of your religions, namely cricket. I've been a mad keen cricketer since I was a boy, as I'm sure quite a lot of people have been here. And I still play pretty much every weekend in the summer. So I just want to say, congratulations, India. You are the superpower of cricket. So
big round of applause for that, absolutely.
Okay, let's get to it. So, strictly speaking, I didn't found Alethea. I worked with Alethea. I founded my own firm, which is called Wilmot ML. We're based in London. Alethea are based in Hong Kong. But mentioning what Google have just done is actually very pertinent to the subjects we want to talk about today, because their deep think model, as they call it, and which they've called Alethea, has in the last few weeks solved some fundamental problems in mathematics, physics, and computer science, which have defied human scientists working on their own for a long time. And it illustrates perfectly. When I started my firm, I started it because I was convinced even then that AI and machine learning had reached a point of takeoff and would eventually come to be the leading factor transforming the whole of the world economy. And transforming it not in a trivial way, but in a way that was similar to the industrial revolutions of the past. So in a very simplistic way, AI is to human brain power what the steam engine was to horsepower. And we know what the implications of that were in the 19th century. This is a long process, and what Google have just done with their new model is extraordinary, absolutely extraordinary. And it is an example of augmented intelligence, which is the other way that I like to think of AI. And these are fundamental problems in science which have been solved, and they call it a force accelerator for human intellect. So one of the ways in which you can think about AI is as a force accelerator for human intellect, and as a way of accelerating innovation, discovery, product design, and so on. So when I started my firm, it was the belief that that was going to be the driving force behind transforming the world economy. And it took a while, but now everybody is there.
Yeah, so that's precisely the question. How do you think AI will reshape businesses and economies worldwide?
Well, I mean, you can think of this through various different lenses. You can think of the impact it has on financial markets and who the winners and losers are. We'll come back to that, no doubt, a bit later. But I think of it in terms of macro. It's essentially the foundation for a re-acceleration of productivity. It is the answer for countries whose populations are declining, unlike India, or are cresting. Stronger productivity growth will offset the decline in the labor force. It is, you could just do a simple thought experiment. Everybody here, you've probably seen, heard, read about the affordability crisis that is a very big political issue on both sides of the Atlantic, certainly in the US and so on. Now, what do people spend most of their money on? They spend most of their money on food, especially poorer consumers, on food, on energy, on housing, and then those are essentials, and you could say these days so is healthcare. Now let's just think what the longer term impact of AI and machine learning is likely to be on the cost of all those things: food, energy, housing, and healthcare. I'm convinced that the effect will be profound in lowering the costs of all those things. So the long-run answer to the affordability crisis actually lies in that complex of innovation led by AI. It's not just AI directly, it's the interaction of AI with what's happening in solar energy, to say, is the key to the energy side of it. It's smarter farming, it's 3D printing and other technologies that will reduce the cost of building new houses. And healthcare is the one area where you can see the most startup activity and the most innovation going on to reduce costs. I could give you a list of 5, 10 things which are happening only because we have the resources of AI to find innovative, cheaper solutions to things like heart disease or cancer or whatever.
Right. So 2 questions. One is, can you clarify over what time period do you see this playing out? Because that is very critical when we think about it from a business and investment perspective.
Okay. So that's a great point. Like, I'm going to describe this with my hands. So, in some respects, the boom in AI infrastructure is driving up the cost of raw materials and food and energy, for example. So if you think of what the end state is, then you think of the price level for these things, it's somewhere down here, and current price level is here. In a sense, the shorter-term cyclical effects of the boom in AI infrastructure is to push prices up here before they end up down there. And that's quite important in the current context, as we'll discuss in a moment.
So what does this mean for interest rates? How do central banks, especially the US Fed, react to something like this? Because apart from AI, we are also today, have a situation of war, trade tensions. All of those are suspected, or people fear that it's going to be inflationary as well. So what does it mean for interest rates and central bank responses going forward?
That also is a great question. This is one of the most difficult periods for central banks around the world. But let's focus on the Fed, because everybody, in a way, it's the most important of them all. There is a massive potential internal debate stroke split coming on the Fed. If you are emphasizing...
Jonathan, can you just hold up the mic? Yeah.
Sorry. If you are emphasizing the longer-term productivity benefits of the current technology wave, you're a supply-sider, like the new chairman of the Federal Reserve, and you would say there's no need to raise interest rates in the face of a short-term shock to prices that's coming from whatever source, whether it's the war or the boom in AI infrastructure. And if you're a more sort of traditional Fed person, like most of the members of the FOMC, you'd probably think that what's happening now is a reason to raise interest rates. And we don't know yet how that is going to play out. Probably in the short run, nothing happens in terms of rates one way or the other. But that debate between the long and the short-term effects of AI is, I would say, for most central bankers, more biased towards the idea that we raise interest rates. If you raise interest rates at a time of very high levels of government debt interest goes up, you get yourself possibly into a kind of vicious circle of rising rates and rising long-term yields, which has pretty nasty implications for what happens in the rest of the equity market.
What is your thought on AI's impact on financial markets, because of course this theme in the stock markets has been very strong. There are a lot of private investments, etc., that has happened. So people who believe this is a bubble are simply looking at the amount of money that is going into it, the use cases, whether they will come through or not, whether it will be profitable, what are the payoffs, etc. People on the other side who argue that this is not a bubble essentially say that these are led by companies which are cash generating and so on, and therefore this won't be see the kind of crash we saw during .com. Where do you stand on this, and do you see some sort of a crash or a steep correction in AI stocks anytime in the next 2-3 quarters? How do you see it playing out?
Where I stand is that the debate about whether it's a bubble is not useful. What it clearly is not is the same as the .com situation in the 1990s. You can see that currently most of the rise in value of the leading AI stocks, especially NVIDIA, which has been in the vanguard, is kind of one-to-one with the increase in earnings that they have experienced since ChatGPT was launched. There is earnings behind this stuff. If you take the equity market as a whole, there was a huge gap between the level of equity prices and the level of earnings in aggregate back in 1999, 2000. There isn't now. In fact, earnings are further above trend than equity prices, kind of almost the opposite. However, it's just dead simple to say that if we have a shock to the world economy that's big enough to send it into recession, if we have some kind of panic in global fixed income markets and worry about debt sustainability becomes, there isn't going to be any place to hide with this stuff. You're going to see very large declines in the valuation of this stuff. If the Chinese were to invade Taiwan tomorrow, there would be very large declines in the price of this stuff. So it's not necessarily because there's a bubble. And then there's the final issue, but I don't want to go into that right now, which is, are we building too much infrastructure right now that will never pay for itself? Now that is a very interesting question, but it doesn't have an easy answer. Actually, it is possible that a lot of that stuff will turn out to be profitable, but it probably won't in a situation in which the global economy is in big trouble. So if you have a cyclical downturn, right, you're going to have a very significant drawdown in the valuation of technology stocks in general, and the AI stocks may being a higher beta, may go down even more than the rest.
Right. We have a whole session on the Israel-Iran geopolitical conflict and where are we headed on that count. But if you can give us a sense of what is your base case and stress case because of this ongoing conflict. Where do you see crude prices? What does it mean for the global economy?
Well, I don't want to take anything away from Charles's talk, but you're dead right. When any investor, any strategist, in a situation which is highly uncertain, you have to have some kind of working assumption. So what do we know for sure? We know for sure that unless we can reopen the Strait of Hormuz within 3, maybe maximum 4 weeks, we'll be in a situation where oil prices could head towards $150, maybe even higher, maybe even 200. So that is the imperative that not just the US, but everybody has to work towards. Everybody's got to find a way. We have to find a way to reopen the straits within 3 or 4 weeks. Looking at that, I kind of think that, well, that's a bit of a 50-50 shot. as far as I know, but the situation is changing very fast on the ground, and it, to some extent, depends on stuff that I can't really predict. So what I do think will happen, I guess probably Charles will say something the same, is that within, I don't know, it may be days, it may be 10 days at the most, I would say, the hot part of this war from the US side will probably stop. Trump will declare victory. But from the point of view of the oil markets, none of that is relevant unless there is a plan to reopen the straits. If we don't reopen the straits and oil prices end up north of $150 a barrel, which in real terms is quite a lot lower actually than it was in 2008, but which helped to precipitate that recession, then we have the ghost of 2008 coming into play. There are credit issues, private credit markets, partly a result of AI stuff. We are at a moment where not reopening the straits is like pulling the plug on large parts of the global economy and then revealing cracks. What do central banks do, what do policymakers do, etc. So from my point of view, I'm staying relatively cheerful in this sense. I'm not taking for granted that we'll be able to reopen the straits within 3 or 4 weeks, but I'm taking for granted that that is what everybody will work with the US to try to do, and that if they don't achieve it in 3 or 4 weeks, they'll probably achieve it in 5 or 6 weeks. So that at that point, perhaps, if there was a big spike in oil prices, it will come back down quickly. But it would be completely wrong to not see the fragility which is there. We're relying on the fact that it's so important for everyone, including the Chinese, that we'll find a way to get it done. We may not be able to do regime change, but we'll find a way to get that done.
Right. And where do you visualize India in all of this? Because compared to the past cycles, we are a lot more resilient on macro front. Our reliance on crude prices has gone down substantially. Where do you see India in the global trade setup today?
Well, India is going to be, as everybody knows, the largest country in the world in terms of population. If you look at the UN projections for population, by the end of this century, China will have shrunk to somewhere between 850 and 900 million people from 1.4 billion. India will have peaked at about 1.6 and will be gently declining. But the relationship in terms of population between China and the US will have completely switched. You have your own issues about, are you going to be able to create enough jobs for a younger population? Are you going to be on the right end of the AI trade or the wrong end of the AI trade? Personally, I am fairly optimistic about India's potential. I think India will, over the next 20 or 30 years, or 10 or 20 years, become more and more important, both economically as an alternative manufacturing destination, and because I think you will actually do well from the AI trade, if you like. But you know, what do I know? I'm just an Englishman, but I think there are a lot of challenges for India, which are sort of structural, political, social, whatever. But economically speaking, you're waiting to become amazingly significant in Asia and therefore in the world.
Right. Immediately, I mean, within the next 1 year, of course, there are a lot of moving parts. But what could be the immediate triggers for the sentiment around Indian markets to turn? Because like you said, we've been at the wrong end of the AI trade. There were concerns about overvaluation in equities. For multiple reasons, foreign investors have exited India over the last 3 years. Do you see this changing, and what could be the triggers for the change?
Look, I think we're probably in arguably, we're in the last sort of 6, 7 years of a long-term bull market which started in 1982. And we've had 2 previous long-term equity bull markets of about 62, 70 years. It's not done yet. I think there is at least one major cyclical decline to come. It could get a lot worse if we don't solve the oil problem even this year. But this is one of the problems that investors, particularly private wealth, have. They always have to balance the difference between growing capital, preserving capital, finding income. One thing you could say about the current environment is, in many ways, it's just like it always was. It's hard to predict, it's bumpy, there's all sorts of conflicting things going on. There's always a tendency to overshooting, exaggeration. But it's probably more difficult now than it's ever been. And one of the things that we're working on, I've been working on for a while actually, is the kind of product I want for my portfolio, which is something which, as it were, you invest in equities, but you can have some way that you switch off the exposure to equities at moments of stress, but you reinvest very quickly. I'm just going to make one comment, because in the context of all this, at the end of the day, we need to know how to manage our money, right? And in my experience, the biggest mistake that people make as private investors is that they get a little bit too carried away when things are good, worrying all the time, but eventually giving in. And then when you have the crash, they take far too long to get back in.
Right.
And so one of the things that we're going to be launching an active ETF in America in May, which is based on a system I've devised using macro signals to outperform equities, in which you delegate that decision to a set of rules backed up in the background by a little bit of AI that allows you to do that. It allows you to react quickly to downturns. I won't go into it in a minute. But the point that I would get at is one of the reasons I run a macro hedge fund in the background for our firm is that I want something that can make money in down markets. Right. And that's a diversification. Anyway, this is a problem which everybody faces. There's going to be at least one major cyclical bear market. It could be very bad, right, if everything that could go wrong goes wrong now. It could be very bad if China invades Taiwan by force. Now, my working assumption, probably Charles will say more about this, is they won't. There is a graduated set of things that will happen. They will first do some form of quarantine, where they insist that anybody who ships stuff to Taiwan by sea has to go through them and get their permission and allow the ships to be inspected. Then possibly they will threaten a blockade way before they did any kinetic war in invasion. But President Xi has said the army must be ready to take Taiwan by force by the year 2027, that's next year. So if we have one of those events, if those go wrong, then things could get very bad. And my last comment on this would be, President Trump is not necessarily that well. Suppose he has a stroke, he's incapacitated, we have J.D. Vance. China's temptation to start with the quarantine system at that point is going to be enormous. So it doesn't matter what you sort of, in a way, it doesn't matter what you think about AI in terms of valuation, etc. At the end of the day,
Right.
we face, as we have always faced, the risk of a major shock, whether it's oil, whether it's Taiwan or so on, which completely upends what we do on a day-to-day basis. And we need to be able to think about that and to have a strategy and to have a way of dealing with it if and when it happens.
Right. Thank you so much. Just in one sentence, because we're running out of time. You've seen markets for the last 40 years, ups and downs, all kinds of, market crashes and rebounds. What would your advice to investors be today? Should they be reactive? Should they be proactive? Just in a couple of sentences.
Okay. All right, number one, go hire a lot of AI agents to help you with the business, but don't, whatever you do, fire anybody as a result. And just recruit them so that you can do a lot more analysis and so on. And the second thing is never forget macro.
Sorry, never forget?
Never forget macro, because for the reasons I've just explained, it doesn't matter what the hell else is happening. If the world has a macro seizure, that will dominate everything else. So,
Sure.
thank you very much.
So much.
Emma.
Thank you so much, Jonathan. Very enlightening talk indeed.
Thank you, Mr. Wilmot, and for your perspectives, and thank you, ML, for leading this conversation as well. But yes, macros is something that we'll be watching out, given that we are in a war situation that is coming in from the West Asia. But before we move on to our next session, did you guys notice a little plant thing which is there on your table? It's just like a tag which is there on like an apparel. So please do take it back to your houses and home and plant it. Remember to click and pick a picture and post it and share it with us. Tag Moneycontrol and IDFC FIRST Bank, and we'll be happy to post it on our handles. So let's spread the message and choose green and choose wisely. So yes, our next session could not have been better timed in a week in which US military actions in the Gulf moved the global markets, and the US Trade Representative launched new Section 301 investigations, which covers about 60 countries, including India. We have had powerful reminders of how US politics directly shapes trade, capital flows, and country risk. And for global investors, decisions made in Washington rarely stay in Washington. So what more can we expect next from the US? To answer this question, please welcome Sachi Trivedi, founder and director, Trident Capital Investments, and for a conversation with someone who has spent 20 years advising candidates in the US presidential, congressional, and gubernatorial races, and is trusted by the world's largest sovereign wealth funds. Please welcome Charles Myers, founder and chairman of Signum Global Advisors. Please welcome them with a huge round of applause.
Good morning, everyone. Founder of Signum Global Advisor, campaign director for Hillary Clinton 2016, Joe Biden 2020, and senior advisor for Kamala Harris in 2024. A wonderful mentor and a great friend, Charles Myers, ladies and gentlemen. Charles, this is your first trip to India. A very warm welcome, and I couldn't have timed this better. So we've got some very hot questions for you. You're actually in the hot seat here. So let's get straight in. Has US and Israel entered themselves into yet another prolonged conflict, endless war, and taking the world with them. How do you think this plays out?
Yeah, so first of all, thank you for the invitation to be here. It's great to be in Mumbai. You know, what I would say on the conflict in the Middle East is a couple things. First, just to make a high-level but very important comment, the United States today is at war. The United States is at war. It is a very big deal. There is only one outcome of this war. Iran will lose. I say that factually. At the end of the day, Iran is up against the two most powerful, battle-tested, sophisticated militaries in the world. So if that's the outcome, really the two remaining variables are what does losing, or in the case of the United States and Israel winning, look like, but also the timing. So partly to your question on timing, what I would say is that the kinetic part of this war is likely to be wound down in the next week to 10 days. I even think it could be, you know, next 4 to 5 days. It does not mean the war is over. It just means that the worst of the kinetic part is over. On what winning looks like, if I can, just to say, you know, in any war, winning is two things. It's first defined by the victor, by the winner, and secondly, it's very subjective. What I think President Trump will do in terms of declaring victory is say three things have been achieved. First, we prevented Iran from getting a nuclear weapon. Secondly, we have eliminated Iran's ballistic missile program. And third, we have kept the Strait of Hormuz open. Now, that all may not be true, but that will be the off-ramp. That is victory. One last quick thing on timing and on this war, to your question. There are three puts at the moment that will continue to guide or force President Trump's hand. First, oil above $100, incredibly painful. Price of gasoline up 20% in the United States, affects every American household. We have a major election in November. The election's in November, it's already started. The first put is oil above $100 for 3 or 4 days, incredibly painful. The president will seek an off-ramp. Number two, if the 10-year yield goes to 4.5%, we're not there yet, would be another forcing mechanism. Number three, major U.S. casualties, 50 or more Americans, he pivots to off-ramp. But I think we get to an off-ramp in the next week to 10 days.
That's great news. Taking a step back, are the actions in Venezuela and now in Iran ultimately the end game here is to isolate China? Is that what it is? What is President Trump's sort of, strategy with China? And does he have bipartisan support for that?
Yeah, so just on American foreign policy more broadly, actually one other quick thing if I can on Iran. Once we declare victory, again, once President Trump declares victory, as I said, it does not mean the war is over, and I'm here to tell you that the United States is going to occupy militarily the Strait of Hormuz. It'll be a no-fly zone enforced by United States, UK, France, and Saudi Arabian jets, combined with the redeployment or diversion of some of our naval capacity into the strait to ensure safe passage of tankers. We have got to get oil flowing again. So I just want to say that the war will not be over, but at least oil will be flowing again, and it will be a medium to long-term occupation of the Strait of Hormuz militarily by the United States and our allies. On the broader U.S. foreign policy, this is an area where I really think President Trump has been incredibly misunderstood. And it's understandable, but he ran as an isolationist, if you remember, and really said he was going to focus on domestic issues, America first, domestic issues. So again, almost everyone, including in the U.S., assumed he would focus on domestic issues. The truth is, America first was always also going to be about foreign policy, and it's two things: economic nationalism or protectionism, tariffs, and secondly, a much more assertive, aggressive, and I would argue expansionist foreign policy, which includes two main things: the reapplication of the Monroe Doctrine in our hemisphere, and secondly, using military force around the world to address our biggest adversaries. And on your question, what we did in Venezuela, what we're doing in Iran today, I'm here to tell you Cuba is next, and then Greenland. In the end, this is about the United States having much more free access to oil, and a lot more oil coming onto the market. Secondly, and very importantly, reducing the influence of China, Russia, Iran, North Korea around the world. President Trump is much more strategic than he gets credit for on a lot. I always say the Trump administration is much more strategic on many issues than they get credit for, largely because of his personality and his rhetoric. But this is a broad America First agenda which includes expansionism and containing China and Russia.
Great segue into Russia. Now, Russia-Ukraine war enters its 4th year now, and I think it was one of the top sort of agenda items for President Trump. Where do you think that goes? What options does Russia have now?
Yeah, well, look, I say Russia is arguably a loser in a lot of what's happening, just geopolitically. The United States literally just kicked Russia out of Venezuela. Yeah, there's no other way to put that. They just lost Venezuela. We are going to kick them out of Cuba probably in the next 12 months. And by the way, in terms of tail risk, that's a major risk because Russia's not going to leave Cuba quietly. Excuse me. And then on Ukraine, this is a war that's taken much longer. I think it's been very frustrating for President Trump. Putin is winning the war. I think he's holding out for a better deal in Ukraine. I think he will get a better deal because Trump just wants to end wars. Trump doesn't often get involved in the details. But overall, I would also just, on your question about Russia, say that in addition to losing Venezuela, Cuba soon, they're not going to get all of Ukraine, clearly. They're a much weaker country and economy. And very importantly, they lost Syria a little over a year ago, and they're losing influence in Iran. Of all of the countries and kind of major military powers around the world, Russia actually is one of the biggest losers at the moment.
Changing tack and sort of, bringing the focus to India. I think one of the questions that is really on the top of the mind for people here is, what is our strategic relationship with America? Like, are India and America friends or not? And if you could answer that, like on 5 levels, President Trump, Republican Party, Democratic Party, corporate America, and then the citizens.
Yeah, so the U.S.-India bilateral, I would say it's very complicated. I think it's always been complicated, by the way. It's just under President Trump, it's a little more complicated. As you will all remember, literally 1 year ago at the IMF meetings, Scott Bessent, actually at the JP Morgan conference during the IMF meetings, on stage said, India will be the first trade deal and it's going to be the best deal. Well, that didn't happen. Really didn't happen. In fact, we barely have a framework today. At least Trump lowered tariffs on India. But several things happened after that delayed and complicated delayed the trade deal, but complicated the relationship. First, India, to the surprise of Washington, but to your credit, I would argue, really played hardball on trade. Didn't just roll over like the EU did and a lot of other countries. That was a surprise to Washington. Secondly, India consistently has not taken the United States' side in the war in Ukraine, has remained more neutral than Washington would like on the war in Ukraine. Number 3, Prime Minister Modi went to Shanghai as part of the Shanghai Economic Cooperation Summit. That did not sit well in Washington. Now, President Trump is about to meet with President Xi, so I'm not here to say there's any consistency in American foreign policy. It's okay for Trump to meet with President Xi, not Modi. But there were some very big issues in the bilateral. I would also throw in Pakistan, and I know we talked about Pakistan in our prep call. It's been very confusing, I think, to a lot of people around the world, including a lot of Americans, this sort of warming up between Washington and Islamabad. What I would, and the fact that the United States and Pakistan are closer today has been another complicating factor in the US-India bilateral, of course. But I would say that on Pakistan, what President Trump is doing is what he always does, which is he will negotiate with anybody, and he likes to de-escalate tension. I also believe when he invited the Prime Minister of Pakistan to the White House, it was also transactional. President Trump is incredibly transactional. It's about Pakistan's rare earths. It's about also national security. And lastly, I do believe, I can't prove this obviously, but I do believe there was some discussion between Trump and the Prime Minister of Pakistan that we, the United States, are about to do something pretty big in the Middle East, in Iran, and we either need you on board or on the sidelines. I'm absolutely convinced that that was part of this warming up of the relationship with Pakistan. But President Trump will negotiate with anyone, and I actually would argue that's a good thing.
So in that, in that US context then, who is batting for India? Is it the Republicans, like outside of like, just the White House? Is it the Democratic Party? Is corporate America kind of, being more vocal on fostering some kind of partnership in India?
Well, I think, the U.S.-India relationship is, or support for the U.S.-India relationship is very bipartisan. I think we have a long history of having very good relations with India. India is an incredibly important country globally in its own right, as well as a partner in the United States, where we've, I think, worked very well is around issues of technology, around national security, around space, which is another future part of our relationship with India. But it's very bipartisan in Washington. The perception of India is very positive, and I'm very optimistic, by the way, on the outlook for the U.S.-India relationship, acknowledging some of these areas of tension. So no, and then on the corporate side, to your question, our private sector cares enormously about this relationship. We have a very strong, close economic and other ties that benefit the private sector in the United States. They are huge proponents of this country, supporters of India, but also trying to keep Washington, especially the White House, on track on India.
You mentioned that U.S. would have taken into confidence Pakistan, about the action that they're about to do in Middle East. By the same token, 90% of India's crude oil needs are imported. So this action in Middle East is very critical for the energy security of the country. Prime Minister Modi was in Israel 36 hours before the action started. Do you reckon that this would have been a conversation that Trump or the Israeli Prime Minister would have had with Mr. Modi, or informed him, or put any consideration to the energy security of 1.4 billion people here?
So is your question whether they had a conversation about Iran or what was about to happen? Yeah, oh, absolutely. In the end, the United States and Israel are at war with Iran, but I think that there was probably more preparation behind the scenes with our most important allies, giving them a little bit of a heads up, and there's certainly been some discussion on that. I think for India, as a very big net importer of oil, the good news is that the price of oil looking out to later this year is going to be significantly lower. And I say that because the United States now controls Venezuela, essentially, and which means the United States has unfettered 100% access to the biggest oil reserves in the world. The output, oil output from Venezuela will increase much faster than most assessments. We're taking clients to Venezuela in literally 10 days, 55 clients to Caracas, very huge interest in the oil sector there. But also, we will get to a de-escalation in Iran, and probably on a track to a new nuclear deal, or certainly negotiations. And in exchange for that deal, Iran can export a lot more oil legally. We will get to a ceasefire in Ukraine at some point, hopefully this year, more Russian oil being exported legally. At the end of the day, the world is awash in oil. We just need to end some of these conflicts, some of which we've started, but we need to end these conflicts to ensure a much more stable, secure, and ample supply of oil. And I think the Strait of Hormuz will be part of that as well. I'm very optimistic on ultimately the price of oil coming down later this year, which is a huge benefit for your economy. And by the way, a huge win for the United States economy and a big win potentially for President Trump into the midterms, because he's going to have a very tough midterm election.
If I can drill a little bit more into that. So am I right in thinking that when the war de-escalates, of course, we have, the oil price will come down. But until that happens, if it takes like 2 weeks or 1 week or 2 months, am I right in thinking that US will be accommodative of India getting oil from either Venezuela or Russia, or basically treat India as an ally in this and solve that problem rather than let 1.4 billion people queue up in the gas stations all over the country?
Yeah, no, absolutely. Look, for so many Americans, we have a very vivid and quite painful memory of the oil shock of the 1970s. I'm old, so a lot of us remember it. And it was an incredibly painful time in the United States economically. Ultimately, it's what brought down Jimmy Carter, I would argue, and hurt the Democrats for 2 election cycles. So everybody wants to avoid an energy shock. It doesn't mean the very short term oil can't go to 120 or higher, but just to say looking beyond that. And I think the United States had to act quite proactively, but actually, I would say reactively, and a little fast to allow India, to give a waiver to India to buy Russian oil in the last 3 or 4 days because of how much the U.S. or Washington is worried about the price of oil. So, but to your question, I could see a world or a scenario in the second half of this year where hostilities with Iran are, done and we're in negotiation. We may get a ceasefire in Ukraine. Venezuela increases output significantly faster than people project, and the price of oil can come down. So, at the end of the day, we could see an environment where sanctions are lifted on both Russia and Iran, and India can buy as much oil as they want. India does it anyway, by the way, just to say something we all know in this room. But at least that you don't have to try to skirt the sanctions. But more importantly, the amount of supply that will come onto the oil markets looking out to the second half of this year is underestimated. It will be a huge amount of supply. Very good news for India, by the way.
Great. I'm conscious of time. One final question for you. Who's going to be the next president of the United States? Is Trump going to extend his, to his 3rd term? What policies will outlive Trump, and what will, probably go with him?
Yes, but this is my favorite topic. The 2028 presidential election. First, just on the midterms this November, I think the Democrats will take the House. The Republicans probably keep the Senate for now. We'll see if we're wrong and the price of oil stays elevated, it will exacerbate the affordability crisis or issues in the United States, and I think the Democrats could take the Senate. But at the moment, I think we're looking at divided Congress. We shouldn't expect much policy change. By the way, as a quick aside, I'm incredibly optimistic on the U.S. economy this year. I think we're going to grow at 3%. Very bullish on the outlook for U.S. equities. I'd be buying the dip here on this risk-off move around Iran, just to put that out there. On 2028, in all of my travels around the world, I've been on the road for 3 weeks through Asia, the Middle East, and Europe. Just got in from London last night. One of the biggest concerns and one of the biggest changes, I would argue, since President Trump came back is that global investors are questioning the safe haven status of the United States. And that's everything from Federal Reserve independence to clean and fair elections to will Trump try to stay in office and get a 3rd term, to your question. And let me say, as a very active member of the political opposition in the United States, I feel very confident that on all 3 of those issues that we will continue to have an independent Federal Reserve. I think Kevin Warsh was an excellent choice. By the way, I think Scott Bessent's doing an amazing job. I'm really glad he's in the cabinet. And on that note, of the things we care about in this room professionally, meaning the economy and the markets, this is a very technocratic team in the US administration, including Scott Bessent, Howard Lutnick, and even the president. But we will have a clean and fair, free and fair election, and no, Trump will not get a third term. I'm here to tell you that. The third term, however, is something that is not getting enough attention in a slightly different way. The third term, I think, in the aspirations of the Trumps is actually Don Jr., is the son. So I wouldn't discount, I would keep a very close eye on Don Jr. I'm convinced we're going to be running against Don Jr. in 2028. J.D. Vance is the front runner. Trump has twice said he may not endorse J.D. Vance. That's not even code, by the way. That's a direct message to every Republican in the country. It's an open seat. Marco Rubio runs, Nikki Haley runs, DeSantis runs, Ted Cruz, because he can't help himself. You know, it's going to be a pretty crowded primary. Keep an eye on Don Jr. I think the family is keeping a lane open for Don Jr. or Eric as the backup. President Trump wants a third term more than anything. He's not going to get one. The second best is one of the sons. So I think we're going to be running against Don Jr. And on our side, the Democrats will nominate a centrist ticket. I would keep a close eye on Governor Beshear of Kentucky, a centrist Democrat in a Republican state. But the Democratic primary is going to be even more crowded than the Republican one. Last quick point on this. On the Democratic primary for president, what I've been saying is every Democrat in the country is running except for Joe Biden. So name a Democrat, he or she is running. Kamala Harris, Gavin Newsom, Pete Buttigieg, all of them. The AOC is running. What I would watch closely are some of the centrists. I think Governor Beshear of Kentucky, very interesting. Governor Shapiro of Pennsylvania, very likely on the ticket as vice president. You cannot win the White House today without Pennsylvania. And Governor Shapiro of Pennsylvania guarantees, a very popular Democratic governor, he guarantees Pennsylvania, so he may be vice president. But I feel very good about a centrist ticket. I would say that President Trump and the administration have given the Democrats a lot to work with, just objectively. And I'm very optimistic on the future of our politics. I'm very optimistic on the institutions in the United States holding. And I'm very optimistic about the Democrats coming back and taking the White House in 2028.
Well, so the key message is oil prices coming down dramatically in the second half of the year. Trump wants Nobel Peace Prize and the third term as a president. Great note to end this. Thank you, Charles.
Thank you.
Okay, all right. Charles, thank you so much for bringing clarity to a market that is being increasingly shaped by policy before price. And of course, we've had some good headlines which is coming in from this conversation where Don Jr. can also be the next running presidential candidate. But yes, thank you so much, Sachi, also for moderating this discussion. And now we'll be moving on to domestic portfolio question, the one that's keeping every fund manager up in this room at night. And we've seen that Indian equities have spent the last 12 months frustrating both the bulls and the bears. So the question has been, where is the right alpha right now? So yes, let's find out in the next discussion. Let me invite back N. Mahalakshmi back on the stage. And please put your hands together for our distinguished speakers. Sunil Singhania, founder, Abacus Asset Manager. Joining him is Rajiv Thakkar, CIO and Director, PPFAS Mutual Fund. Maran Govindaswamy, Executive Director and Co-founder, Unify Capital, and Sridhar Shivaram, Investment Director, Enam Holdings. Please give them a huge round of applause.
Thank you so much, gentlemen, for making this dream panel come true. On a Saturday morning, thank you so much for joining us. Whatever this panel of four men say is going to have a bearing on this Monday morning opening. They're all sought-after fund managers and very astute delivered outperformance for many, many years, seen many, many cycles. The markets have sold off nearly 3,000 points from the top. And for all this while, we have been talking about this conflict. In fact, for 3 years, geopolitical conflict has been seen as a risk. But, and for known risks, we usually say that the markets know this risk and therefore it's not a big risk. But even so, whenever a risk plays out, it brings in fresh uncertainties like we are seeing today. It's not just the price of crude, but the availability of gas that is dominating the conversation today. How does that impact not just oil stocks, but also something one would not have imagined, like a stock like Eternal? So the first question is, what is the unknown part of this equation? And therefore, what is the downside from here on? Let's start with Sunil. It's on, I think. Just speak.
Good morning, Mahalakshmi, and thanks Moneycontrol for having me. Fabulous setting. It's an immersive experience. Frankly, you know, the way last week has gone, I was so relaxed that Saturday, Sunday, I will be completely switched off from equities. But here I am again talking about equities. So I think, frankly, you know, multiple headwinds we have faced, but most of those headwinds were becoming tailwinds over the last 15, 18 months. You know, economy was coming back on track, corporate profitability was coming back on track. The tariff issue was more or less, you know, sort of sorted, at least reduced in terms of intensity the way it was at the peak. But out came this joker of the pack in terms of the Iran conflict. And conflicts are never good, and more so when, you know, it is in the region where India gets impacted the most because of its reliance on crude. Having said that, obviously, you know, when these things happen, there are reactions, and logically so. We have seen the emergence of massive FI outflows. In fact, February was a good month. FI flows had started to become positive, but there has been sudden risk off. And obviously countries like India, which got hit because of oil and consequently the currency also take a beating, have seen a major brunt. Emerging market funds which were receiving inflows have started to receive massive outflows. And for a change, I am also seeing a lot of nervousness among Indian investors also. And it was very evident last 3-4 days where even the you know, sort of stable companies like banks and Larsen of the world and all falling 10, 15, 20%. So I think it's a phase where you need some kind of good news. And I wish that what was said in the panel before, or in the you know, session before, that it's in the last 4-5 days and we should see some good news. I think war will de-escalate sooner than later, but we need very, very decisive good news for the you know, the markets to you know, sort of find its bearing. Obviously, valuations have corrected, so that is a little bit of a comfort. But markets can swing more than fair value on the upside as well as on the downside.
Rajiv, if oil were to correct, or you know, this conflict has to escalate, what do you see markets playing for? Do you see a rebound of sorts? And if it were to deepen, do you see the market getting into a more bearish consolidation phase for the rest of the year?
It's quite difficult to predict. So that's the reason why we keep telling people come to equities only if you have a 5-year kind of horizon. Near term, the headlines can swing markets either ways. As was mentioned in the previous 2 panels, it's a certainty wars will end somewhere. No one is clear on the time frame. Will it go on for a week? Will it drag on for months, maybe a year, so no one knows that. But people will adjust. Luckily, for India, oil is not as big a component of the overall economy as it was, let's say, in the 90s, where oil shock would completely derail us. Foreign exchange reserves are plentiful in India. And the world also has a choice. So while we are seeing disruptions on the cooking gas front and maybe a disruption to the petrol diesel kind of ecosystem down the road, but luckily the world has alternatives in terms of electric mobility, and so world will adjust. I don't see a problem there. The problem that I see is everything looks like a crash, but all said and done, we are roughly 12-13% from the peaks that we saw. This is not like COVID, where let's say 35-40% correction happened, or like 2008 where maybe 50-60% falls were there from the peak. Also, starting valuations were not very conducive. So we have had a 2-year kind of flattish market, time correction and price correction in the small and mid cap space. So we are somewhere near moderate valuations on an average. Now, average hides a lot of things. There are pockets of overvaluation still, and there are pockets where attractive valuations are emerging. Like Sunil said, there's no law which says market will stabilize at a fair value. It could fall significantly. So market goes to extremes. So that is the worry. Choppiness will be there. So people should come to equity only if they have a longer term horizon. And the other worry that I have is a big section of the investors today have not seen a sideways or a downward market. They have always been taught to buy the dip and things normalize in 3 months, 6 months time. If it continues longer, then some of them will lose hope.
Madan, you and I have spoken about this, average conceals the valuation discrepancies that you see in the underlying. And the last time we spoke, you said 10 to 15% of the stocks are essentially below the, long-term averages in terms of valuations. Has that equation really changed? And therefore, for the overall broad markets, how much more downside do you see in a stress case scenario and in the best case scenario?
It's tough to put a number, but to a specific question, what percentage of markets are at, say, investable zone from valuation perspective? Over the last 1.5 years, most of the conversation among fund managers, investors, and when we meet the investors, center around macros, geopolitical events. Many of them were not so relevant in the context of making a longer term investment. Valuation divergences in market, which always exists, in every market you will find that, but the degree of divergence, especially over the last 3-4 years, has been sharply higher. That led to more than half the companies in major benchmarks being super expensive levels. And that's getting corrected, but it hasn't got corrected to a level where you can say majority of the stocks are in the investable range. But to put a specific number to your question, what otherwise would have been 15-20% of the market that were investable maybe a few months back would have become 5-10% more. Right. But still, you may find almost half the markets you can't justify based on current valuations.
Right. Sridhar, do you see any hiding places? Because I think you have a similar view on valuations. In this sort of an uncertain environment, do you see any hiding places? Should you hide in equities at all, is the first question.
So there are no hiding places, as Sunil also mentioned, that, if we are going through a geopolitical crisis right now and nobody has a clue. I mean, your earlier panelist also...
Put the mic up.
Yeah. He also mentioned that, we really don't know when this war ends, how this thing plays out. But I also want to put a context that, the Asia is going through an earnings super cycle. So when we see FIs selling, what we need to keep in mind is that Korea earnings growth is going to be 100% this year. Taiwan is going to be 30% plus. Even China is having 15 to 18% earnings growth. So when earnings growth comes back in India, specifically the the large cap, we will see FIs come back. We will see the markets come back because stock markets are to some extent slaves of earnings. Our own view is next year earnings will come back. We don't know how this geopolitical thing affects the earnings, but if you assume that it doesn't last for too long, earnings comes back, then large cap specifically does look like a space which should do well in line with earnings. That's how I would put it.
Right. Maran and Sunil run mutual funds, which I don't know your strategy, but most fund managers tend to say that we take whatever money comes into equity funds as a given and try to be fully invested at all times. But Rajiv is more dynamic with respect to asset allocation. So in this sort of a market, as a tactical bet, would you much rather increase your cash position, sit on the sidelines? Because they say that in bearish scenarios, it's good to have firepower, dry powder to be able to fish when the market really cracks. And like Maran said, that we have only seen 15% down from the top. Would that be your strategy, or is this time to just sit with whatever you have and watch, or would you liquidate some of your, would you take profits, would you cut losses, what would you do?
So I have no view on the direction of the market. I don't know what will happen on Monday. Will it be sideways, upward, downward? If I get adequate opportunities to deploy, I would be happy to deploy to the last rupee that I have in the portfolio. It is just that after we deploy in companies that we like, sectors that we like, given the weightages that we are comfortable with, whatever remains we stay in cash. That hasn't meaningfully changed for us in this. So at the margin, of course, we have been buyers, but it hasn't meaningfully changed things for us. But things are starting to look interesting. I think if markets continue to fall for some more time, I think we'll be close to fully deployed. Not yet, but maybe somewhere down the road.
Right. Sunil, you are a growth at reasonable price sort of an investor. In this market, are you looking at buying opportunities? Of course, with your new fund, you will have to deploy, but where do you see?
No, I think definitely stocks are cheaper than what they were 18 months back, and in fact more cheaper over the last 1 week, 10 days. And the other thing is the impact cost is now no more there. So it was very difficult to buy stocks in good markets. The moment you go to buy, the stock just used to move. Now it's basically a buyer's market. The other thing is, I think Sridhar mentioned about earnings growth. In fact, we were getting very positive on the earnings growth cycle. December earnings growth were pretty good. The Nifty earnings growth were upwards of 10%. The broader market companies grew 15 to 19%. And things actually were falling in place, are actually falling in place. If you see the January and February data points also, car sales, retail sales, steel sales, cement sales, they have all been trending up. Now there is going to be a near-term disruption for sure, not only because of oil prices, but because of also supply chain disruptions. But these are the times when, you also get opportunities. And I think particularly in the broader markets where now we have reached a stage where the seller doesn't care about the price and is just dumping, I think I would say that this is a much better time to start to create portfolio than it was maybe in the last 6 to 18 months. And
any particular pockets that particularly look attractive to you?
So I think, see, financials, great sector. Stocks, particularly for larger banks, have fallen a lot. Some of the engineering companies, I think stock prices have fallen a lot. We like pharma, though in this current correction, pharma has been resilient. But if we get an opportunity, we like a lot. But broader markets, smaller companies, I think that is where we see, much better opportunities than ever before. We typically don't like to keep too much cash unless the view is that the markets are going to fall by 25-30%, because that cash decision is already taken by the investor. Investors are already doing STPs or SIPs. On top of it, if we also do cash, then maybe, it might be a double whammy for the investor if the markets move up. And frankly, no one knows. As Rajiv said, we don't know whether markets will open up or down. But I am very positive that this conflict has to end sooner than later. And I would say that the way crude prices have moved up and the way the supply is responding, it is possible that when things settle, oil can be significantly lower than when the conflict started, and which can be great news for India.
Right. I'm just looking at, some of the stress sectors today. For example, the oil, the entire oil pack, the city gas distribution, and all of that. And Rajiv, I saw that you've made some purchases in that. So does this, the businesses that are stressed because this ongoing news, are there any pockets that are now, looking very attractive in terms of valuations and warrant a very compelling buy?
I think this is even before the war thing started. I think one of the big themes in the market has been sell anything relating to software and IT services, and where AI will do everything end to end. While it's true that headcount needs may reduce or there will be productivity gains, I am in the camp that people will still be required. It's not that a few prompts will get you the entire piece end to end. And somewhere the IT services space will start to look attractive. So watching that space closely.
Okay. Sridhar has a completely contrary view on that. Please go ahead.
Yeah, so I think this is a view we've had for more than 2 years, that this sector is getting disrupted because of AI. It doesn't mean that the disruption happens tomorrow or day after. As we've said, that this is a derating event, as we saw with the media sector. 10 years back, OTT came, and did the media sector completely vanish? No, but their valuations are now in single digits. So the starting point for the IT sector was actually even worse, because when AI has come in right now, their growth rates have been very moderate, in the 3 to 5% range. And the valuations were very stretched, not commensurate with the growth that they were giving. We think that they will continue to derate. Now they have corrected so much. Is it possible that it moves up in the short term? I don't know. But if I take a 3-5 year view, is AI going to disrupt? The answer is yes. How much? I don't know. Will the valuation derate? I think the probability is very high. So that's how I see. Are there some opportunities in the small cap? Maybe. But I think the large cap companies, adoption of new disruption by an incumbent, they're generally very slow. I think it will be very difficult for the larger IT companies to adapt to these changes. We'll see how it plays. I would surely stay on the sideline.
Just a couple of minutes more, and anybody can take this, but I'll pose it to Rajiv, because you're rooting for IT and saying that it's looking like a good space. Because like he said, top line growth is 3 to 5%. In this whole, AI story, people say that even if they have productivity gains, all of it will have to be passed on to clients, and therefore bottom line growth cannot be faster than top line growth. And the base valuation is not cheap. I mean, even I think from 2014 to 17 or 18, valuations were lower than what we are seeing today. So what is the case?
So I think Benedict Evans has written a wonderful nuanced blog post on this. And he talks about something called the Jevons paradox, where when something becomes cheaper, people start using more and more of it. So cell phones, for example, 16 rupees a minute was the call rate, and then things became very cheap. Number of subscribers simply exploded. Or banking, for example, earlier ledgers were written by hand, cash was dispensed by people sitting on the counter. The question is, do we have more employees today in the banking sector, or did we have more employees in the banking sector 30 years back? Answer is, we have more people employed in banks today. So more and more software needs will come to the fore once productivity becomes that much more. That's my understanding of it.
Maran, what is your hunting ground today? And are there pockets of stocks which are perhaps just 10% away, because it doesn't take too much for the market to go down 10%? I mean, a couple of weeks of bad news may take it there. 10% away from what you would think is compelling valuation? Pockets.
There are pockets. There are pockets. One thing we should avoid doing today is to trying to make sense of whole market in a overgeneralized manner.
Yeah.
Maybe we got used to periods like 21 to 24 when you had a broad market move, and that move came with very low standard deviation. Over 3-4 years, we had much higher than long-term average returns, but at much lower than long-term average standard deviation. Such periods usually will be followed by periods of lower than long-term average returns or higher than long-term average volatility, or both. At this point of time, instead of trying to make sense of whole market, if you are looking at certain pockets, maybe in the last 6 months, 9 months, even before the recent correction, there are pockets of market which are much cheaper today than what they were, say, 3-4 years back. For good reasons. Either there would have been some earnings disappointment, or some inconsistent earnings, or uncertain future. Within that, if you can find few pool of ideas, this is fantastic time to invest.
So what are those pockets? What are you looking at? Higher than average growth, lower than average valuations.
It's easy to ask, but tough one to state. But I think there are few pockets. People like you try to make sense that in terms of sectors. But we should be conscious of the fact that some of these sectors, which were extremely homogeneous in the past, like IT services, may not be so in future. So may find a very different outcome within that. But there are few businesses like financials, which are not in the expensive pocket of the market. They are cheaper today than what they were 3-4 years back. Pharmaceuticals, they are cheaper. But there are a whole lot of businesses which you can't just... I think this mic is off. Yeah. So you will find a significant sectoral rotation maybe in the next 3 to 5 years from now. We have been having it over a period of time. We don't notice it. What was maybe steels, cement, textile, power were 60-65% of the industry when I began my career in 91. And in 2001, we had probably 40% of the index market cap being in IT, and financial services were in single digit. As recent as 2020-21, we had almost 40% BFSI. Are we going to have similar weightages, similar sectoral representation, say 10 years from, 5 years from now, 10 years from now? We are not going to have it. So it is better to not to take a sectoral call and instead focus on valuation, and there be agnostic to the market caps. Today it's tempting for people to say small mid caps are expensive, right, but within that you find quite a few interesting opportunities. And some people may say large caps aren't that cheap, but if you look closely, maybe 35% of the large cap earnings are in single digit companies, which means the balance 2/3 of the large caps are much higher than what the index is showing. So there are pockets, but instead of trying to make sense of that in an overgeneralized manner, right, or through a sectoral lens or through a market cap lens, it makes sense to go back to the basics of valuation and see the opportunities.
Got that. I mean, this is a conversation that will go on in Money Control every day, day in and day out. Half an hour is too short to sort of, map the whole market and say where you should be buying and selling. But thank you so much, gentlemen. All of you, please stay tuned to Money Control and this conference for more conversation. That's all the time I had on this panel. But thank you so much, gentlemen.
Appreciate it. Thank you.
Good morning, ladies and gentlemen. Good morning to this audience, and what an interesting discussion we've had out there. So I'm wondering, how is the audience feeling? How's the Josh? Gold, silver, crypto, real estate? Any ideas, any thoughts? Equity. Equities is really getting the audience, I think, thoughts out. We have a lot more lined up for you. Thanks very much, Mahalakshmi and the panelists there. Fantastic session. Now, before we move on, just a quick reminder. If you want to share your key takeaways from the Moneycontrol Global Wealth Summit 2026 on social media, please do click post, but remember to tag us as well and use the hashtag MC Global Wealth Summit 2026. Do tag moneycontrol.com. And also, just another quick reminder, a little planting for the future tag is there on your tables. I'm sure everybody's seen it on your tables. Please do take it back home, plant. It's a lovely Sunday tomorrow. You can use that time. Remember to click a picture and do, again, share it with us, tag Moneycontrol and IDFC FIRST Bank, and we'll be very happy to post it on our handles. So let's spread the message, going green, green for the planet, green for our portfolios. We all are looking for a little bit of green in life, right? So if you, by the way, if this tag, if you can't find it on your tables, then do collect it. It's also available at the registration desk. So make sure green is the color we want on our planet, in our planet, and obviously in our portfolios. Let's move on now, ladies and gentlemen. With India going through a remarkable financial transformation, millions of new investors are entering the system. Digital payments are becoming second nature. Few leaders now have had a front row seat to this transformation, like our next speaker. He built Capital First from scratch, merged it with IDFC Bank, and has spent the last several years transforming it into a modern digital retail bank serving over 40 million customers. Ladies and gentlemen, please welcome on stage V. Vaidyanathan, MD and CEO, IDFC FIRST Bank, with a huge round of applause. Mr. Vaidyanathan, if you could hear a few words.
Good evening, ladies and gentlemen. It's really a great pleasure for me to talk to all of you, and this is one of the probably only second time in my life I'm doing a speaking at an event where it's all around 360-degree view. First of all, since I'm one of the early speakers, I'm trying to just set the context of the overall numbers that we're dealing with in the country when we talk of wealth management as an opportunity, but set the context. So India's household financial assets in the country is about $19.3 trillion at this point of time by multiple research numbers. Of this, the financial services household wealth, okay, financial services, that is about $4 trillion. And of that number, let me just share with you where is that money. So this is about 22 to 23% is in financial assets. Now this number about 5 years ago was 18%, about 10 years ago. So you can clearly see that financialization is growing, and the rest of the number, X this number of the 19.3 minus the $4.3 trillion is basically physical assets. Could be property, which is the largest, gold comes next, then physical assets like consumer durables and other watch, pen, all the kind of physical assets people own. That's about 80% or maybe 78%. Now of this financial asset of about 350 lakh crores to 400 lakh crores, 150 lakh crores is in bank deposits. Now don't confuse this with bank deposits stock in the country as we report, we normally call it 240 lakh crores. But I'm saying household bank deposits, okay, household bank deposits. That's about 150 lakh crores. Equity, good estimates are about 100 lakh crores. Mutual funds, about 50 lakh crores. Again, don't confuse this with mutual funds of 80 lakh crores we talk about. We're talking about household mutual fund holding over 50 lakh crores. And then EPFO, pension, etc., all that 45 lakh crores, you get the drift. So a large part of the Indian ecosystem is still in bank deposits, but you can see clearly that mutual funds and equities growing very well. Let me just share with you, in the last 10 years, the bank deposits have grown by 2.6 times to reach the 240 lakh crores today. Now I'm talking not household bank deposits, but total bank deposits. So total bank deposits have grown 2.6x in the last 10 years to reach this 240 lakh crores. the total mutual fund investments has grown 7x, 7 times, to reach about 80 lakh crores. The total PMS market, portfolio management services, that has grown 7x to go from 1.5 lakh crores to 11 lakh crores. The AIF market has grown again 12x from 1 lakh crore to 12 lakh crore. You can clearly see that bank deposits has grown by 2.6 times, but everything has grown by 7 times to 11 times. You can clearly see money is moving to investments. But this is not something that should be surprising. Then I went and checked out data for other developed countries as well. Like in the case of US, for example, and many other developed countries, what we are saying bank deposits, household bank deposit about 50% or so, this number is about 15% or 20%. So as the initially, like all of us, I'd say 90% of the people in this room also, maybe one generation ago, our parents would have probably earned maybe a lakh a month, a lakh a year, or maybe 2 lakhs a year. But today you can see people are earning maybe 50 lakh, 60 lakh crore of a year, depending on which income level they are, maybe even 20 lakhs. So you can see that big shift has happened, and after the basic need of keeping money in savings is required, people do move to investments. People do move to investments, which is why as income is growing, you can see clearly where the story is moving. So, and this is also fueled by the fact that huge amount of entrepreneurship is coming in the country. Any case over the next 5 or 10 years or so, you will see serious movement in entrepreneurship, in data center, and with data center will come downstream entrepreneurs like your maybe cooling systems, maybe wiring, cabling, real estate that is coming for data center. You see the drift about everything will create its own. Similarly, renewable energies will come, that will create its own ecosystem of entrepreneurs. A semiconductor industry will come, that will create its own downstream entrepreneurship ecosystem that will come about. Space will come, AI will come. So these are new sectors coming up. Everything will create its own, entrepreneurs, micro-entrepreneurs, and so on and so forth. And that also creates wealth. Big amount of intergenerational wealth will also happen. Compared to past generations, this generation has made a lot more wealth. It will get transferred to the next generation, and they will all need financial advice, wealth management, and so on. So if you see broadly, the people, if you think of a pyramid like this, and think of people at the top, they usually are getting all support. They are getting mutual fund advice, they're getting AIF, they're getting PMS. I speak to many venture capital funds these days, $100 million, $200 million funds. Everyone is telling me my fund is making 15% CAGR, 20% CAGR. Where is all the wealth going to? They're all going to top of pyramid, because who's investing there? Only top of pyramid people are investing there. When you come to, let me say, middle segment, in the middle segment, one level below, these are people earning probably maybe 20 lakhs a year, 30 lakhs a year, 40 lakhs a year. They probably invest in mutual funds. They get kind of advice. I don't think they're getting high quality advice, which fund to invest in, etc. But they just they go by. If you come, but they have some wealth, not great advice. If you come below the pyramid, people earning 15,000 a month, taxi drivers, rickshaw pullers, this is a large population of India, they neither have money, they have very marginal saving, and they don't get advice for sure, because no bank can afford to do it. But my point is, I'm going to show you in a quick demo about how, this advice can go down the pyramid in a very quick way. And, my colleague here will just put it up. So now what we have done is that, is the screen coming up? Yeah, so what we have done is, we have tried to create something called wealth management for all. This is very important, because we also admit it's not possible to give a 40 lakh relationship manager to somebody keeping 20,000, 50,000 rupees in the bank account. It's not, economics don't work. Because remember, behind every relationship manager meeting a customer, there's a large number of people who are behind the scene working to make it happen. They are the portfolio research people, they're the analysts, the operations people, the compliance people, technology people. A lot of people are working behind. So one RM supported with so many, all that cost comes to load to service a customer. We all know that. So what we have done here is that we have created something called wealth management for all. You can see on the top, left-hand side, wealth management for all. So now we say, click on wealth management, And then you say that, you go here and you say, look, if there's a customer who doesn't know their own risk profile, they say, they don't risk profile. They say, I'm not sure. So here they come and say, look, how dependent are you on your investments? Okay, partially dependent. For time horizon of 3 years, how comfortable are you if you're of high risk, high returns? You say, I don't know, maybe I'm not comfortable, or yes, I'm comfortable. And then you say that if you win a lottery and all your money was if you want to invest, where would you put it? Let me say debt and equity. So through all these processes, you get a sense that, this customer is a balanced investor. So these are digital tools. So you say, okay, I want to make an investment. And then based on the fact that you are a balanced investor, now the system is then throwing up, say, a bunch of funds for you, which is a deep research that has happened behind the scenes, the same number of people, but instead of serving, 20,000 customers, it is serving, let me say, 20 million customers. So dramatically equation changes. And then you are in a position to say, okay, what is this fund that is recommended by the bank in this case? And then you say, you can see what is the performance of that particular fund. You can see what are the market cap of the companies it is invested in. What are the companies that particular fund is invested in. And then you see the companies you feel comfortable. Then you come and say, okay, what are the scheme details? And then you come and say, what is the risk of this fund? You can see risk of this fund is something like this. You say, fine. And then you say, I want to make an investment. And then you say, okay, invest now. And then you get an OTP, you submit it, you verify, and this investment is done. So this is a digital process of giving wealth management to below the pyramid, because whom we cannot afford through the relationship manager process. And it works, by the way. And let me now take you back to say that if this customer, one of the big things India has achieved is to create the account aggregator framework. And with the account aggregator framework, you can see the top right-hand side, we got something called the My Net Worth. So in the My Net Worth, you can click on this, and this particular customer whom I'm referring to here has a net worth of, say, 23 lakh rupees. And this person can now see what is the savings accounts I have across the ecosystem. In this case, let me say this person has account at State Bank of India, and then so on and so forth. And then, the person says, okay, what are my stocks I'm holding? And similarly, what are the mutual funds I'm holding? And then you get the drift. And then you can say, what are the EPF? What are the fixed deposit across the system? And so on and so forth. So this ability to bring the entire ecosystem together through the new digital ecosystem India has created, and make it available through, you can see in a single screen, this person could see their investments across mutual funds, EPFO, stocks, fixed deposit, bank balances, everything. Now you can do high quality analysis on this based on-off data and off-us data, and then give high quality research to the common people, which you would have normally brought through relationship managers to the top of the pyramid. And this is something that is a new agentic ecosystem that is going to come up in AI. This will make a very big difference, because again, in today, when a relationship manager meets a customer, I told you there are a lot of operations happening behind, and you're serving 200 customers or maybe 70 families. Its economics don't work. But with the arrival of AI, this research can go and check, agent can go and check what are the news articles about the subject. It can give a full look through of what are the stocks you're holding based on the multiple mutual funds you're holding. It can probably go and do a tax assessment for you. Another agent can go and see what are the GST changes. Another agent can go and see what is happening in the oil market today or what's happening. So there are multiple agents can operate in the background, very low cost compared to human beings, bring it together and give high quality research. Therefore, when today wealth management is available at, say, 5 crore plus or a private banking with a relationship manager, same quality research. I use the word same quality, not the lower end quality. Same quality research for a 5 crore rupee customer, what you're getting high quality, can be made available to somebody keeping 10 lakhs in the bank. And that makes a very big difference. Not even 10 lakh, could even go below that. So that is the power AI is bringing to this digital ecosystem if we embrace it to the whole ecosystem. I don't mean the conversational capability, which also can be the next avatar of it. Because conversation, like a RM talks to you, like that the conversation, it can never be as high quality as a human being really talking to you, but you know, you get the drift, get somewhere close. So this is one very important thing that India should be moving ahead in this ecosystem. I want to just, finally conclude that this agenda of, because what is happening is that the rich will continue to become richer because they will keep earning 15% plus compounded. If they put an AMIF, PMS, they will become maybe getting 18%, 20%. But bottom of the pyramid is just beating inflation through savings. They will never make wealth. So this rich-poor divide will only increase if we don't find high-quality digital tools to fix this issue. And today, fortunately, with the digital ecosystem, availability of Aadhaar, the entire bureau and the whole digital India ecosystem India has put together, plus the arrival of AI, is a massive opportunity if we absorb this opportunity and take high-quality research to the bottom of the pyramid. Now, I want to just conclude by saying that there are few things that we still need to improve. India has built this phenomenal architecture today of, depository participants, registrars, a fantastic regulator who's looking at it so closely and so on, and regulating it, and the time coming down from T+3 to T+2 to T+1, paper going away. That is like something phenomenal India has created. All of you will talk about it, I'm sure, all day. Now, this is a massive thing that is actually enabling things going down. In the previous ecosystem of paper, there's no way below the pyramid would have been serviced. So the cost of funds coming down is also because of a market mechanism India has created and a settlement architecture and so on. But even today, if you see the porting of a customer from one wealth manager to another is quite complex. You take a physical paper, you send it to some RTA, and they take 15 days to make it happen. In today's digital world, it should not be like this. Because you can move a bank account, you have two bank accounts, you move money instantly. You can even port mobile number, quickly. But you can't port a wealth customer today so easily. It takes 15 days to make it happen. So this is something that, it will improve competition, it will improve, service levels. This is something India should look at. And finally, of course, when we look at, the growth of the wealth management ecosystem, fortunately, a large number of players have now come into the game. Banks are providing wealth management. These new age broking firms are providing it. Standalone wealth companies are providing it. So this ecosystem has come alive, which is all bringing it together. So I'd like to bring this to a close. Since we are associated with the program, I'd like to share with you very quickly about IDFC FIRST Bank. I'll just take a minute to just share with you that we are ourselves a big beneficiary of this being created in the new digital ecosystem bank. The person who spoke to me, introduced me as saying building a digital bank. I truly tell you, IDFC Bank is building the bank on 3 fundamental principles. We are saying new digital ecosystems come. We are born in the new age. So I showed you how we can do, I did a demo. We say we want to be ethical banking, so we really make that in a tagline. We want our employees to imbibe that. And third, we say, simple products. I want to tell you that in the last 10 years, 6, 7 years alone, you can see our wealth management grown from 1,000 crores to 58,000 crores. And that's like you can see how it's growing. And then we kept it very simple. We said zero fee banking. We said 6.5% interest above 10 lakhs. And then we said monthly compounding, and below 10 lakhs we pay 5% above 1 lakh. And then we said monthly compounding interest. We keep it very simple from the point of view. We try to put a bunch of services for the customers which we think are complete in terms of wealth management proposition. And we put together a bunch of credit cards, and we take out all complexity, etc. But the point is that we are experiencing whatever we're building. We are experiencing it, that customers are loving it, numbers are growing. But the main thing is that we are ourselves following this concept of taking it below the pyramid and dropping the thresholds or giving the same quality what we give for a 5 crore plus customer to somebody even keeping maybe 10 lakhs. And that is our agenda we're working with. And that will truly expand it, particularly with the growth of the Indian market ecosystem, digital ecosystem, and the market and the extraordinarily fantastic market infrastructure India has put together. And I must close by saying in the last 10 years or so, India has truly built something quite remarkable in terms of all the participants, the wealth managers, the regulator, etc. we talked about, and my really heartiest compliments to anybody, all of you who are participating in building this big ecosystem for the country. So thank you very much, all of you, and really nice talking to all of you. I'm really so happy the regulator is here with us, and thank you very much. All of you are doing a really wonderful job for all of us. Thank you.
Thank you so much, Mr. Vaidyanathan. That was a very, very interesting session, very interesting thoughts as well. And obviously, financial services has become an increasingly complex and perhaps increasingly competitive landscape here in India. And technology and digital obviously is the disruption and the opportunity as we go forward. Well, we also have our guest of honor here with us, and in the next couple of minutes, we will be hearing from him. We're talking about the capital markets ecosystem. We're talking about keeping investors' trust and faith intact, and that is what our guest of honor, of course, really embodies and symbolizes. So in the next couple of minutes, I think we'll have Nalin join up on stage to welcome our chief guest. But in the meantime, as we're just getting ready for that session, let me ask the audience. So how's the Josh this Saturday morning? I think it's only high on my left. I think my right is not feeling it. Oh, someone on the back, I think. Okay, so once again, I go back to that question I asked before this session, before Mr. Vaidyanathan came up. So equities, bonds, crypto, commodities, precious metals, real estate, come up with what you want. This side said equities. What's the right side saying? Multi-asset. Someone's saying cash. So okay. So I think we have mixed views over there. So? Fidgetital. Okay. Okay. All right. Okay, let's do a riskometer. Volatile markets, the last 1 year has never been, perhaps more challenging in a while, since COVID for sure. We've had the trade disruption thrown at us. We've had the AI disruption thrown at us. And now we're dealing with a full-blown war in the Middle East. So riskometer, how are you feeling? It's a feel factor or an emotion factor riskometer. On a scale of 1 to 5, let's see a show of hands who feel that the fear factor is at, say, 7, 8, or 7 or above. How many people feel that there's a lot of fear and they want to go down on risk? Show of hands. Who want to curtail risk in their portfolios? Not too many, actually. Okay, a few hands over here on this side. Okay, and how many are willing to go all in and use every opportunity to buy? There we go. I think the bulls have it. The bulls have it for this one. Thank you, audience. You're very, very spirited. Thank you very much. And without further ado, now let's get ready to welcome in our guest of honor, Nalin. If I could please have you on stage.
Thanks very much, Surbi. Capital markets, of course, rest on a very simple promise: fair information, honest price discovery, and a level playing field. Upholding that promise is the role of the capital markets regulator, the Securities and Exchange Board of India. And right now, the agenda is as complex as ever, from the surge in retail F&O trading to IPO pricing and global capital flows, and of course, the impact of the war. Ladies and gentlemen, we are privileged to have among us today the man holding it all together, a beacon of stability in a world full of chaos, the chairman of SEBI, Mr. Tuhin Kanta Pandey, sir. We at Moneycontrol are very fortunate that you kicked off the inaugural Global Wealth Summit last year in your first public speech after taking over as SEBI chairman. And we're delighted that you're back this year at the second edition, sir. We are very honored and grateful, sir, for your presence. Ladies and gentlemen, Mr. Pandey has been India's one of the most distinguished civil servants, an IAS officer of the Odisha cadre of 1987. Before joining SEBI, he served as the Union Finance Secretary, the Revenue Secretary, and the Secretary Department of Investment and Public Asset Management, also the Department of Public Enterprises and DOPT. He's also served in the Regional Office of the UN Industrial Development Organization and holds a master's degree, sir, from Chandigarh University and also from an MBA from the University of Birmingham. Sir, over to you, sir. Everyone is waiting for you.
Good morning, everyone. It's a pleasure to be here today with this distinguished gathering of leaders from finance, business, policymakers, media, and the wider ecosystem. I would like to thank Moneycontrol for bringing together such a diverse gathering of participants. Today's theme, making capital markets more efficient in uncertain times, is both timely and important. If we look at the global economic landscape today, one word appears repeatedly: uncertainty. Technological change, particularly the rise of artificial intelligence, is reshaping industries and business models across the spectrum. At the same time, geopolitical tensions continue to influence economic relationships. Conflict in Middle East has massively disrupted energy supplies and created volatility in oil and gas markets across the world. Inevitably, capital markets have been severely impacted. Yet, when we look back at similar episodes in the past, one lesson becomes clear. Periods of extreme volatility never last forever. In the recent past, we have witnessed the disruptions caused by COVID-19 pandemic, followed by the Russian-Ukraine conflict, which had triggered market volatility across the world. Markets experienced turbulence, but they eventually stabilized. Even today, while the ongoing tensions in parts of the world have created uncertainty in energy markets, global efforts are underway to restore stability. For many investors, especially retail investors, the best strategy may be, during such period of high uncertainty, to remain patient. Markets today operate in a very different information environment. Capital flows now respond not only to economic fundamentals, but also to rapid shifts in sentiment, information, and narratives. This raises an important question. Can markets remain efficient when uncertainty itself becomes the norm? Or perhaps a more relevant question is this: are markets designed to function efficiently despite uncertainty? Because uncertainty, as history tells us, is not an exception in financial markets. It's a recurring feature. The real test of a market is not whether volatility appears. The real test is whether the system continues to function smoothly, fairly, and efficiently when it does. Efficient capital markets play a stabilizing role in an uncertain world. They enable transparent price discovery. They help absorb shocks without destabilizing the broader financial system. And perhaps most importantly, they sustain investor confidence. Efficiency is the foundation of trust in the financial system. Without that trust, capital hesitates, investment slows, and growth becomes more difficult to sustain. In fact, the true test of efficiency is not in theory, but in how markets evolve and perform over time. India's experience over the past decade offers a compelling illustration of this evolution. India's capital markets have expanded significantly over the last decade. Since FY15, our market capitalization has grown at a CAGR of about 15%. The corporate bond market has expanded steadily at a CAGR of around 12%. The primary market has remained an important channel for capital formation, facilitating around 9.7 trillion rupees of capital raising annually. The number of unique investors in securities market has grown at roughly 21% CAGR, indicating a broadening investor base and a rising household participation. Mutual fund AUM have expanded at over 20% CAGR. The AIF ecosystem has witnessed rapid expansion, with investments growing at more than 50% CAGR, channeling capital into startups, innovation, and emerging sectors, and so on. These numbers tell an important story. India's capital markets are no longer merely expanding. They are deepening, diversifying, and becoming increasingly resilient. But as markets grow in scale and complexity, they also become more closely connected to global developments. And that brings us to the changing landscape in which today's market operates. The environment in which our markets function is evolving rapidly. One important shift is economic fragmentation. Trade corridors are changing, supply chains are being restructured, and investment flows are responding to these shifts. Another major transformation is driven by technology. Algorithmic trading, artificial intelligence, and advanced data analytics are accelerating the speed at which markets operate. Liquidity conditions are also becoming more episodic. Global capital flows can move quickly across geographies. But perhaps the most striking change is the velocity of information. News travels quickly, opinions travel even faster, and most importantly, markets today react almost instantly to the narratives. And therefore, the question before policymakers and market participants alike is, how do we ensure that speed does not compromise stability? In recent years, SEBI has undertaken a number of initiatives to strengthen the efficiency of markets ecosystem. We have reduced the settlement cycle to lower the settlement risk and improve operational efficiency across the market. To strengthen debt ecosystem, thresholds from electronic book mechanism have been reduced, and the scope of EBP platforms has been extended to include REITs and InvITs. In a measure aimed at further facilitating capital raising and easing minimum public offer requirements for larger issuers, the central government just yesterday notified changes to SCR rules. These changes allow companies to list with different levels of initial public float, consistent with adequate liquidity, and provide a longer phased timeline to achieve minimum public shareholding requirement of 25%. We have strengthened the AIF ecosystem with lower thresholds for LVFs, large value funds, and strengthened the framework for accredited investors. For global investors, our effort has been to make access simpler and more seamless. Measures such as simpler regulations for IGB-only funds, introduction of common contract note, Swagat FI framework, relaxed block windows, all are aimed at enhancing ease of doing business and bringing in operational efficiency. Another area of our focus is how can we increase investor participation. To improve the investor access in debt market, we have reduced the investment threshold for privately placed bonds. Issuers are permitted to offer incentives in public issues of debt securities. To promote greater participation in mutual funds, distributor incentive structures have been revised. For NRIs, certain KYC requirements have been eased, facilitating smoother participation in Indian markets. Our efforts are underway to further simplify the investor onboarding processes by enabling enhanced information sharing through KRAs. While expanding participation, investor protection remains central to the regulatory framework. Tools such as validated UPI handles and SEBI check enable investors to verify intermediary accounts in less than 30 seconds before making payments. Monitoring of social media platforms help identify misleading or manipulative content. Initiatives such as Parva are helping standardize and verify performance data presented by intermediaries. With an aim to strengthen the governance standards and accountability across the ecosystem, we have taken several measures like mandating external independent performance evaluation for our market infrastructure institutions, designating compliance officer in regulated entities as key managerial personnel, strong emphasis on independence, diversity, and accountability in board composition, mandate for regulated entities to dissociate from unregulated entities that make unverified claims on returns on performance. These efforts aim to ensure that market development remains anchored in transparency, accountability, and investor trust. However, efficient markets cannot be built by regulation alone. They require the collective commitment of the entire ecosystem. Listed companies must uphold high standards of governance and disclosure. Intermediaries must promote a culture of compliance and integrity. Institutional investors must contribute to responsible market development. And market infrastructure institutions must continue strengthening resilience and operational excellence. Efficient markets are, in essence, a shared responsibility. As India continues its economic journey, capital markets will play an even more important role. The next phase of development will require deeper bond markets, stronger institutional participation, and continued technological innovation. Today, capital markets are moving from supporting economic growth to shaping economic growth. Ensuring that this growth remains transparent, resilient, and efficient will be one of our most important collective tasks. Let me conclude with one final thought. In uncertain times, the strength of a capital market does not lie in the absence of volatility. Volatility is a natural feature of markets. The real strength lies in the confidence that the system will function fairly, transparently, and efficiently, even during periods of stress. If we continue to strengthen our institutions, deepen participation, and uphold governance, India's capital markets will not only navigate uncertainty, they will emerge stronger from it. And that is a journey we must pursue together. Thank you, Jai Hind.
Thank you so much, sir. Thank you for your thoughts and for an inspiring speech. And I must thank you, sir, also on behalf of the entire investor ecosystem. It is thanks to SEBI that those guardrails are in place. It is thanks to SEBI that this market has evolved. It has become deeper. The systems are in place to ensure that while volatility comes and goes, the market simply goes on, whether on the way up or on the way down. The regulatory environment has ensured that our market continues to be a very, very vibrant one. So that's, of course, as far as regulation is concerned, the evolution of our market, and where we are, ready to compete with any global stock market or equity market or securities market around the world, all thanks to the structures that we have built and the way the regulators have kept our ecosystem safe, and they've kept investor trust at the center of it all. All right, ladies and gentlemen, with that we have to move on to our next session. Now we're talking capital markets. When the history of India's capital markets in this decade will be written, I'm sure that the IPO chapter is going to be a very, very colorful one. Record issue sizes, anchor books filling up in a matter of literally hours, retail participation touching record levels, and we've seen listing days that have become reminders that euphoria and price discovery are not always the same thing. The opportunity ahead is enormous. The global ECM pipeline for 2026 could approach, as per some estimates, around $2.25 trillion. Now, how much of that India captures and how these deals are going to be structured, how will they be priced, how will this capital be allocated to public investors, that will determine the shape, the credibility of our market for years to come. To take the next conversation forward, let me invite on stage my colleague Ashwin Mohan. Ashwin. Now, a lot of you will know Ashwin. Ashwin is the deals man of Moneycontrol. Every now and then, you have to be on our platform to get the latest breaking story when it comes to deals. But how's the mood now, Ashwin? Since market is almost in a funk. Well, but how's the deals mood?
Well, thanks, Surabhi, for that rather generous introduction. And good morning, everyone, and welcome once again to the second edition of Moneycontrol's Global Wealth Summit. Surabhi, you were asking me, how's the mood? Well, as a deals reporter, ye dil mange more. Think deals, think Moneycontrol, and we sincerely hope the purple patch continues. But clearly, the world has changed in the last 2 weeks, right? Yeah. We saw the last quarter of 2025 was a sizzling quarter, more than 10 billion raised via IPOs, but now the entire IPO market is facing the entire impact of the West Asia crisis, right? And that's obvious. Yeah. And that's something that we're seeing panning out because activity is slowing down. But yeah, go ahead.
But I suppose that is part and parcel of volatility. It's part and parcel of the news flow and the challenges that are getting thrown at this market every day. But I think structurally, so much has changed. Domestic institutions coming in, participating, owning so much of equity assets in the country. And I don't want to take more time because I know that you have a fiery panel lined up to discuss all of this and more. So take it away.
Absolutely. I'm not going to waste any more time, and I'm going to invite our stellar panel on stage one by one. These are men who have seen various market cycles, gone through various ups and downs when it comes to the life story of the issuers. And they've also taken some of the creme de la creme of firms public as far as Dalal Street is concerned. So without further ado, let me invite on stage V. Jayashankar, MD and Deputy CEO at Kotak Mahindra Bank. Atul Mehra, MD and CEO at Axis Capital. Abhinav Bharti, Head of India ECM at JP Morgan. And of course, from the PE point of view, one of the pioneers of Indian private equity, Manish Kejriwal, founder at Kedara Capital. A round of applause for all the panelists. Right. Be fearful when others are greedy, and greedy only when others are fearful. You know, the man who said this wasn't exactly a big fan of IPOs. I'm referring to the legendary market investor Warren Buffett. But this was his mantra during times of market volatility. And as it looks like, that's exactly the unpredictable and challenging scenario that is staring at me as well as the panel, because we now have the rather brave task of dissecting the roadmap as far as the Indian IPO market is concerned, going ahead in 2026. So, without further ado, let me go straight into the conversation. Jaya, let's start with you. More than 140 companies have regulatory approvals to go ahead to raise more than 1.6 lakh crores via IPOs. What's the mood right now on D Street? Can we safely assume that it's wait and watch mode for all the major issues? And is the strategy now to perhaps wait for stability, wait for light at the end of the geopolitical tunnel, take a check from the investors later on, and then plan ahead?
Yeah, firstly, I would say that the overall IPO momentum has been the strongest in the current year as we began in January compared to the previous 2 years. There were probably, as you said, 160 filings. If you look at the number of IPOs that happened in the last 2 years, it's been on average 100. So there is certainly a great degree of optimism in terms of quality. We are seeing the quality only getting better and better. So I think structurally everything is in place. Obviously, no one expected the Iran-Israel-US war situation.
That's right. It came like a bolt from the blue.
But as some of the fellow panelists said before this session, markets have a way of turning around very quickly. I mean, you look at the Russia-Ukraine war, probably the markets were disrupted from a IPO point of view for a period of, call it 30, 45 days. It had both the tech meltdown as well as Russia-Ukraine war. The COVID situation disrupted the capital markets for about a month, month and a half. So markets will bounce back pretty fast. At least there seems to be a consensus that the war will probably enter a low intensity even if it continues. Markets need to find that stability. But I think deal making will happen.
But are issue launches getting deferred, Jaya?
It's a pause. I wouldn't say getting deferred. It's a minor pause. We are just waiting for that little bit of stability.
Right. So when the going gets tough, the tough gets going. You know, Atul, why don't you chip in over here? What's the feedback that you're getting from IPO investors, both domestic as well as overseas? And how does the pipeline look like?
Okay. So can I set the context a little?
Please go ahead, Atul.
Okay. Flashback. Whenever we speak to investors, and investors can be of any type, foreign institution, domestic, private equity, or a man on the street, there were 4 common concerns which came up. And what was the first one? Geopolitical, Mr. Trump. The second concern that came up was the prices are too high. It's very expensive market. Number 3, valuations are stretched. Okay, number 4, FIIs are selling. These were the 4 common excuses which were given to us. Now you have an adversity which is an opportunity. What has happened? The prices have corrected. Okay, valuations are looking much better, much reasonable. Okay, and we all know that this war is not going to last perpetually. Most of the experienced people believe that if not over, it will be substantially over in a very near future. So I see this as a great opportunity in an adversity. What do we need? We need a little bit of 3 or 4 things that need to happen, and this is what the investors are telling us. Number 1, as they say, long live the king. I rephrase it to say long live the SIPs. As long as the SIPs survive and we have the inflow, I think the domestic mutual funds are in a very big way. They are not shying away from investing. Number 2, you will see a lot of cash-rich corporates whose stocks have taken a beating because of no reason. They will step in to do buybacks in a very aggressive manner.
Right.
So you will see support coming in from there. You will see friends like Manish, Kedara and other private equity rolling up their sleeves, sharpening their pencils very quickly and coming down with their shopping list to invest money, because this is a great investment opportunity for them. And what are the FIRs telling us? They are liking the correction in the market. They are liking it. Unfortunately, they are seeing redemptions in the emerging market flow, which is the only concern that they have, because they are not the principal, they are the agent. When the money goes out, they have no choice but to sell. Therefore, they are reacting. To my mind, we should not read too much into it. As Jay said, I will rephrase it. This is more of a dislocation rather than a fracture. Okay, this will get corrected very quickly, and we have past precedents which points towards us. Just a matter of little bit of courage, little bit of conviction, and you're home and dry.
Sure. Manish, I'm going to come to you in just a minute, but let me just address the third banker on the panel. He struck a very optimistic note. Abhinav, tell me, and the audience would like a candid answer, are there any super gutsy firms out there that may perhaps take the plunge even during these uncertain times? You know, I'm reminded of the market debut of Mankind Pharma back in April 2023, right? Exactly. Jaya and Atul are smiling because both of them are on that mandate. Now, Mankind Pharma launched when nobody expected anybody to launch an IPO. It came on the back of several weak retail listings. The pharma segment was down. So tell me, any super gutsy firms out there, Abhinav?
So there are a few, without naming them, but the most important point I would make is, at the end of the day, periods coming out of these volatility, we have seen the firms that get priced their IPOs deliver the best returns in the long term. Mankind Pharma was one example, but if I roll back a year prior, 2022 on the back of Ukraine war, we had a 3-4 month lull. But when the IPO market started and you had small deals, 1,000, 1,500 crore IPOs, each of those companies have done very well. So point number 1 is that the reset of valuation, because IPOs are always a derivative of where the secondary markets are. You have seen a reset of valuation in the secondary market, it will flow through into the primary markets. Primary markets are always driven more by what I call it as the VIX index. So VIX going above 20, you will see the issuance going down, because nobody will be issuing paper when stocks are going up and down every single day. You want stability more than the level of prices. So going back, there are quite a few firms lined up, and more importantly, as the secondary market stabilizes, you will see them coming back much faster. In a pipeline of 160 odd filings, there are quite a few high quality names that will come to the market this year. In my view, you will again see a situation where the long-term performance of those IPOs should be very stellar, similar to the names you highlighted.
Right. So key takeaway is that IPOs are not in cold storage. There are a few that have just merely pressed the pause button. Manish, he struck a very optimistic note as far as private equity firms and their appetite in such a market is concerned. How do you view the exit environment from your PE lens?
First, Ashwin, thanks for having me here. Good to be here. I didn't know it was going to be such a large audience, so congratulations.
Indeed, a pleasure.
I don't intend this to be a one-on-one on private equity, but I just want to put a little bit of context from an investor's eye, which is very different than most people in the room, because we do private equity, not public markets. We're not marked to market every single day. So we actually have a huge amount of luxury, and our time frames are much longer. When Ashwin calls up, kya deal hai? He needs to fill out the paper tomorrow. I smile because we have a 10-year product. So there's no rush for us to do anything.
And I have a 24/7 monster to feed.
Sorry?
And I have a 24/7 monster to feed.
So The beauty about our products is, please understand, firstly, we have to be humble and recognize the power of the markets. And whether you have an IPO that you're selling in or buying into, respect the market because it will always humble you, right? So what do we do? For us, understand as a private equity player, the largest competitor when we are in buying mode is the markets. It's not any other private equity firm. You try to convince a promoter to take a stake, help him. If the market is trading and roaring as it has been, good luck. He would rather take his company public. Whereas on the other hand, when you're selling, your market is your best friend. So broadly, and I'm coming to your answer, if I look at the last 1 year, what had we done? We had put the brakes, not brakes, but we had slowed down investments, but we had really accelerated exits. As recently as 2.5 weeks ago, and Jay and a few others were involved, we sold down $500 million equivalent of stock in one of our larger companies which we had listed called Vishal Megamart. We still sold down something more last week. So I'm just saying, at times like this, it'll be great. The prices have not, what this gives us is a chance to actually deploy more capital, assuming, unlike what Atul is saying, the war is extended. I don't want it to be extended, but if the war is extended, there should be a correction in pricing in the private markets, which is always 3, 4, 5, 6 months after the public markets. And that's a healthy thing because the markets are unsustainable as they were as a buyer 6 months ago or 3 months ago. So the correction is good, but again, in our mode as a buyer, obviously our selling, I always say I'd much rather be lucky than smart. And we're lucky we sold out. We couldn't predict the war was going to happen.
Right.
And that's our worry, where we focus our time as private equity, is not kharidna hai, bechna hai. We have great friends like the three of them here on stage who help us do that. For us, the real time right now is, given what's going on in the war, what's going on in AI, how does that influence our companies? Is that a good thing or a bad thing? And for each of our companies, the only thing we are focused on is how do we maintain revenue growth, hence EBITDA growth. Exit, there will be a time. If the markets are closed for the next couple of weeks or months, it makes no difference to our life at all.
Sure. Quick question before I come to Jay. When are we getting the next Vishal Megamart from the stable of Kedara Capital?
You know, I think Jay and Atul will know that better than me.
Jay, we have spoken about launches being on pause, but let's now talk about the forward outlook, right? Let's talk about fresh pitches, fresh filings. Which are some of the most active sectors that you see at Kotak in terms of fresh pitches and fresh deals? And a quick follow-up question. Hyundai, LG Electronics, Tenneco, now I believe beer giant Carlsberg is also in the works. Will the MNC IPO wave continue? Your thoughts?
See, the thing I would say about the Indian capital market is it's very resilient. And it's very resilient because of the pretty strong domestic institutional flow. And there is certainly a valuation arbitrage for most of the MNCs when they look at their own parent valuation and the Indian valuation. So it's only natural when they start looking at capital allocation globally to probably invest here. So if you look at the sell down last year in terms of blocks, about $30 billion were sold, out of which roughly a third were by foreign MNCs. And it's a capital allocation issue, and some of it probably happened through the IPOs as well. So I see that trend certainly continuing. The reason why they also look at India for a listing is because India is, after all, a growth market. In most sectors, whether it's consumer or otherwise, you find the Indian growth opportunity and therefore the valuation being superior. So this trend will continue, but having said that, it is not going to gallop in a fast way. It will be a steady circular trend. That's my view.
And quick take on MNC IPOs?
They'll continue.
Especially where there's scale and size.
Absolutely, absolutely. It will be more strategic decision by the MNCs to list in India. It is not just a question of taking advantage of valuation arbitrage. It's a more thoughtful, strategic decision. Some of them want to be seen as a more of an Indian brand.
Indian brand, right.
So those are other factors that play in. So it's not going to be just one of a valuation arbitrage.
Right, point taken. Atul, a few years back, there were no takers for instruments like REITs and InvITs, right? Indian issuers also did not have the option of confidential filings. Now confidential filings are picking up steam. It's not just the new age companies, but the non-new age companies also that are adopting the route. Give us a sense of the appetite for REITs and InvITs going ahead, Atul. And don't you think confidential filings are very flexible and are perhaps beneficial for a company when you might just change your plans?
Now, both of them are valid question. Let me first address confidential filing. Confidential filing is a great leeway which has been given to us by SEBI. When I say us, the entire capital market, by SEBI, it achieves many, many things. In a situation where your data is confidential and you don't want public to have a dig at it, but you want regulator to clear it, I think confidential filing comes very handy. And two, when you have a certain regulatory challenges which you're not meeting the guideline, you can do confidential filing and it helps you to buy time. So that's a second big advantage. And third big advantage, as you rightly said, I may change my mind. I may do, I may not do. So it offers great flexibility. For all the three reasons, we are seeing many companies, many issuers, many private equity investors opt for a confidential filing. So that you're going to see increased number over time.
And quick take on REITs and InvITs and the demand?
So REIT and InvIT, I am most bullish on. Okay, we just concluded one transaction last evening. Okay, Rajmark. You will. If I tell the numbers, or if you would have seen the numbers, it will blow you out. Okay, it goes to show the depth of the Indian capital market. It goes to show how many investors are willing to buy this product. And by the way, 10 years ago, when we did the first REIT and InvIT transaction, we had to explain the product to the investor. Today, investors have understood it so well, they are buying it. So I am most bullish on it. We have seen this market grow 10 times in the last 4 years. 10 times growth in last 4 years. This is the fastest growing segment within the capital market. And look at it, objectively, we need two types of companies. Companies which take the development risk, which we called as the DevCo company, and we have the REIT and InvIT companies where their build out assets are given to pension funds, insurance companies, all the ultra high net worth individual who want steady return. So it's a great product for them. And when I was talking of Rajmark, we had 10 pages of anchor list flowing down in terms of investor. And again, I'm happy to say even our regulator, SEBI, participated as one of the anchor investors in that. So the product is now gaining tremendous acceptability across every category.
Right, so Atul's made his point loud and clear. He is very bullish on REITs and InvITs. Of course, we have a very proactive regulator that has done its best to adopt global best practices. But coming to practices and processes, right, Abhinav, as a deal maker, ye dil mange more, right? So give us a sense of perhaps some of the aspects which the Indian regulator can adopt, which are present in overseas jurisdictions, but may not be part of the current SEBI setup, whether it comes to book building, whether it comes to how much skin anchor investors have in the game. Can you illustrate with a few examples? In fact, Hong Kong also last year changed the rules of the game.
Correct. So I would say, look, for IPOs, the thing that is most important is flexibility. The ability to have a flexible regime so that you can react to market changes. Remember, an IPO process is a bare minimum 2 to ideally 4 weeks that you are stuck with a single valuation number, whereas the market can go up, down, and you have to try and book build there. That's the single biggest challenge we face. So the biggest benefit if we can provide is how much more flexible we can make the process. Now, of course, the regulator has continued to work on that path. The minimum public shareholding, the minimum float required upfront, the rules that came out last night are all in that same direction.
That's right.
But just to give you some examples, despite the way the markets are, in the US right now, you are still seeing IPOs getting priced. In fact, just earlier this week, a Japanese company listed in the US called PayPay raising about $900 million. They had the flexibility without changing the issue dates to actually price their IPO $1 below the range, change the price, the number of shares or ADRs being issued. So those flexibilities in a public book build process allowed for a transaction, a cross-border situation to get listed in the US, even when the markets were so bad. So that's just a very recent example. I'll give you another example, and you talked about Hong Kong. Hong Kong has this concept called clawback for retail. And the way it works is it actually makes the retail a more positively biased in the direction of how the book building is happening. So every IPO, for example, will start with, let's call it only a 5% retail tranche and a 95% institutional tranche. There's no HNI equivalent there. And then depending upon fixed number of subscriptions for retail, that retail tranche could actually expand to become 50% of the IPO. In other words, in a hot IPO, retail gets more. In a not so hot IPO, where you want institutions to actually own the stock and so that they could hold it for the long term, they actually take the more. So it becomes more aligned with how you want the stock to get concentrated in the
And these two aspects you think will go a long way in giving more flexibility to Indian issuers.
Exactly.
Well, we can only hope the government and the regulator is taking
away
note.
From retail. If retail shows up for our deals,
absolutely,
they will absolutely get their full 35%. But equally, when they don't show up, you don't have the stigma that, look, the book wasn't subscribed.
Very, very interesting submissions, Abhinav. Manish, give us a sense, are private equity firms now warming up more to dual track processes, wherein you simultaneously pursue an IPO and at the same time you're also trying your luck with a stake sale? That's number one. It's a two-pronged question. And the second one, how challenging is it for a PE firm like you in the current environment to maintain the key metric of DPI, distributions to parent capital? At the end of the day, that's what matters to your LPs, right? Go ahead.
Second one's easier, and the two are interrelated, of course. The fact that we sold down 500 million in Vishal was cognizant of DPI, but not DPI for ourselves. You've got to think actually ahead. Creating DPI in these times is more valuable because our investors, if you avoid for a second the domestic, our investors firstly are global institutional investors who've had a huge shrinkage in liquidity because of what's happening in the rest of Asia, especially China. So they're very, very scarce of capital right now. So an additional dollar from us is worth a lot more than normally. So we shoot for DPI. The beauty about India today is DPI, there are three engines for us to your dual process. One is, of course, the IPO markets, and thanks to the domestic investors, SIP, large mutual funds, it's been on fire for the last 2 years. We also have a very active sponsor market, which is private equity firms buying and selling from each other. We sold one company to Warburg, another packaging company to Advent, one more financial services, Avas, a listed company recently to CVC. So there's a very active secondary market. When the market falls right now, the pricing in the secondary market, sponsor to sponsor, because of the liquidity in the market, is significantly higher. So you're right, that's the second one. The third one, which also for India is becoming critical, is strategic buyouts. Often companies globally are looking to mark India now as a pivot away from China, or they started with the Japanese 20 years ago, but now it's becoming commonplace. So those are fewer and far between, but you're still seeing many of those. As a PE investor, when we're looking at a company, we don't decide today, market this thing, let's do something else. That decision was made an investment. I don't allow an IC to be evaluated unless the team at the time of investment has a very good perspective on who the natural owner should be. Is it the capital markets? Is it a strategic? Is it a sponsor? And actually, the IC won't pass it until we get the names, if it's number 2 or number 3.
That's right.
My only point is, so it's not a knee-jerk reaction to what's going on in the... Our team would have had 3 options, worked on the most probable one, and frankly, if the market is as it might get to, so I don't want to be rosy all the time, this could get to a real amount of gray for the next 6-7 months. We then say we defer the sale, because again, remember, we are a 10-year product. But the discipline of exit should be such that you realize the money 3 months ago, not be forced to selling today.
Fair point. Gentlemen, we're approaching the end of our panel, but Jay, I'll leave the closing thoughts to you. Any key dominant theme that you would like to point out for the rest of the year when it comes to IPO activity? And secondly, we've also seen the market regulator, SEBI, intensifying its scrutiny of draft papers, right? There's a lot of intense scrutiny. There are a lot of questions being asked. There's a lot of focus on quality disclosures and compliance. So your quick take on those two aspects.
See, obviously, this disclosure standards, because of our regulations, is really high. We have seen some of the MNC clients really commend our market, saying that perhaps the disclosure standards here, due to its focus on retail investors, is perhaps even superior to the developed world. So that is one thing which really stands out about India. The second thing I would say is the depth of our capital market is really strong. I mean, if you look at the last 5 years and take the top 10 companies, I think they would have probably raised through secondary IPOs as well as blocks anywhere between 20 to 30 billion dollars. I mean, Vishal Megamat that Manish spoke about, they have done about $3 billion in 15 months. Mankind, you spoke about $2 billion in 15 months or 18 months. So that's the kind of depth that is there for quality companies. And that is what keeps us excited. Structurally, I think India is in a great place.
Well, audience, you can sense the optimism on stage. Atul, Abhinav, Jaya and Manish, thank you so much for your rather candid thoughts. With that, we have come to the end of this discussion. Hope you folks enjoyed it. Thank you so much.
Thank you. Thank you.
Thank you, gentlemen. That was a very interesting one. I think it's very, very clear. Global capital, local capital, it will be here and it will chase assets, which is why the deals market, the kind of assets on offer, the pricing, it will always be extremely at all points in time, offering plenty of opportunities for investors, depending on, of course, their individual desires. With that, let's move on. Now, India has an estimated 8 to 10,000 family offices managing over $30 billion. This number is growing faster than probably most of the other Asian markets. That brings us to our next discussion. Inside India's family offices, the new playbook for private wealth. Let me call my colleague Chandra Srikanth on stage to talk about this, and then of course she's got a full panel of experts with her. Of course, Chandra is no stranger. She's a lady who spoke to President Trump at Davos. So, we'll always remember that as a highlight.
And when the trade deal happened, Surabhi.
Exactly, yeah. So that was Chandra at Davos. Chandra, I can tell you this, that as someone who tracks the market, family offices have become such a huge force to reckon with. Of course, there'll always be the debate about whether people should be entrepreneurs and focus on building businesses or building family wealth. But that debate continues, and I'm sure you'll be discussing that and more with your set of experts and panelists.
Right. In fact, all of them are sitting right here. Some of the biggest family offices in the country, who I dare say are giving Ashwin speakers a run for their money, private equity funds and venture capital, because these are not just token checks anymore. Yeah. They are investing in the private markets. They are investing in the public markets. They are making overseas acquisitions. Yes. And they are setting up offices around the world. So India's family offices are going places.
They've really come of age. So take it away. Let's call the
Thank you very much. And it's always challenging, to stand between a session and your lunch. But I promise you, this will be very appetizing. A lot of interesting takeaways. Not to mention a lot of money on stage. It's my absolute pleasure to welcome Rishabh Mariwala, the founder and managing partner at Sharp Ventures. Rishabh, please come up on stage. We also have Deepak Padaki, the president of Catamaran, which manages Mr. Narayan Murthy's funds. We have Shekhar Garissa, the MD and CEO of Claypond Capital, which is Ranjan Pai's family office, and Venkat Subramanian R, which is actually the newest family office on the block. He's a CIO of USK Capital, which manages Uday Kotak's wealth. Thank you all very much. Thank you, Rishabh, Deepak, Venkat, and Shekhar. So, the previous panel had the bankers, but you guys are the ones who will sort of put money on the table and cut those deals. But before I come to each of your family offices and their approach, I must ask you, it's been such a challenging time globally in the last few weeks. How has that changed your strategy? And Rishabh, I'm actually glad that you're in Bombay because I know you shuttle a fair bit between Dubai and India, but it's good that you're here.
No, thanks for having me, Chandra, and pleasure to be here at the Moneycontrol Global Wealth Summit. I think from our end, I think these changes have happened here and now. So it's difficult to really plan in terms of with all the geopolitical shifts taking place. I think the here and now issues will be on crude and how that impacts overall businesses. Unless you're in QSR where you might get impacted. I mean, I talked a little bit more from a consumer lens. So that's what I look at. I'm sure in other industries there will be different issues that will prop up. But at least those are the here and now issues for us. But I think in terms of you're asking in terms of staying relevant, what are we doing? So at least from our end, in terms of strategy, we're just being more relevant in terms of the quantum of capital that we're investing into the businesses. So we're going deeper. We're taking more stake in the businesses. And so by taking more stake and being more relevant, we're able to influence the founders more. The amount of capital that you have on the cap table, that is proportionate to the influence that you make with the founders, is our belief. So I think that influence itself makes a difference, and having a seat at the table in terms of just influencing really impacts the potential overall direction of the business. And if we believe that we have the experience, then we can actually add that value to the founders. Of course, the founders are driving the show. We are venture capitalists, so we're investors, so we appreciate founders as well. And founders are driving it. It's their blood, sweat, tears with our capital. So, I mean, that's how we look at it. But I think that, just overall in terms of thought leadership as well, we do a lot of engagement with founders to actually drive, value and give perspective. So, for example, we had 3 weeks back, we had an entire masterclass on content is the new distribution, and how content is changing the way in which the distribution moat is getting killed in consumer. So,
and will consumer continue to be a sweet spot for you? Because you've been investors in, Mama Earth, Nykaa, Sleepy Owl, or Sleepy Cat, a whole range of D2C and consumer businesses. So will that continue to be your sweet spot?
Yeah, 100%. That's all we understand. We don't understand anything else.
What about you, Deepak? If I look at Catamaran, again, very diverse portfolio, from insurance to deep tech. In fact, one of your companies listed recently, Sedimac Mechatronics, which is a deep tech company based in Pune, founded by an IIT Bombay professor. So where do you lean towards?
So thanks for having me and all of us here, Chandra. I think just to the first question on, what's our reaction to all the volatility and the chaos in the world today. Look, we are test match players, not T20 players. We watch the T20 and clap. But really, the idea is really long term. And so these volatilities will come up and down. And you have to go with probably 3 things. One is, like Rishabh mentioned, if you have conviction in what you bought, whether in public markets or private markets, then just wait it out. One of the things we try to evaluate is whether the company is resilient enough to handle such short-term, volatility. The second really then comes down to asset allocation. Do you have enough liquidity that you can, manage investments when there is an opportunity, right? So it comes down to honing your ability to have the right allocation so that you can turn some of these events into opportunities. So for instance, today, we are really analyzing how much liquidity we have or be able to generate quickly. So if the market drops, then you use this as an opportunity to enter because you're really thinking long term, right? So that's the kind of approach that we have taken. And yeah, we are glad for some of the IPOs. We've had 2 IPOs in the last 2 months, 3 months, I would say, which is again testament to the quality of those founders.
And will you look at setting up perhaps an overseas office for Catamaran? Is that on the cards? Do you already have plans in that direction?
Yeah, I mean, we are looking at that more from a point of diversification because most of our capital is here. But you have to find the right structures and the right partners to do that. We have made attempts to do our own, but that hasn't come through, but because of the way we are structured. But if we find the right partners in, who think like us long-term, the right amount of risk and safety that we're looking for, that's an opportunity, yes.
Great. Venkat, as when I introduced you, I said the newest family office in the block, managing Mr. Uday Kotak's wealth. You are what, 15 months old?
About 18 months.
18 months. And one of your first big moves was actually to acquire a consumer brand in the US, which is a very different approach. So tell us about, where you see opportunities as a family office.
Sure. First of all, thank you for hiring me, and good afternoon to all the audience here. I'll take one step back and just explain to your audience. First of all, the term family office. Each family office will have a different objective. So it's not a homogeneous pool of funds. And hence, while in some parts, family offices would have somewhat similar objectives, but if you scratch the surface, everybody has a different goal. And in our case, because of the kind of peculiar nature of the family office, that we have a large exposure to financial sector. That constitutes the bulk of the family's assets. And that financial entity by itself has significant exposure to everything that you can think of in financial markets, whether it's public markets, private equity, everything related to, and it's a big play on the Indian economy and the Indian financial sector. So that's our starting point. So, while many family offices may be trying to solve for a certain amount of financial return for the corpus that the family has entrusted with them, in our case, we have a significant exposure to the markets in any case. So when we thought about what should be our strategy, there were two things. One is diversify away from financial services. And again, unlike many of the big business families and industrialists who tend to have, because of business reasons and the nature of business, tend to have capital outside, which acts as a natural diversification. In our case, our founder, our principal, had zero capital outside India. So we are entirely INR, entirely financial services. So from there, how do we move out? So the diversification objective was non-financial services and, to the extent possible, non-INR kind of investments. So that's how we kind of thought about it. So that's on one part. The other part was, again, we didn't want to be in multiple small investments, which we have to manage. The approach is that, look, we want to be business owners. Like we have investment in the bank, we want to make a handful of investments that we can practically own forever. So that is, a business owner's mindset than as an investor mindset. So that's our starting point. And the investment that you referred to happened to be one of the opportunities that came along because we have been talking to the bankers, and we found the target to be extremely attractive. We got an opportunity to acquire almost 90% of the company, and it's in a better for you snacking kind of product.
Will that continue to be the sweet spot, non-financial services,
Yeah,
non-INR?
Absolutely. Not INR. We'll of course be looking to make investments in India, but it so happened that this one came up
Basically,
ahead.
if you're not doing anything in financial services, go to...
We won't, by mandate, we can't do anything in financial services. So that's our starting mandate. But so non-financial services, business ownership approach with a value investor mindset. That's the way I describe our objective.
Shikhar, if I look at Clay Pond Capital, out of 5 startup deals today, at least 2 will have Ranjan Pai's name somewhere. Now his name is also there when it comes to IPL teams. So hopefully, I don't know, RCB, are we going to see Ranjan Pai there? Fingers crossed, toes crossed. But how has it been for you? Because you've taken really large stakes in some companies where you have a controlling position. And these are not easy companies to run or turn around, from Farmeasy to Akash. But on the other end of the spectrum, you also want to invest in new age startups, for example, like a River EV, which makes EV bikes. And are you also an LPN fund? So is it going to be a diversified strategy?
Yeah, it's quite diverse, as you said it yourself. Yeah, the two ways we're looking at it, right? First is there are sectors that we understand well, given our background.
Closer. Yeah.
So sectors where we understand well, we're okay to take very large concentrated bets, control stakes, and you've spoken about some of those investments. And then the second part
where
of
you're
it
promoter.
Sorry?
Like you're the promoter of Akash, promoter of Farmeasy.
We're not promoter of Farmeasy, but Akash, yeah, we have a control stake there. And we also have control stake in some medtech device companies. So in spaces where we understand, we have very clear opportunity view, we are happy to take those risks. But the rest of the fund, we also are a very active growth stage investor, and you spoke about some of those investments as well. There, we like to participate at a certain stage. We are sector agnostic, but we are more stage specific, so which is coming in at growth capital, maybe 200 to 300 crores of check size. And there we are fairly open and operate like any other private equity fund. And yeah, I mean, coming to the recent volatility, by definition, we are long-term oriented, like Deepak said. It doesn't impact us.
Deepak said it's a test match approach, not a T20.
Yeah, rightly said. But that said, it impacts our portfolio companies. So in a portfolio like ours, we have an airline company and we have a defense company. And the impact is very different on both of them, given what's happened in the last 4 weeks. So for us right now, the focus is on supporting our portfolio companies, for them to deal with the situation in the near term. Than for us as a fund, we continue to operate the way we have always operated, which is to take long-term view.
Right. I think earlier my colleague Surbhi did a show of hands in the room. Will you buy the dip or just stay away from the markets for now? And I think people on this side of the room said it's a big opportunity to buy. So from a family office perspective, are valuations more reasonable now, both in the public market and private market? Is it an opportunity to double down, Rishabh?
I think, not that I'm an expert on public markets, but I think across the board, it's still, the valuations are definitely much higher, and definitely a lot of overvaluations taking place across small and mid caps, for sure, large caps as well. If you look at a 20-year or even a 10-year the mean, it's still one or two standard deviations above that. So the
correction has not yet sort of happened.
Not yet, at least. Not that we see it happening. I would love to hear from the others, but not that we've seen that happen. It's not sort of impacted our portfolio in any way. But I think it will come. Given all the uncertainty geopolitically right now that's going on, I think it's a function of time where it's going to happen. You'll see that dip coming in the next, 3 to 6 months. Difficult to say, but next 3 to 6 months, at least in the public markets. In terms of the private, again, if I look at consumer itself, Marico's been an acquisitive player, but we've done deals at really good valuations. So that's augured well for us. But then you have you have companies who are buying businesses at 6x multiples. I think those take the markets. Founders want those high multiples, which again, I don't think that will augur well for the market either, because even for a listed company, you have to build into those multiples. So if you don't build into that, then you'll get impairment. So I think it's a challenge when you buy, even though like consumer good companies, we have big treasuries, and we can afford to buy those companies at 2,000-3,000 crores or whatever. But still, the challenge is that once you acquire it, how do you build it up to that level at that pace? So the pressure is on the company to actually then perform and make that good and make that happen. And I think that's the challenge, which sometimes founders just see the market and say, okay, fine, this is 6x multiple and this is what I want. But in reality, it's very difficult to sort of come into those valuations.
Got it. Deepak?
No, I think, if you look at public markets first, I think like somebody said in the previous panels, there are pockets in which you can buy. So what the approach we take, of course, there's a large swath of stocks that you analyze and keep ready, and you wait for the moment to buy them because you have conviction in the stock. It's just that valuation might be expensive today, but again, these are opportunities. And so rather than painting a broad brush of mid-market, small market, it's like there are pockets, there are specific companies that you can acquire today at a reasonable valuation. On the private market side, I think like Manish said in the previous panel, private markets take some time to catch up on geopolitical and these kind of risks and to mirror the public markets. And so what we are seeing, at least until this whole crisis happened in the last week, there was still a lot of money in the system. And so in late stage growth and late stage where we are focused and pre-IPO, if there are good quality companies, there is a lot of money flowing to them. Right? So it's a very concentrated flow of money, and therefore the valuations tend to be expensive, right? Pre-IPO, and so you have to be very careful at that juncture. But in early stage, for instance, if you take early stage AI, deep tech, there we are not seeing really a big run-up in valuations like you're seeing in the Bay Area, for instance, right? You're seeing pretty reasonable, and founders are also not really looking for that much of valuation uptick at the start. So I think it's kind of mixed depending on which asset class and at which stage you're looking at these things.
So private markets, you think, will still have to catch up?
Yeah,
there is a lag effect.
Of course, we have to see now what happens because as you probably most people know, in the private market, there's a lot of money coming in from the Middle East, from the GCC.
From the sovereign
What
funds.
is going to be the impact of that on the amount of capital flow into private markets and late stage in the PE markets in India, we'll have to see.
Great. Venkat?
On the public markets.
In terms of the overall valuation expectations.
Yeah. Look, the correction has been sharp, and hence you will always find the market a little bit more attractive today than it was, say, 3-4 months back. But it's not become cheap in an absolute sense. So we are far away from, becoming attractive on an overall basis. But I would say the mid and small cap, at least a 10-15% at the bottom, have become literally very, very attractive. So there is a sharp correction in mid and small cap in specific sectors like chemicals and engineering and all of that. Combination of tariff fears, raw material related disruption and all of that. So there is a pocket of market which has become attractive, but I don't think the market as a whole has corrected enough to make it attractive. From a private market point of view, I don't think there is going to be any dent immediately. The expectations in the private market are set not on a daily basis. Over the last 3-4 years, entrepreneurs have seen how well the public markets have received IPOs, and hence the valuation expectations are very high. Even today, even in this market, some of the IPOs have been priced at a level where you would hesitate to kind of invest, however good the company may be. So I think the time it takes for the message to reach the private market is still some time away, not yet there.
Got it. Shikhar, since he mentioned IPOs, I have to ask you, if you look at all the new age company IPOs since last year, except for maybe a couple, which is Grow and Lenskart, almost all of them are below the listing price. Does that make it hard for the next batch of new age company IPOs? And if I look at your portfolio, I think Zepto is a big, is one of the most anticipated listings this year, apart from PhonePe, when I look at the startup space. Again, does that make it difficult? Do you see delays in some of these IPOs like Zepto, PhonePe, till the market sort of becomes better?
Yeah, I think the panel before us also addressed this question that it's not given that good companies cannot IPO in this space, but given the trajectory of what the other companies have gone through, clearly everyone, both the companies are more aware now in terms of what they need to deliver in the first 1 to 3 years once they list. Markets can be unforgiving at times. And even from an investor perspective, people who are participating in pre-IPO are, I guess, now more aware of what it takes type that whole investment from getting in to getting out, because there are lock-ins, there, the companies themselves will go through a few cycles. So I think all of us are learning, from the rush that, the companies know what performance demonstration track record they need to have even post-listing. Markets can be very tough. The investors know what are the reasonable expectations to have when they participate as an investment in a company which is closer to an IPO. And maybe the big change is the investment horizons have to be very clear when we look at an asset which is close to an IPO. But that said, I think good companies will continue to do good, as cliched as it might sound. And in times like this, the best companies get separated out from the not so best. So the good quality assets will always attract right capital, right investors, and that's what we're in the market for.
Great.
Chandra, if I can just add 2 points to that. See, I think one is companies coming from this VC, PE and going public is a relatively new trend in India, right?
Yeah.
So we are also evolving and learning. And I think public markets also will take some time to understand how these companies perform. And the advice we are giving to our founders is that you don't dress it up for an IPO, right?
Don't do any window
yeah,
dressing.
because the market
or,
will recognize that in 2 quarters. And then you'll have a problem, right? So that is one piece that we all have to, both as investors and as companies, we have to keep a watch out for. I think the second thing there is that, well, I lost my train of thought, so I'll let it go, yeah.
We'll come back to you, Deepak, when you remember. But we have 3 minutes, so I'm just going to do a very lightning round. Rishabh, one sector that you will stay away from this year.
Stay away from?
Yeah.
I mean, I'm so focused on consumer that I stay away from
That's
most
like
sectors.
the easiest answer, anything non-consumer.
Non-consumer.
No, I said that's the easy answer for you, non-consumer.
But I think the buzz is on AI, and there's a lot of madness like globally on AI. So I think that's something that, if you really don't know it, then, it's very easy to say, put money into
anything that has .ai at the end.
Pretty much.
Okay. Deepak, one sector that you will stay away from?
We've stayed away from for a while on lending.
From?
Lending.
Lending, okay. Venkat?
I told you BFSI.
Lending, BFSI. Shekhar?
I mean, I wouldn't say sector, but we'll stay away from the hype. There's a lot of noise around, and it's very,
hype
very important.
is a very broad term.
Yeah, very important to stay disciplined in our process. But yeah, I mean, we're a sector agnostic fund. There's nothing that we'll stay away from as long as opportunities exist. But I agree with what he said that, what AI does to many of these industries is an evolving story. And that's where wherever we are not clear about what the impact of AI is, we would want to wait and watch.
Got it. Who has the toughest boss?
I mean, I did have the toughest boss when I was working with my father. Now luckily I've got enough autonomy, so he's not as he used to be earlier on. But I mean, I think I'm in a good space being a family office because I'm answerable to only the family and not to other investors. So I think, as a family office at least, because it's my family and I'm running the show, our long-term horizons are real, compared to a VC or a PE.
Which would have a 5-6 year horizon.
No, more than that, not
More
5-6
than
years. You should have like 10-year horizon, right? Because a PE, VC will have a 6, 7, 8-year horizon, maybe even 10 years. So how do we stay the path? And that's the differentiator, right? Why should a founder take our capital? They can take venture VC or PE money. So they should take the reason to exist, and the differentiator is family office because of long-term patience. And I think that gives us the performance pressure is less. And because VC and PE has performance pressure, of course it has discipline as well because of that performance pressure. But because we don't have that, I think, I was at all the annual investor conferences there in Bangalore last week, and $450 million fund, the global investors were asking them, it's year 2 of that fund, and the global investors asking them, when can we see liquidity? In year 2. So, it's funny that, liquidity is just, they want to see very quickly, they want to see DPI. And we are able to stay the course and exit even post IPO, which is what some luxuries that some VCs or Ps may not have.
Got it. 10 seconds, Deepak.
Well, you know my boss probably better than I do. No, but I must say the family has been very generous. We're trying to build Catamaran as a professional investment firm. And so the family's involvement is more to ensure that we can build a very long-lasting firm. So it's more about the processes and the way we take decisions rather than the decisions that we take ourselves.
Got it.
So I think that's...
Look, there is this quip that I'm a simple man, I'm easily satisfied with the best. So, I have that kind of requirement. But jokes apart, I think the key requirement for any professional is clarity of mandate. As long as the mandate is clear and the goalposts are not shifted, you're good. I think that's good enough.
Okay.
I don't think anyone defines Ranjan as tough. He's as good as they come. So, but that said, it's very important for us as a family office to take his culture and make sure that we are reflecting that culture in everything that we do. The advantages that family office has will always remain. That you're faster in decision making, you're flexible in terms of in your investment thesis, you can be. You have a longer term investment horizon. We are able to connect with the founders and their journey of building business better because of our background. So we need to make sure we're taking that goodness. But as we go forward, we also want to make sure that, we are truly capturing the aspirations of our promoters, Ranjan, in terms of what kind of wealth creation, wealth preservation journey he wants to go on, which means we have to become multi-asset, and which means we have to build our competencies, processes, discipline to be able to do that. So that's a balance we have to find.
Great. On that note, thank you all very much, Rishabh, Deepak, Venkat, and Shekhar, and hopefully we will see more and more money coming from India's family offices this year. Thank you very much.
Thank you.
Thank you,
Chandra.
Thank you. Yeah, thanks. All right, thank you so much for everyone for giving us a rare window into how India's private wealth is being managed, debated, and deployed. And thank you, Chandra, for leading and driving this conversation. But this brings an end to our morning sessions. We'll now take a break for lunch. Please join us in an hour for more insightful discussions. Thank you, everyone.
सबसे भरोसेमंद हिंदी बिजनेस न्यूज चैनल।
There is concentration over Taiwan. There is no way that the Philippines can survive.
The special edition of Vantage by the White House and the heart of the action. And as
Welcome to the Dictator, a series that strips away the myth.
Good afternoon. Today, First Post has brought together geopolitical strategists from across the world. President Dissilva, welcome to First Post. Before spotlight, global issues from an Indian perspective. We're trying to make our mark in the digital sound space. We're building a news platform with a video news base. Giving 200 countries a reach. We hope to get their growth stories. And we will continue to do this with credibility as a whole.
It's the voice of business, offering definitive perspectives on technology, culture, politics, and world affairs through a uniquely Indian lens. A treasure trove of actionable ideas, timely insights, and incisive analysis. Bringing best-in-class journalism to life, the trusted partner of India's decision makers. Delivering thoughtfully curated digital content. Shining a spotlight on the wonders in business that are revolving around the axes of the global race.
Of finance for an Indian.
The hallmark of leadership excellence. A dialogue with the world's greatest givers, thinkers, and doers. A celebration of India's youngest entrepreneurs, advancing industries across the globe. Forbes India, India's most influential business platform. Giants. When and how do you know you were right?
Heritage of India and inspired by its cultural and artistic beauty. A new legacy takes shape, presenting Ashwa and Madhura. The metal credit cards by IDFC FIRST Bank. For those who hold India close to their hearts and carry its essence wherever they go. A card that connects the elegance of our past to the luxuries of today. Crafted in metal, carried with pride.
Ladies and gentlemen, please welcome your host for the event, Lavisha Darad.
All right, welcome back. And of course, I hope all of you had a very hearty meal. But yes, let's move on to our next set of conversations, right from where we started in the morning. But before we move ahead, just a quick reminder that you can just share our key takeaways from our today's discussions right on your social media. So do click, post, and tag us on the hashtag, which is your MC Global Wealth Summit 2026, and tag @MoneyControlCom. But yes, one key trouble that the Indian markets have been facing over the past 12 months is the trouble from the FIIs, because we've seen over 1 lakh crore in FII outflows. Yet, we have seen that, the global investors have signaled that there could be a positive long-term outlook. So the key question has been quite important, but that is the world which is being shaped by war and valuation concerns and AI-led disruption. Will the global capital indeed return to India? So yes, to lead this conversation ahead, please welcome back Surbhi Upadhyay right on stage once again. And yes, Surbhi.
Thank you, Lavisha, so much for that. So I hope everyone enjoyed their meal. I'm just wondering how many people are feeling sleepy in this audience now? Don't even think about it. That's all I'm going to say, because the next set of panelists are going to, allow me some Hindi, aapki neend uda denge. That's the panel that we're talking about. I have, I think 2.5 bears and maybe 1.5 really charged up bulls. By the end of it, will it be a, more bullish, less bearish panel, or vice versa? We'll find out. So let me call up on stage our next set of experts, and they need little introduction. They've been with the market for many, many years, looking at it through various prisms as investors, as people who are channelizing foreign money into the country or outside the country. And we are looking forward to their views at a time when the Indian capital market, the equity market, seems to be facing several structural questions. So let me invite the lady on stage up first. I have with me Sachi Trivedi, who's founder and director of Trident Capital Investments. We have Ajit Dayal, founder of Quantum Advisors. Ajit, if we could have you. Shankar Sharma, who's joined us all the way from Dubai. I'm so glad you could make it, Shankar. Thank you so much. And Sunil Tirumalai, who is the GEM equity strategist at UBS India. Thank you so much for joining in. Now, let's take a seat. I'll read this here. Okay. Yeah. So I must say that we had a mini session over lunch, and I don't even know where the missiles will start firing from and where the drones will come from the other side. But I want to start by asking this panel a more fundamental question. See, I mean, our topic at hand is war, valuation, AI risk. Will global capital return to India? The point is global capital is important, but in the last 18 odd months, the market has also realized that it can hold on its own, and domestic capital has really come to the forefront. So let's just understand the panel's thoughts first on how desperately do we need the FPIs to come back. Ajit, let's open with you.
Thank you for having me here, and it's the graveyard shift when you have to speak after lunch, but we're not talking about India being a graveyard, believe me. I'm that half bear, I think. So global capital flows are essential if India indeed wants to get to an 8% long-term capital, a long-term rate of GDP growth rate. As an economist, I can tell you that's kind of a guarantee. I can also tell you this, that when we talk about the title, War, Valuation, and AI, the question I was asking myself was, we've already been, as a country, we're at war with the providers of capital. We're the only country in the OECD which taxes foreigners when they invest in India. So if I was to invest in America, I would pay no capital gains tax because my source of capital is from India. And that is the principle of taxation. It's taxed at the source of capital, not where the profit is made. And our government has been tone deaf. So before this war that we talk about with Iran, we've already been at war with even our domestic investors. Since COVID, we've had this surge of local money coming in, and we unleashed F&O and Jane Street on unsuspecting retail investors. You have an asset management industry which gets a SEBI license, all the mutual funds, which says AMC, Asset Management Company. Their business plans are AGC, Asset Gathering Companies. And they dump, in my view, risky products, which investors don't understand, and maybe put them in the wrong asset class. So we've been at war. Foreign capital is important. Domestic capital is important. NRI money is important. We get $115 billion of NRI remittances every year. And yet, when you ask many people, they say NRI, not required Indian. And right now, when the rupee is weak against the dollar, we've had a disastrous 2025. Since indices were compiled, this has been India's worst relative performance against emerging markets. The only significant currency to have lost against the US dollar in a year when the dollar lost 18-19% against strong currencies like the euro and the franc, etc., etc. It's been a disastrous year, and it's a wake-up call. It's a wake-up call for us to recognize capital, whether domestic and foreign or NRI, needs to be respected and treated well. Otherwise, we'll be stuck in this 6% GDP rate of growth. We can have all the webinars, all the seminars, everything you want, we'll be stuck there. So we're not at full potential.
He's already pulling the punches. I told you he's already added one more element. We were thinking AI, war, valuation. We've gone straight to tax, and I'm going to come back to that because that's always a huge topic here in India, right? But Shankar, now I know something you wrote on social media recently, and I think that was pretty interesting. And you kind of were taking aim at
I've written many things. Which one are you talking about?
I'm talking about the one where you said, this market is not falling because FPIs are selling. So your views on just, $20 billion last year, as of today, latest count, $7 billion this year.
First of all, I'm very concerned about that thing called a drone because I'm coming from a part of the world where we don't like these things flying around.
These are friendly ones.
Okay, it's a friendly one. All right, thank you. And pardon my attire because I was coming from Dubai and I didn't want to pack all my best suits lest the plane get hit and we all die. I didn't want to lose all my suits in my death. So I'm just very casually dressed. Pardon my dress code. But so the question, I suppose, is about the FII flows and whether we need them or not. Is that the question?
The question is first, before we get to the flows and whether they're coming back or not, their relevance, because structurally something has changed over the last 2 years with more DII ownership of the market.
No, nothing has changed. The market, I mean, look, when we started our careers, the market was, I used to always say, it's the 2 square mile stock market, which was Fort and Nariman Point, all right? In my view, it should have remained there because the stock market should always be between professionals and not for Aam Janta, because Aam Janta is never going to have the skills to be able to make money on a long-term basis.
You're questioning the intelligence of 1.3 billion, out of which as many percentage are now investing in the capital markets, the financialization. That I see Ramdevji sitting there. He's a very big proponent of it.
Today somebody showed me that, I mean, on a 30-year basis, gold has beaten the Nifty as far as whatever the data is. And I've told this to my sister, who has always been pestering me for 30 years, that Papu, you're some big shot in Bombay. You never told me a single stock. I said, Didi, you stay with gold, stay with real estate, stay with fixed deposits. And she has never opened a money control, and she has lived a very happy life. So I'm saying it's not meant for the Aam Janta. Now we got them in, and we got them in basically to give a mass exit to foreigners. And that's why you're seeing FIIs exit. It is not because they necessarily want to exit, but when they are being given massive amounts of capital for exit, they are taking the money and leaving. And of course, as we were discussing over lunch, we have made it very unattractive for FIIs to be in India. The taxation is absolutely ridiculous. This arrogance of policy that India doesn't need foreign capital. We are a capital short country, capital deficient country. Look at our current account. Look at our balance of payments, by the way, which in FY25 was a minus $5 billion. Our net FDI, net, okay, which means gross FDI minus what Indian companies, remit out and what foreigners, like the FDI investors sell in India and take out, is down to a ridiculously low number. We are short of foreign exchange. That is the fact. And in that period, and this year will also be probably a minus on the balance of payments. Looking at oil prices, we are already, total energy imports are maybe $170, $180 billion when oil was at 60. And LNG, LPG, all the other derivatives were much lower. Today, just within 15 days of the war, we are looking at a 25-30% higher bill for energy, which means easily $50 billion more. We have a problem. So we need to be very friendly towards foreigners. We need to be, I would go to the extent of saying, keep the taxation on domestic investors there, as was the case for a long time. Keep foreign capital tax-free. If you don't want to give up all of the gains from the capital gains. So tell me
this, and I really want to come to the left side of the panel, but I must ask you this. Why not let retail participate in the story here? Why not let retail become owners of the assets here? We've seen that in the US.
It's not mutually exclusive. You can have everybody participate, but remember, in every country, when
you're saying it's stupid money,
No, let me finish.
It's not for the
when I first went to Nepal to gamble in class 10 in the casino, okay, I was looking like a Nepali. They won't let me enter. Okay, then I asked him, why not Nepal? He said, no, sir, we never allow locals to gamble. Only foreigners should be allowed to gamble because they always lose money. It's good for the domestic economy. So I'm saying, please allow investors, but with some checks and balances. This FNO frenzy, as Ajit was saying, has gone to ridiculous extremes. We have lost huge amounts of capital all to the Jane Streets of the world. Brokers have become fabulously wealthy. But ultimately, country has not got any taxation out of it because FPIs don't pay tax on derivative profits. And what capital formation happens out of FNO trading? So in every strata, we have seen this thing percolate a bit too much. The aggressive marketing, the derivatives, all of those things are not making for a good long-term, good behavior for investors. It's all satta. And that is not going to work out well. It's not worked out well.
So very strong points made by both of you, and I'm going to come back to some of them. Ajit, just allow me opening thoughts here, and then we're coming right back. Okay, let me go to Sunil. Sunil, you've heard several reasons already. Tax, war, macros, oil. We've not even started talking about the AI disruption. Out of all of these, which ones do you think are more structural in nature? And could they really alter the way FPIs are looking at this market?
Thank you, Surabhi. Yes, so when I look at it from an FII's perspective, I mean, in my role, I'm based in Mumbai. I stay in Vadala. My office is in BKC, but I am an emerging market strategist. So India is just one out of 20 markets that I track and I take a view on. Keep in mind, ending today, if you take the last 5 years, FIIs have net sold out of India, right? And India has gone, Nifty has gone from about 15,000 level to where we are today. So it's true that over a long term, we've kind of demonstrated that the domestic capital, has been, so as, Shankar also mentioned earlier before the discussion, there's always a buyer and there's always a seller. It all depends on who is the more desperate party. Is the buyer more desperate or is the seller more desperate? And that's what, drives the direction of the market. Now, if you're a foreign investor having an option to invest in multiple markets, what is it that India is actually giving you today, right? Let me just focus on 4 large markets outside which really matter. US is 60% of global index, and within the emerging markets index, China, Taiwan, and Korea, the top 3 markets, are about 60% of the emerging markets index. You don't have tech in India at all in the large cap space, and if you see, that's been the primary driver of market returns and earnings growth, both in the US and in Asia. You could actually argue we are on the other side of the tech trade. The question on the structural reason why I think we need foreign capital, even in spite of all that I said over the last 5 years, in any economy, if you need investments, that's better funded through local savings. And our household savings have actually come down to a 30-year low, right? We can talk about a lot of money coming into the stock markets, but that's a very large growing part of a shrinking pool of savings, right? And we've done work in terms of what have been the interest rate and the real interest rate dynamics that have driven this. I mean, unfortunately, household money and retail money is also reasonably momentum driven. So they come in when the markets have done well, and when the markets start showing, some signs of volatility, they start having second thoughts and so on. The structural thing that I'm worried about.
That happened in the last 12 months. It's been reasonably stable.
So SIP is one, but the net mutual fund inflows have actually been falling. That's what I'm watching. So it's not as strong as it used to be. And for me, from a capital perspective, the structural issue is that savings have actually come off. So in our numbers, Indian households have started behaving like American households in terms of their consumption and savings behavior, even though our income levels are like 1/30th of what the American households are. That needs to be fixed.
Okay. Very quickly, before I come to Sachi, so we'll go back to tax and to AI and to obviously macros which are under challenge. I just quickly want to address the valuation question. In a bear market, the narrative will always be about how expensive Indian market valuations are and how, foreigners don't want to buy something at 23p, which is fair if they're getting something far more attractive, better growth, say, in South Korea. But the reverse is always argued as well, that the Indian market has always been expensive and people have always paid tax. There was capital gains tax after COVID. We had the mother of all bull runs after COVID. There was capital gains tax back in from 2005 to just up till the GFC era. We were paying some semblance of tax at that point in time. So the valuation argument, where does that stand, given the fact that there's more and more retail money coming to the market?
So valuations always need to be seen, a PE multiple needs to be seen in the context of what growth you're getting. A price to book multiple generally in context of what ROE you're getting, what ROICs you're getting, right? Pre-COVID, India's ROIC was not very different from MSCI EM, and we had a premium because there was a hope that there is, that there's going to be faster growth in this economy and so on. Right now, over the last 2 to 3 years, we've seen a very sharp increase in ROICs for the rest of emerging markets because the AI fundamentals have actually turned them around quite a lot. We are missing out on that, and our ROIC gap to the rest of EM is actually, we are below. So the perception is that the companies in India are good quality. At the index level, when I look at it on a weighted average basis, our ROIC is well below what emerging markets are, and we are still at a premium. So I actually don't think the premium that India had pre-COVID is even justifiable now because the quality that you're able to offer to a foreign investor is actually below what the other markets are giving you. We don't have, and unfortunately, this is an index where 30% of the index is banks. None of the other 4 markets that I mentioned they have more than 10 or 12% of banks, right? Because new age technologies and new age businesses have come up and they are the growing parts of the economy.
So is that really it? And Sachi, I'm going to come to you because, we've been hearing a lot of people make very strong points.
We need the bull.
So before I get to I think the only bull right now on the panel, almost the only bull, so keep the flag flying high. No, but is that the reality? The valuation issue, the tax issue, are these all issues right now because we don't have the growth? When the growth was coming, when consumption was the story back in 2005 to say 2008, people were very happy to buy India at always premium valuation. But is the problem really AI? There are other options in the world, and because of that, India is suddenly looking bad.
So let me sort of jump in there. I am a long-term India bull, don't get me wrong. I think every investor outside India, in the international world, must have a significant India allocation. So just because I said, I'm saying things that the government's done to push that money away in some sense. I think the story for India is extremely compelling. I think the valuation, if you look at the quantum mutual fund, which is what we run, in the quantum mutual fund, we've got this called the value fund. The value fund aims to make 400 basis points alpha over the MSCI India index. And we have a 20-year demonstrated track record on the domestic fund to actually get very close to that. And we have this predictability power to indicate to you what the returns are likely to be. SEBI doesn't let us publish that, but we do that internally. And then we show it to people after the match is done. So it's there on the slides for those who've actually been to our presentations. But to the valuation part, I think India has always been expensive. I used to manage a Vanguard International Value Fund for 4 years, which invested around the world. And I traveled around the world at that time. I don't do that anymore on behalf of Vanguard at least. But companies that you meet in India, managements you meet in India are fantastic. Sometimes they're a little too smart. That becomes a problem. But I think the ability to allocate capital, the ability to give minority investors their proportionate share of profits in a company, in India is far superior to many emerging markets. Okay. So I think valuations in India right now are not too expensive. And I think given India's potential economic growth, if the government was to focus on more sensible, market-friendly rules, and it's really taxation end of the day and education of domestic investors in some sense, India would be flying.
Okay.
So I think India's got all the ingredients of being a phenomenal market. And what's happened over the last year and a half or so shows that just giving speeches and having webinars and seminars is not going to get you to anywhere.
Ajit, slightly soften the blow there. But
I'm going to take over.
Yeah, please, because the missiles and the drones are coming from all directions.
It's fine, it's fine. I don't know if I'm the bull or the cow on the panel, but okay. I would say this for the benefit of all domestic investors because I believe that is majority of the audience looking at this. I'm a die-hard capitalist. We are operating in capitalistic society in capital markets. Whether we need capital, we want capital is totally irrelevant. Capital will come where the returns are. It will come when the returns are. There are two aspects to capital, to the returns. One is the absolute and the other is relative. One can argue that the absolute returns in India have declined from the last 5 years. They may decline over the next 5 years. We can argue about that. Global investors have choice not just to invest in India, but around the world, as my friend Sunil mentioned here. Now, allow me. Emerging markets, the rest of them, right? What are we even talking about? What are we even talking about? The whole Iran war tells me one thing, and that one thing is that China is uninvestable. They got Russia embroiled in a war that has entered the 4th year. They've got Venezuela, which is China's friend. They've neutralized Iran now. Charles, who was there in the panel earlier, they're going after Cuba next and Greenland next. China is isolated. It is and will continuously be pressured. It's uninvestable. 3% of global capital goes to China, 2% to India. What is the bear thesis in India? High valuation, low earnings growth, no AI story, and currency fluctuation. Put your taxes and everything there.
right? Just throw it in there. That is the bear thesis. What is the bear thesis in China? You will not be allowed to take your money out if you put in, or you will be, sanctioned if you put your money in. That's China for you. That's a $10 to $13 trillion market, right? My friend Sunil mentioned rest of the EM. Let's go there. What is Korea? $2.5 trillion market, 35% is Samsung. Sorry, 25% is Samsung and SK Hynix put together. Two companies, one theme. Let's go to Taiwan. $1 trillion market, maybe $1.5 trillion market, 35% one company, TSMC. Where else would you like to go? Let's go to Brazil.
But Sachi, the thing is those themes are working. So is this just global FOMO at its peak right now?
Let's go to Brazil. $1 trillion market, 25% of the market is Vale and Petrobras, okay? Let's go to South Africa. $1 trillion market, 25% of the market is Naspers and its parent Prosus. That's what we are comparing. We are a $4.5 trillion market, maybe $4 trillion market. The other are piddly $1 trillion markets, one-trick ponies, one theme works, and those themes will work. From time to time, those themes will work. One day, guess what? North Korea will also work. But if you want a broad-based economy where you have financials, my friend talked about other countries don't have financials. If you want a broad-based economy which has got financials, which has got defense, which has got consumption, consumer discretionary, healthcare, that country, my dear friends, is only India. And I want to say, thank you.
We know how the audience is feeling.
But I want to say two more things. We are so dismissive. Ajit, you were so dismissive about 6% GDP growth. Really? Really, Ajit? 6% GDP growth, you are saying dismissively?
Repeat that again, I'm so what?
You are so
You've been dismissive about 6% GDP growth.
Hold on. 6%, 7.5% GDP growth. Hold on. 6 to 7.5% real GDP growth, 10% nominal GDP growth. India is the only economy that is gonna double and double again. Find me an economy like that. And a final point. Allow me. You've all had a go. Final point. AI.
She has the audience with her.
AI, right? Biggest bear thesis on India. It does not have an AI story. It does not have and it is a victim of AI, right? If people are really concerned that AI is going to take jobs in India and the related credit card spending, housing, mortgage, consumption, take it all away. Take it all away. IT sector, 7% of GDP, and then you throw everything else at it, take it away. If AI is going to bruise India, AI is going to butcher US. India and US both at equal valuation today. One country is 65% of global allocation, the other country is 2% of global allocation. One country has just gone up 20%, the other country has just gone down 20% in US dollar terms. One country has got $400 billion legal market, software market, healthcare market, finance, banking, accounting, R&D, science, you name anything. Everything is at risk there. What is at risk here? And this morning, I think somebody was being very dismissive about the FTAs. FTAs is not a February 2026 story. FTA is not a FY27 story. But FTA is surely and certainly a story because those people need to move away from China. They need to manufacture stuff. They need to diversify, and they don't have the people to do so. Elon Musk robots are not coming to pour concrete in India anytime soon. We will be doing this, and that's a real story. Thank you.
Wow. Well said, Sachi. Now the bears have to think of a comeback. Making Shankar do that, I think we got it on camera. This visual will stay for the next many, many years. No, but just before we wind up, we have the last 1.5 minutes. I just want to deal with two issues, AI and its interlinkages with the macro questions that are coming up. I'm not going to the war and oil prices. That will resolve as and when it does. I mean, none of us have the answers. But Ajit and Shankar, maybe on AI, because that also was raised as a structural challenge for India. What if it triggers job losses, then the Indian consuming class and the great Indian middle class? Will it have several layers of a sort of a spillover effect?
So I think on the AI, let me just go to one comment you made. I think that, I'm not being dismissal of India. That's a very inaccurate statement. I wrote an article in 1990 in the Wall Street Journal about India reforming and becoming the best economy in the world. So no question of dismissal. The dismissal is from the pension funds who don't want to touch a country that doesn't respect their capital. You have to make that distinction. So it's not that I'm dismissed of that. Moving to the AI portion, I think on the AI side, it's all unknown. I think it's everyone who we speak to, again, we're not engineers, we're not scientists, people we speak to recognize, and every company we talk to, most of them will tell you what they can do to improve their productivity and how they may be able to use AI agents to get their sales moving. But they can't quite contemplate how it's going to impact them in terms of employment, profitability, society, etc. I think we're very early in that cycle. There are a lot of articles, a lot of theses on what would happen, but when we talk to different people around the world, you know, there's still it's still not clear. But if AI was to take the doomsday scenario that is going to knock off employment, we're in trouble. We already were in trouble from 2005. We were supposed to create about 10 million jobs a year. We haven't done that. We're nowhere close to that. So if AI comes in and does it, we'll have a massive social disruption in India.
So we need to really watch for the jobs
But do recognize, I still love India. Pensions have to love India, and it's taxation that will make them love India.
So
let's get that also
so
clear out of the
that's
way.
on the AI piece. I'll come back to Shankar for the last word, but Sunil, very quickly, just on the here and now on oil and what the reality, if this continues, you are anyway underweight on the market here, though you like some sectors like financials you mentioned. If oil continues to be where it is for several weeks, have you started building some models into what it means, time correction, price correction?
So in a scenario of extended conflict, flows will go out of EM. Forget about India, right? I mean, most emerging market, Asia is 85% of MSCI EM index, and Asia as a whole is a consumer of oil, not a net producer of oil. And, you know, India has a problem, Korea and Taiwan have a problem. China has less of a problem because they managed to build some reserves, but after 2 months, they'll be in a problem. So we are basically talking about flows going towards safer assets, and EMs will get sold. So, I mean, I hope that situation does not arise. It's not good for our markets.
Shankar, are you investing more in the market now, Monday ko, after listening to her?
Yeah, I'm tempted to. No, but she was very good. Congratulations. That was a very compelling argument. And of course, what she said is very true. India has always had a great diversity of companies and industries. It's just that there are a lot of things that, I mean, and my view is, of course, we did very well for 4 years. So we are going to have, or for 4.5 years, we are going to have very poor another 4 years, of which I think 1.5, 2 years are behind us. There are 2 more years ahead of us before we normalize our overall long-term returns to a more average number of 10% or so, which is where the nominal GDP growth is. So I think there is still a little bit of pain ahead of us. I think oil prices are a new googly in already a lot of googlies that existed in the last 2 years. And I think my view is that it's a structural bull market in oil. It's not cyclical because oil has been cheap too long. Just as gold was cheap too long. We saw how gold did. Now oil is going to be the new gold. And I think you could be looking at, I don't know, $150, $200, because my take from where I sit in the Middle East is that it's not an easy war to just simply somebody does a tweet and calls it off. I think it's gone too far now. So yeah, that's my view, of course. But
the lady has the last word. Sachi, final thoughts.
Look, I'm a long-term investor. I also believe that my job as an investor is not to predict the future, but it's just to manage the risk. Where will oil go in 2 months? Where will market go in 2 years? I have no idea. All that I know is if I have to pick a geography, a economy to invest for the long term, it is definitely India, because there is no other large economy that is going to double, and it's going to double again in the next 15 years. I will rest.
If I may just add one point on the AI debate. We are worried on the markets today because of the construct of the markets, the kind of companies in the markets and their impact. But if I take a longer term view, I think AI can be transformational for India in a very positive way. Right? And I go back to the mobility era when mobile devices, right, i.e. cordless and wire-free wireless devices came in. The penetration of landline phones in the US was 50%, and in India was less than 1%. And we got mobile phones here probably 5 or 6 years after the US, so pretty much at the same time. In India, they serve the need of not just commerce, but also just basic connectivity, right? And so given where we are in terms of healthcare, in terms of education, what we can get is a lot more than what a developed market can get. For that, I'm really excited, but the market construct today in terms of the companies in the index, you should be a bit worried.
Okay. All right. I think this panel started as being largely bearish, but I think tilting a little more on the bullish side by the time we wrap up this debate. Extremely spirited arguments from both sides, and thank you very much for all of you for joining in today. Thank you.
All right, what a passionate, riveting conversation that we have had now. And despite the FI outflows, that definitely stands out that India has stood out to be a compelling case in terms of investment. But yes, thank you to all our speakers, and thank you, Surbhi, for driving this conversation. And let's move on to our next set of conversation, where over the past few weeks, we have asked the followers on IDFC FIRST Bank and even Moneycontrol social media about investing, from starting out to building out a diversified portfolio, protecting wealth during volatility, and what's concerning them when it comes to building wealth. And the response has been quite overwhelming. So we have curated a very special session with the industry veterans to continue to make the most of the sound investments, irrespective of the most volatile times that we are living in. To lead this conversation, please once again welcome N. Mahalakshmi to moderate the session. And now please give a huge round of applause to our distinguished speaker, welcoming Ramdev Agarwal, the chairman and co-founder of Motilal Oswal Financial Services, and Sanjoy Bhattacharya, founder of Fortuna Capital. Please welcome them with a huge round of applause.
It's very hard to sort of beat that spirited discussion we had, but we have two stars. I have two stars to my rescue, two to tango. Best of friends. One thinks in Hindi, one thinks in English, according to them. And you have said that he thinks in Hindi, you think in English. The other way around? Whatever, there is diversity here too. So this is panel topic that both Ramdev and Sanjay are extremely passionate about. Both of them have followed value investing for the longest time. They're value gurus as for the last 25 years or more that they've been investing. And most of what I have learned is also from these people. The topic for this panel is buy and hold dead? And this is an ideology that a lot of investors around the world have seen as a go-to strategy to create wealth. It is something that is deeply followed in India. The idea that you buy great businesses at great valuations, you and hold them for a long period, you do end up making humongous amount of wealth. In the past few years, though, we can think of several examples and all these darling companies which have sort of give us some sense to question this whole idea. For example, last 5 years, IDFC Bank, which has been a greatest compounder of all times in India, has not delivered anything. Darling in the stock markets, DMart, is a stock that is not delivered as one would have thought, because people thought that retail is a very long-term story and it was deservedly trading at high valuations. There are several. Asian Paints, one of the longest compounders, most admired companies in India, has got completely challenged. So in this age of AI disruption, hyper competition, and elevated valuations, how valid is this whole idea that you can buy and hold for a long time and hope to get rich? Ramdevji.
Good afternoon, friends. I think the only way serious money is made in the stock market is buy and hold. Look at the top 10 guys in the world. Say today Elon Musk. Is he trading or is he buying, is he holding his own stock? Because maximum money is made by the promoters. Why? Because they are forced to stay with his company. And they hold for 25, 30, 40 years. Of course, there is survivorship bias. But the only way to make serious money beating the index is to buy and hold. The issue is what you hold. Do you understand the underlying value why you are buying? That is the main problem. Problem is that most of the guys, they don't know what they are buying. Everybody knows the price. Nobody knows value. Nobody means literally nobody knows value. And then you expect him to buy and hold. So what he's holding, he doesn't know. So of course he cannot sustain with that. And that's why the promoters know what they're holding. And they make a lot of money. So if outside the promoter campus, if you are an investor who believes in knowing the value, long-term value of the companies, and you buy at reasonable price and you hold on to it, you'll make fabulous amount of money. Particularly in a country like India, I don't have exposure to global markets, but what I have seen in the last 45 years, the only serious trade to make money, serious money, is to have a large portion of your portfolio, which is buy and hold if you're lucky enough.
Sanjay?
I think he's right, and he's right, and he missed a trick here. He didn't mention one of the reasons why buy and hold has worked in the past. See, if you trade a lot, you pay a lot more in taxes, assuming you pay taxes. That's not a given in India, so it wouldn't resonate with many. But if you traded frequently, as opposed to a person who bought and held something for 10 years, 15 years, tax would be a huge part of your end returns. So he's got that absolutely right, and he didn't even use, I think, a point that works hugely in his favor. But I think the 3 or 4 things which stand out why today buy and hold should be seen in a different context than, let's say, I would say as recently as 25 years ago. One, I think there's this famous Buffett phrase, and you know my love for the guy. The period of competitive advantage has shortened dramatically all around the world. People do not have the same level of enduring competitive advantage that they had. So Motorola, best known example, Phil Fisher bought Motorola, held it for 60 years or 65 years, right? And then look at what's happened to Motorola. So one is the competitive advantage, the moat
Can you put the mic closer?
Yeah, sorry. So the period of competitive advantage is shortening. Second, India is different in that it's a much more open market now. It's no longer a high tariff closed market that it used to be 30, 40 years ago. So the extent of not only domestic competition but international competition has gone up a lot. Third, there are disruptive technologies. You know, things come in and they slowly sort of eat away at some businesses that were fabulous. And again, to go back to the great man. I mean, if he had sold Coke in 1998, he'd have been better off than holding it till today. And that's a difficult one because it's a change in taste, in beliefs about health, about habits. Or you look at the Washington Post, destroyed by the internet. I think even the print media in India is destroyed to a significant extent. The rate of destruction is slower. But so basically different types of technologies can come in and cause you a lot of pain. So if you don't sell through, and you're not even sure whether the damage is permanent or you're going to recover from that damage. In many cases, the damage is permanent. So if the damage is permanent, there's no reason to hold on to it. The last one, why I think, you know, buy and hold is much less valid now. I think there's a massive increase in the misalignment of management in how they run companies today than the way they used to do it 25 years ago. No one had stock options in India. So stock options has a wonderful one face to it, and the other face is pretty grim and black and gray. And that has affected how businesses are actually run. And therefore, for us as investors, the problems that we have, because their thought process is not long-term. The guy managing the company on your behalf has begun to stop thinking long-term. He thinks short-term.
Right.
So you've got a serious problem here. And at the end of the day, he calls the shots, you don't. And despite all this wonderful talk about Indian governance being terrific and so on, I think I've spent a good many years looking at Indian managements and in greater depth than I would venture to say anyone in this room. And my evidence is that it's improved a lot, but there are no paragons of virtue in this country. None.
Ramdeji, you talked about the fact that, you need to know what you own, which is very true, except that most of these things become clear only in hindsight. For example, 5 years ago, I don't know if anybody would have predicted that HDFC would not perform for 5 years. DMart, anybody could have, seen that this level of disruption and quick commerce will take off in such a big way. So when businesses are getting disrupted and like he said, competitive advantage period is going down, but there is competition coming from the periphery and it takes center stage. What is your checklist? How do you assess that whether you should, hold? How do you think about the idea of whether you should exit or think like a promoter or stay invested in a stock?
At times we confuse the failure of a company from the price point of view. So there are two machines, value machine and price machine. We judge only by the price machine, and price can be extremely irrational on the upside as well as downside. And the moment it goes on downside, we start discarding the stocks. That as if the management has failed, company has failed. Asian Paint has not failed. HDFC Bank has not failed. Stock has failed for last 2-3 years. So we have to differentiate that particular part of it. That has the bank stopped performing? Is the future of the bank is in jeopardy? Or is just that there was maybe excess valuation or something, transition must be there, and hence there is a price correction. So price correction should not be taken as failure of the company or industry or anything like that. But there are disruptions. Of course, like Indian IT is clearly headwinded right now. So, I would say my understanding is also limited, and in any case, there's a lot of confusion. So I would say stay away if you are not there. And or you can reduce, maybe you can book your profits and go along somewhere else. But to say that a company is, just because it is underperforming the market, the story is, in fact, in buy and hold, most important thing is to bring conviction when things are not good. Managements stay with the company in bad time also. And that's why buy and hold is very tough to practice. Everybody wants good time to be with the stock and bad time with it should be with somebody else. It doesn't work that way.
But isn't that the charm of the stock markets, that you can exit bad businesses? For example, the Asian Paints management or promoters don't have a choice but to stay invested in a business if the business is getting disrupted. As a stock market investor, you can take a call that you don't want to be invested.
True, Mahalakshmi. I think that's a kind way to look at it. Because if they think that the end is nigh, they'll find someone else. There are enough guys abroad who want to buy that business and be present in India. Enough large international paint companies. We've seen one on the block already. Axo. So that's a signal. I don't think promoters are, my heart bleeds for them. Oh gosh, life is so tough. We should go and hold a handkerchief. Not at all. They're just like anybody else.
No, in today's market, I totally agree. But largely, but for this cycle, most of the promoters have held on to their companies irrespective of valuations or where the stock markets went. But my question is, as an investor in stock markets, should you not be exercising the option to exit a stock if you think the business is disrupted, the valuation is high? What is the incentive? Why should you be thinking long-term at all?
See, we have limited time. Otherwise, I can keep telling you the stories, what we have gone through as a buy and hold. I'll tell you without naming a company, I bought it at 70% discount or underlying value in 2003, thinking that it will double very quickly. It went with 90% discount, 10 years. Okay? And then after that, the stock is up 60 times. Because the value was going up, markets were refusing to accept the price. The stock never became popular. So that's what happens. But in HDFC Bank, that doesn't happen. HDFC Bank, the day you bought, just started going up. So in investing also, you have different kind of experiences. You know, one stock I bought very cheap. It went up 10 times. And then after that, 5 years, it didn't work. But the company was growing at 25%. Even my own board directors, they were saying, right, Ramdev, why don't you sell? I said, don't even talk about it. And today's stock is double, and I'm telling you, in next 3 years, again it will double. And then again it will double. So you have to bring that conviction of understanding value.
Right.
Yeah.
So you are giving me examples of, stocks that you bought which were underpriced. According to you, it was 70% cheaper, and therefore you could buy and make whole lot of money. But today, for a lot of new age companies which are not making profits, or elevated valuations, 40, 50 times, where companies are growing fast, we see that there is a secular growth story. People say that high valuations are fine because they are going to, grow structurally for a long time. But a simple math, a PE of 40 times, 10 years it has to grow 20% year after year after year. If after 10 years it is supposed to converge at a PE of 20, you have to grow at 20% year after year. Do we really have those kind of structural stories, Sanjay? Can you really defend?
That's called a half volley on leg stump. You short these companies.
No, but that's a predominant part of our market.
I mean, it's insane. Just because a guy wearing a Ferragamo tie and a fancy suit sells you some crappy story, and it's called new age.
No, it's not just new age. I mean, that's just one thing I pointed out. But a whole bunch of companies, EMS companies, a lot of manufacturing companies.
So, Mahalakshmi, the issue is here. It varies from company to company. It varies from company to company. I don't think it's possible to generalize. I think, and the why we have this difference between whether buy and hold is dead and it's not. Buy and hold works really well for guys who are exceptionally talented investors. So if you buy really high quality businesses and you have a knack for doing it, as he has done again and again, I've known him for 42 years now. He has that ability. But how many other people have that ability? I mean, I don't have it. That's why I don't do it.
So do you buy and hold?
What
is your holding period?
Whenever I buy something in common with him, I hold it.
Okay.
I bought Hero Honda.
So all Ramdev stocks we should hold for a long time.
100 baggers he has got. He's the guy with highest number of 100 baggers.
So what is your average holding period, Sanjay?
I'd say it's about 3 years.
3 years.
Though I've held Hero Honda with him.
By the way, for the benefit of this audience, although we know that, Buffett saying that you should hold for his favorite holding period is forever, it is nothing but true, because the study has shown that his holding period of an average stock is only 2.5 years. Let me repeat that, only 2.5 years.
That's 2.5 is like very low. I typically buy for 20-25 years. So, see, buy and hold is one thing, but buy and hold forever is yet another. I'm not in that camp, a buy and hold forever. No company lives forever, So, but see, companies are also like human beings. They have a productive period, there is a growth, then finally that concept itself goes off, like Kodak moment comes for every company. So you have to, but then you have to live through the prosperity of a company. If a company has to go from 100 million to 100 billion, if you don't hold it, how will you make money? I mean, your same Infosys or HDFC or, unless you hold them, you cannot really reap that, you have the purchase price advantage in a compounded growth scenario. If you have bought it right at the beginning, actually when the markets like this, they correct, you just don't feel it because you bought it so cheap.
Right. No, but this is not a market that is so cheap. So we have less time. So
can I just very quickly say one thing? Because this is the last thing I'm going to say on this. You've heard of John Maynard Keynes, right?
Yeah.
He said, when the facts change, I reserve the right to change my mind.
Yeah.
I think that settles it.
True. So one last question. The markets are what they are, the valuations are what they are. Today, just mapping the market, where do you think, what are the pockets where you think today if people buy, let's say in the next 2 weeks, we get some opportunity, market sells off some more. What are those pockets which you think will truly create wealth if you take a really long-term view? Can you buy some stocks now with a 10-year view where we have structural stories? Do you find anything interesting?
Yeah, so I'll tell you, see, markets are growing. Market in last 45 years done about 13-14% compounded, excluding dividend. Including dividend, it will be closer to 14-15%. So I don't see that trajectory changing. If anything, it might be a little better in local currency. So if you buy at 90% of the, whatever is the, say 25, 26, 25,000 is the base, this thing. If you buy 10% lower, your return in next 5 years goes up by 2.5% per year. If you buy 20% lower, your return goes up by 4.5-5% per annum. So right now market is say 90% to the whatever 25,000 now. If it goes down by another 10%, you have a very good chance of making about 17 to 18% at index level for next 5 years. Absolutely non-stops. So that's the kind of opportunity this market is throwing. As the market is going down, your prospective return is going to go up. If by chance market goes half or 1/3, say half is too bad, but 1/3 what happened in COVID, the 12,000 came to 8,000. What happened? In next 5 years, you made compounding of 21-22% on index. And when index goes up by 21 to 22%, the high beta stocks or your portfolios, well-selected portfolio like that of Bhattacharya, that does 30-35%. That's the opportunity you are sitting on right now.
Right. One question on IT. First of all, I think you're going to
this?
Yes.
God is being really kind to us right now.
Right now? Define right now.
If you can't buy
Last
now,
2 weeks, they've not been kind.
If you can't buy now, don't bother about investing. Just get the hell out of the stock market.
Okay.
This is the opportunity of a lifetime. Money is made at turning points. If you had bought in 2008, in the last quarter of the year, you'd still be clapping your hands. If you had bought in 2020, you missed the beginning. You bought after 6 months, you'd still be clapping your hands. If you had bought in late 2000, when the bust took place, you would have seemed like Einstein's cousin, first cousin. So it's about recognizing that markets are mean reverting. And if you don't respect that idea, it's very tough to make money. That's when all the macro difficulty comes. You don't need to know all this macro wisdom to make money.
Right.
It's about character, fear, greed. And the funny thing is, you're always on the wrong end of the greed, on the spectrum.
Ramdevji, is this that kind of a compelling market?
Yeah, so I have seen four declines. 92, the moment I started my career, Harsha Mehta bull run and then collapse. Y2K, then GFC in 2008, and then COVID recently. This is the 5th one. We are in the midst of it. Nobody knows the bottom.
Nobody knows the bottom.
Nobody knows the bottom.
But this valuation is still attractive to buy. Is that what you're saying?
Yeah, I'm saying that. If you're going away from that 25,000 to 0.9, 0.8, 0.7, lower the better. The corrected market for a compounded market is the best thing you can ever get. Now, how much correction? Who knows?
Right.
You know.
But through the correction, stay invested and buy more. Is that what you're saying?
I can see value emerging. I can see value emerging across in large cap, mid caps, small caps.
One last question. Deeper? Anything that you would not touch? For example, IT. There is a lot of debate around IT in terms of long-term prospects. Sanjay, I know you have invested. You've also invested.
No, he's the guy.
So, yeah.
Is
it a long-term compounder from now? Is it a tactical bet? How do you look at it?
I think, there's too much hype around AI right now. Yes, it's going to have a profound impact on our lives. This is one of the great things in terms of technological innovation. Post the internet, I think this is probably, a great thing. It's like the steam engine. It'll have huge impact. But will it happen in the next 3 months? In the next 6 months? See, the people who are going to use AI, the diffusion of AI by companies, by users is going to be slow. You need to build apps. When did the internet take off? The internet, Tim Berners-Lee discovered it in the early 80s, mid 80s. But when did when did the internet take off? When you had applications.
Yeah.
The same with AI. When you can use AI productively for your benefit on a large scale, then AI will have significant impact. Now, the Indian IT services companies, most of them are run by pretty smart people. And so they know that their future has been dramatically changed. So they need to do something about it, and they need to figure out how they get on the right side of AI. And so you're going to see a bunch of different strategies in place. Some will align with global majors, some will, change the way that they sell products to or sell their services to enterprises. Some will themselves think about data centers and participating through that route. But Indian IT services, yes, the growth will slow for a short period at least, in the period of, transition. But it's far from dead. Indian IT services will continue to be a business, and it's all a function of what your return expectations are and the kind of volatility, for want of a better word, that you want to take. So I think it will be a low volatility, moderate return business if you have a 5-year perspective from here.
Fair enough. Your last word on all these new age companies, because a bunch of them have got listed, the valuations, there are eternal debates on their valuations, and a whole bunch of them are also coming to markets this year. What is your take? How do we approach these companies?
Yeah, so to some extent it's speculative, but there is a consumer revolution actually. Okay, it has happened in India. So this, you are talking about quick commerce companies, isn't it?
Yeah.
So quick commerce has been a revolution kind of thing, and it has changed the complete behavior of the households. So I am betting on the permanent change of the consumer behavior. Like you don't buy now your theater tickets. Even if the theater is empty, you will buy and pay 10% service fee. That's the kind of change I'm seeing for grocery purchases. If that were to happen, you're talking about 50, 60 lakh crores or maybe 100 lakh crore industry in making. And everybody cannot do it. So the scale is on their side. Profits are not there right now, for sure. That's what makes our valuation exercise a little more challenging. But 1-time sales, 1.5-time sales, you have bought a small ticket onto the bus. If things work out our way, I think we'll make a lot of money. Otherwise, it's a very fast growing, 70, 80, probably 100% growth. And in compounding, I mean, you can't do anything for 100% growth kind of thing. But there's a very large growth opportunity, and probably 1 or 2 companies will emerge which will be worth maybe 25, 30, 40 lakh crores worth. But which one of that is there? That you have to really see. So I have bought like all 3 of them. So let's see which one works. That's happened with the HDFC Bank also.
Correct.
So whosoever got the license, only HDFC made it. Rest all kind of fell by.
So, last question, will a spray and pray kind of approach to all these new age listings, will it work in the long term if we were to sort of, equally distribute your, investable surplus across a bunch of new age companies and say, let's hold on and just keep adding to them as they start to perform? Will it be a good strategy to take today?
No, I would not do that.
You won't do that?
My basic fundamental is that first you understand the underlying value or potential value. If you don't understand that,
stay away.
Stay away. In fact, you must stay away in these new age companies because they're very expensive. Most of them, if at all they make money, they are at 80, 100, 150 P multiples. So if you lose 90%.
Right.
So I don't want, loss of capital is not my way of doing.
Sure. Your last word, Sanjay.
I think new age companies are some kind of a gigantic joke being played on investors. It's a gigantic joke being played on investors who've become bored. There's absolutely no reason. I mean, they talk about, I've heard so many of these guys. They're all from some fancy business school. They're wonderfully attired. They talk about unit economics. The unit economics doesn't make PAT. And not for 1 year.
Eventually they will. That is. Eventually they will.
Mahalakshmi, you are such a kind soul. We have given these
No, that
companies
I am,
10
but then,
years,
I mean,
15
see, these
years.
arguments were made even for Amazon. Of course, that Amazon had a cash
They are
cow,
not Jeff
even at the-
Bezos. Please, Mahalakshmi.
No, I'm saying every technology company starts off, any new age company starts off like that.
But these are sucker punches.
You're being
Does any
harsh.
of them have the intellect of Jeff Bezos? Everyone wants to be a Buffett. This country is about wannabes. Everyone wants to be a Buffett. Everyone wants to be a Ramdev Agarwal. Do you have his intellect? Do you have
There's
his
nothing
network?
wrong. People are aspirational. I mean, don't fault them for that.
Yeah, but
come
aspiration
on.
isn't enough to make money. You need a little bit more than aspiration to make money, right? You need profits, you need a reasonable valuation, and you need a bunch of guys who are honest and don't talk rubbish running your company.
We will have to end this conversation here. This is a very long conversation, which I think we should have offline. This is all the time we have on this panel. But gentlemen, thank you so much. Hope spray and pray is not a strategy. Know what you are buying if you were to buy and buy for the long term. That's the big takeaway. Thank you so much, Ramdev and Sanjay, for joining me this.
Exactly, rightly put by ML, you know, that it's a clear message that it's a buy, because just when Nifty has been down by about 3,000 points from its record high, this decline is definitely bringing out an opportunity for investors. But yes, thank you, gentlemen, for that sharp and thoughtful discussion, and thank you, ML, for driving this conversation. But before we move on to our next set of conversation, remember that I mentioned in the morning also that you have a small tag right on your table, so that's a planting for future tag. So please take it back home and plant it for tomorrow morning. And remember to share and click a picture, tag Moneycontrol and IDFC FIRST Bank, and we'll be happy to post in our handles. So let's spread the message of choosing green and choosing wisely. But yes, let's move on to our next set of discussion. For years, the default allocation for Indian investors has been India first, India mostly, and often India only. And that has also worked well. But that mindset has been evolving. The access to global markets has been easier than ever, and investors are increasingly asking a bigger question. That is, where the world's biggest opportunities lie, and how should Indian capital participate in them. So to explore this conversation, what to buy, where to play, and how to win in global markets, let's bring in back on stage Surbhi Upadhyay, who will be leading this conversation. And please welcome our distinguished panelist, Saurabh Mukherjee, who's the founder and CIO of Marcellus Investment Managers. Joining him is Ketul Sakpara, founder, Bayfort, and Abhishek Tiwari, who's the CEO of PGIM India Mutual Fund. Please welcome them with a huge round of applause.
Thank you, Lavisha, so much for that. You know, when sessions are going fabulously well, when conversations continue off the podium as well, they continue on the stairs, around the aisles and around the tables. Gentlemen, please join us over here. Come, hi. Please. I was just discussing with Sanjoy that maybe the lesson from what he said for new age is that they should definitely ditch the Ferragamo. Maybe try Bandgala and Khadi.
I'm wearing Fab India. I'm wearing Fab
You're
India.
safe. You're safe.
Yeah.
And on a lighter note, I was thinking of my previous panel and this current panel. And if I could sum it up, in the ethos in terms of a Bollywood movie title, the previous one was Aa Ab Laut Chale for the FPIs. This panel is Zindagi Na Milegi Dobara. So let's go outside, get on that road trip, right? Go where the fun is. More importantly, let's go where the money is. So that's the topic at hand. Seizing the world's best growth opportunities, what to buy, where to play, and how to win. So one thought from all you gentlemen on where to put the money, and then we're done. No. On a lighter note.
So that nobody has a go at me after this, I'll hedge my bets. 4 years ago, I decided I'll have half my money here and half my money bahar. My thinking was very simple. My bachchas wanted to study outside. Plus, I realized my phone is made in Bangalore. It's an iPhone made in Bangalore. But I looked at the phone and I realized 90% of it is imported. I looked at the electronic equipment that our hosts shared with me whenever I speak on media, and I realized that's imported. I looked at the flights that I was taking in India, and I realized the planes were imported. The fuel inside the planes was imported. I realized even the in-flight magazines in our country were imported. I also realized that the movies I was watching on OTT was on an imported OTT channel. And I saw my kids were listening to songs on Spotify. And the most common source of entertainment in India had become YouTube. So I said, I'll have half my money here. I'm dramatically overweight India. I think India is 3% of global market cap. So half my wealth, 50% is here. So I'm big time overweight India. But I said, I'll put half my money in Europe and America, even though they account for 75%. So in that regard, I'm underweight. I'm underweight the Western Hemisphere. And I feel fairly comfortable about that. Half here, half there. So as my wife, every year my wife asks me how much money have we made. So the way I put it is, kabhi yahan pe pitai, wahan pe kamai, kabhi wahan pe pitai, yahan pe kamai.
But you said you're underweight the Western Hemisphere.
So it's 75% of global market cap. It's only half my portfolio.
Ah.
Right?
Okay.
So it's underweight. No. But I didn't think of it like that. I just said, adha yahan pe, half here, half there. Because genuinely, I'm not making it up. Barring COVID and Lehman Brothers, we haven't seen both ends of the world getting plastered at the same time. So usually we get hammered and they're all right, or they get hammered and we are all right. And the good news is over 10, 20 and 30 years, and it's actually not just good news, I think it's remarkable news. Over 10, 20 and 30 years, Surabhi, the only two big markets which give you double-digit dollar returns are United States and India. They're a little ahead of us at the moment, but double-digit dollar return, only two big countries, India and America, pull it off. The beautiful thing, and long live Harry Markowitz for highlighting this, because their correlation with us is pretty low. I stress again, barring Lehman and COVID, the two markets haven't fallen together. So if you go 50-50, you stabilize your returns, you sleep better at night, but you don't compromise your compounding. Wealth creation chalu rehta hai. Your wealth continues compounding, but your raat ki neend becomes better. In simple English, nobody's forcing you to live through the boom-bust cycle of every country. Not everybody has the strength of character that the legends who were on stage before me. Not everybody has the strength of character of Sanjoy and Ramdeo-ji. They are professional investors, they're legends. The typical investor in our country, right? Or indeed the typical investor even in America, right? Is a regular dude or regular guy trying to do his job, run his life. You can't tell him, you buy and hold through 60% drawdowns like 2008. I mean, you can tell him, but his nerve will shatter when he lives through a 60% drawdown like 2008. So a better way to do the job I felt was help people diversify, help Indians diversify, and especially since the government through GIFT City and through the RBI is making it easier for us to go abroad, making it low cost, and actually, Ajit Diyalji, to your point, and it's a very interesting point I would just throw at you, it's become actually more tax efficient for Indians to invest abroad. It's become more tax efficient for Indians to invest abroad than to invest in their own country.
So, I want to really take up that point and kind of ties in with some of the thoughts we've heard earlier as well. In this country, at least over the last couple of years, maybe the last one decade, domestic investors have been largely shepherded towards domestic equity, right? The taxation is better than obviously fixed income, and then it became far better than fixed income after the tax changes a couple of years back. Most Indian mutual funds are shut. They're not directly taking money for overseas investing. However, now this gift route is coming up, and I think a lot of Indian fund houses are beginning to set up structures. Because retail, I don't think is as dumb as, we might want to believe or some might believe. And the market is a great teacher. Now, over the last 15 months, as returns have not been made, people are watching. It might be FOMO, fingers might be burned initially, but people know they need to diversify. They need gold, they need silver, and they definitely need global markets. So, Abhishek, let me ask you first, as asset managers, how are we looking at the options? Because the options have been very limited for at least local retail. They've been there for the family offices, they've been there for the well-heeled. So, what are we working with?
Okay, so first of all, thank you for having me here, Surbi. And I'll possibly pick up from, from what Saurabh was saying and try to intertwine what you are asking. So first of all, I mean, the way I look at it, and let me qualify what I'm saying, I don't manage money, but I have the privilege of speaking to a lot of people who keep managing money on a very daily basis. The way I process equity is the best part of equity returns are made when you respond to a challenge, which means innovation, right? Now for context, when you look at India, the reason the GDP has been so much in a very tight band and it's very linear is because innovation is relatively lesser, right? So you will see low volatility, more predictable returns, much more linear GDP patterns. Whereas when you look at some of these global markets, you really have innovation completely inbuilt into various parts. So for example, like Saurabh said, US and India are the only two markets, right? Think about how US has literally rallied. It's all because of innovation, R&D, and so on and so forth. Having said this, it's also important to realize that if you were to just dial back a few weeks to maybe a couple of months back, most of the markets who generated returns, ballpark, and I'm just taking the liberty of painting everything with the same brush, but most of the global markets, ex of US, actually expanded on valuation. Ballpark, 50 to 70% is valuation gain, 30 to 40% or 50% in certain cases is earnings gain. The only adjacent market to that has been India, which also exactly delivered in line with the earnings, no valuation gain, right? So if you really put a gun to my head right now, I would say being an Indian and most of my money and savings completely tied into Indian equities, I think I'm very, very excited with what's coming our way. But having said that, what we miss is innovation. And to capture that innovation, we'll have to go out. US is the hotbed of innovation, but I think there are other markets. Like, for example, Taiwan. You don't have a parallel of that in semiconductors. If you think about health tech, I think there's enough health tech happening otherwise in Europe, in China for that matter, and so on and so forth.
Well, the biggest debate will remain, and with that, of course, I want Saurabh's thoughts on this as well, but opening this to Ketul, and Ketul is someone who's managing a lot of equity money out of the US, and this is primarily money that's going into US equities. We go back to the big billion or trillion dollar question, that there are certain fad trades, there are certain trends, and then there are certain structural stories. Up until now, till the AI question came upon us, India was always seen as the solid structural story. And now there's AI. So do Indian investors really have a very compelling and very real reason should they be looking overseas?
I think what Saurabh said is absolutely right, that you need to diversify. Harry Markowitz, low correlation, all that is perfect, and that needs to be done. The other thing why, and I just want to add to it, is that the reason that we also ask investors to invest outside of India, a certain portion, you can be 50, 60% home biased and then add 30, 35% outside of India. One of the big reasons is India is an emerging market, and the sectors available in India are mostly emerging market sectors. You'll have BFSI, automobiles, infrastructure, steel, cement, oil and gas, which is good. You can make money over there also. But as Indians, we have lost out on wealth generation from sectors such as the internet in the 90s and 2000s, followed by the mobile telephony in the late 2005-07 time frame, followed by the biotech revolution, the SaaS revolution, and now the AI revolution. If we don't invest outside India, we'll be the biggest consumers of those and probably the largest revenue generators for those companies, but we'll never make any money out of them because they are not, unfortunately, they are not listed in India. They are not listed in most of the places in the world. They are listed primarily in the US only, and a lot of them are based out of the Silicon Valley. And so that is the only way to generate wealth in those sectors. So I think when you invest outside India, it not only provides you geographical diversification, currency hedge, but it also provides you a sectoral diversification. And that's what we focus on. We don't want to invest in a bank over there because you have better banks in India. Why do you go to outside India for investing in banks? So we want to focus on sectors that are not available in India.
So on that piece, Saurabh, when I want to ask you what made you go with the 50-50 split? Till a couple of years back, pre-COVID, actually more than a decade back, the whole narrative around India was mass consumption. No one can consume like us. That's where the growth numbers were coming from. That's why you would pay 70p for a HUL, right? And foreigners were paying, those kind of valuations. The entire narrative now is technology and innovation. Is this a permanent sort of pivot that's happened for good? And will that then require a totally new way of looking at our investments and dividing them in the different buckets, India and overseas?
So Surbhi's asking a pointed question. Let me try to give as clear answer. There's a book being published. I'm publishing a book on 23rd of this month. It's called Breakpoint. I'm trying to address exactly this point Surbhi's making. She's asking, what changed? Why did people like me decide that we will go to America, get a license, put half our money there? Why did we do that? So what we are saying in Breakpoint, this is a quick summary. It's also a plug for Breakpoint. I hope all of you buy it, right? What we figured out 4 years ago, that when we saw the government's tax data, the corporate tax data from the government, what we figured out was what was happening in our country is the sorts of companies people like me invest in. So for example, we invest in market leaders which are listed, the sorts of companies that I think everybody in this room will be shareholders of. Those companies were hoovering up market share. We were consolidating our economy on the back of a bunch of reforms, right? Better road networks, GST, UPI. As we were consolidating our economy, 90% of companies, registered to pay tax, they were falling by the wayside. So just to put some simple numbers around it, 1.5 million companies in India are registered to pay tax. 1 million was saying we have no profits to report. Out of the 500,000 who had profits to report, only 70,000 had PAT greater than 1 crore. The remaining, those 70,000 who had PAT greater than 1 crore were doing well, right? So many of them were listed, many of them were private equity investing companies. But the remaining 400,000 were showing 10-year PAT growth of 4%. This is 4 years ago. I think the numbers are looking even worse now. So we were consolidating our economy. Now that's great for investors, because people are around this room who invest in market leading franchises, we were seeing decent PAT growth, but it was a disaster for jobs. Those 90% of companies who were falling by the wayside were India's main jobs generator. Remember, large listed entities, well-funded companies are obviously using better and better automation, better and better machinery to grow their businesses. They're not going to create a lot of jobs, right? Our investee companies in my Indian portfolio are using state-of-the-art global machinery to deliver growth. They don't need people by anything like the amount they did a decade ago. So 4 years ago, my colleagues and I figured out that if we can't create jobs, and the reason we can't create jobs is companies are automating, and therefore they don't need to employ a lot of people.
And that's only going to accentuate with AI, right?
So let me quickly finish as to where we will have our Sagar Manthan. So what I'm saying in Breakpoint is, our main engine of growth in India has been consumption, 60% of GDP. That's effectively broken, right? Whatever you might say about the published data, I look at consumption growth. I take simple things like Nielsen's FMCG volume growth. Nielsen is a reputed provider of FMCG volume growth. Nielsen's FMCG volume growth has been running, Surbhi, at 3% now for several years, right? So the call I made 4 years ago was, India will pivot. It's a free market economy. India will swing. It will swing from being a consumption-centric economy to an economy which will be able to deliver manufacturing exports. For that, we needed a weaker currency, we needed FTAs, and we needed a shock which forced the country away from saying IT services export karenge, and we will use that to drive local consumption at 60p, right? So in 2022, when I made the switch, I couldn't see how the currency would depreciate. Foreigners were pouring money in, we were ramping up the currency, they were strengthening the currency, but now it's become easy to see. I think we are in sight of 100 to the dollar. The UK FTA, I think, is a very good FTA. I think it goes live next month. The EU FTA goes live in June next year. And hopefully one day we will have an FTA with America. I think manufactured exports will have to be India's renaissance. It's relatively clear that IT services, they'll be around, but I don't think IT services can deliver Forex growth. We won't be earning incrementally more to buy this lovely mic or the phones in your pockets. So India will go through a Sagar Manthan. The economy will shift from being a consumption-centric economy to a manufactured export-centric economy. That Sagar Manthan is underway. It'll be painful. And in that transition, I want to make money through investments in in domestic exporters. And thankfully, Surbhi, they're available at 15p, 17p, 18p, because nobody else wants to buy them. And certainly nobody wants to buy them at a time when war is raging in the Middle East.
You know, that's a really important point, Saurabh, that you're making and illustrating very well, that we're shifting from being a consumption economy to a manufacturing economy. And I hope maybe, I don't know, 3, 4, 5 years from now, when we're sitting here having this conversation on the 7th or 8th edition of the Global Wealth Summit, I mean, I'm hoping we would have
And the beautiful thing is,
we're
doing it because free market forces demand it, not because our netas want it. Free market forces demand that we switch from saying IT will bring in the forex. It ain't going to bring in the forex. If we want to buy these lovely things that make life interesting for us, we will have to deliver manufactured exports, a smashed currency, FTAs, and a world which wants to reduce its dependence on China should give us that window.
Okay, now that's on the macros. We will make that switch as we will, but let's not lose sight. We're still looking at roughly 7% growth this year, the war notwithstanding. But we're now down to the last couple of minutes of this panel. And I think the audience wants to know, kharidna kya hai? Where to go? What are these shores beyond India which are calling and which are looking lucrative? So you want to take that, Abhishek, first?
So, may not be so much tilted as I said in my initial address, that a large part of returns have come out of valuation expansion. So, and these are essentially, I think in one of the panels earlier it was discussed, these are essentially one pony or two pony trades, right? So if you talk about Taiwan or if you talk about Korea, these are essentially two pony trades or one pony trade.
The ponies are running really fast.
Could be, and to be very, very honest, while, you know, historically, I think the best investors, the only mistake that they make is valuation, right? So while the growth may always look easy to predict in the future, valuation is the biggest mistake to make. So I would say, look at a bunch of themes which are not available in your home market, specifically because your home market itself is at a relative discount. The way to look at it is, if you look at a fair value, your large caps is practically at a discount. Your mid caps and small caps may be trading at a premium, but only by a minute premium. And this I'm talking about fair value looking backwards. Let's not even plot what may come forward, and building into the predictability of a market like India, which will continue to grow at maybe, you know, in real terms 7 to 7.5, and maybe a 3.5, 4% inflation, which means a nominal of 10 to 12 or somewhere there. Not a bad place to be in. The faster growers essentially could come out of mobility, could come out of health tech, could clearly come out of AI, more so towards productization of AI rather than anything else. And I think that's where you would like to go out and hunt opportunities. So essentially not looking at a geography, but looking at these bottom-up themes.
Thematic.
And wherever it is available, go there.
Yeah.
So there's a lot of that available now in emerging markets, as well as
the US. Now, Ketul, on the US, let's not lose sight of the fact that there is a huge argument raging there as well. On, okay, bubble, no bubble is one thing, but the fact that it is very, very circular. These multi-billion-dollar deals that have been announced, whatever's coming out of the private credit market every now and then gives you a very eerie feeling. So our US equities, and then there is the war, of course the US doesn't hurt at all. In fact, if anything it gains, price of oil is up. But is the US still the best port of call?
Yeah, I think as of now, in terms of innovation, it's a leader. Whatever we are talking about AI, all of that is happening in companies mostly based out of the Silicon Valley. So, and AI is not just one single sector, it is impacting so many sectors. You have, because of that, you will have, now you don't need to talk to machines, they'll be able to understand human language. So that brings up robotics, that brings up drones, that brings up healthcare applications.
But don't you think stock prices have, priced in, how much? Have they priced in the next 10 years already? Or 5 years, 3 years? I don't know.
I think something that he alluded to was that in US, stock prices have gone up in line with earnings. So it's not a valuation expansion that has happened. And that's why, even though in an absolute term, it seems like stock prices have gone up, from a valuation, simple PE-based valuation, they have not gone up. If I were to tell you that pick any company that you know about, NVIDIA, Netflix, Microsoft, Google, they all trade below a PE of 25. Most of them below PE of 20 for CY27, correct? So valuations, I think people think that the stock prices went up, but the earnings have gone up much more than the stock prices. And that's why the valuations are actually quite cheap.
Quick final word on the mode of investing overseas, and I want to come back to the point on gift, Abhishek. Now, obviously, all the capital coming into the Indian equity market, and I always think, and I think for me, that's going to be the biggest watch point of 2026, as these newer structures open up in gift, and investors here realize the need to diversify. And I think the thresholds being spoken about are a lot cheaper. I think for retail investors, it could be up to about 5 lakhs or so. And you can invest in some of these feeder funds. What should we expect? What kind of new products? And will we see a very meaningful shift in capital? That'll have a huge bearing on the local market as well then.
So I think first things first, gift is a brilliant foray or a brilliant way to be able to add diversification, because it gives you a very, very clear visibility that it will keep on happening forever. I think clarity on taxation, the simple idea, because it's a clear port to be able to access the entire global market. I think the offerings like we used to do in our international FOF days will not be limited to just pure equities and so on and so forth. So the ability to take money out and possibly pipe it into a product which may be looking at a global REIT, global real estate operating company, which is, I think, arguably at a very, very good place if you were to steer clear of a few markets, because it's also a combination of yield and efficiency. That's not the kind of asset that you are otherwise, exposed to in India. Or you talk about products which can really give you a little bit of a leverage if you have the risk appetite. And at the end of the day, obviously, you have the ability to go across the market cap as well as the market curve. Otherwise, we are always limited by only the offerings that we have here in India. I must qualify, I don't have a Gift City vehicle as of now. There is a lot of work we have done. We have not gone into Gift City, but I'm sure Saurabh can talk a lot about that.
Can I just substantiate that? Because I think Abhishek's making some really relevant points. So the benefits of Gift City is it's giving you access to lower cost investments, right? The expense ratios that you get if you go through Gift City are lower. The tax incidence is lower. The ability to access superior earnings growth, orders of magnitude superior to what you're getting here. Valuations which are cheaper. And there is diversification as well. All of that within the ambit of Indian law. IFSCA, the regulator, is part of it's an act of parliament, Indian act of parliament, which created the IFSCA. So given that all of us are sitting in this country and we are rational people, if someone says I'll give you lower cost, better tax regime, better valuations, better growth and diversification, it's difficult to say what's not to like. And as Survi pointed out, the retail regime which we are part of, allows you to invest as little as $5,000, which is 4.5 lakhs as of today, and start your global journey. So remarkable stuff, actually. I mean, it's very difficult to praise the RBI and the folks in Delhi and in Gujarat enough, because I didn't expect to see 5 years ago all of this happen in my lifetime. Effectively, what the country has done is given you semi-capital account convertibility. If you run a company in India like I do, you're allowed to invest up to 50% of the net worth of the company abroad through Gift City, right? Make the most of it, folks. We can't go to the government and say, "Paisa nahi ban raha yahan pe," because they can rightfully turn around and say, "We've opened the path for you to diversify globally. What are you waiting for?"
So where are you going? I'm not talking about summer vacation. Till now, Indians were only planning their summer vacations overseas. Now it's portfolio planning overseas.
Summer vacation ticket might be hard. So in terms of where have we invested, we put just roughly 25% each in the following 4 themes. Firstly, power. Globally, we're seeing massive power demand, courtesy everybody in this room using AI. So every year, 400 gigawatts of extra power is required globally. The world has only installed 400 gigawatts once in the last 50 years, which was last year. Effectively, between now and the next 10 years, world power capacity will have to double. So we are investing heavily in Europe and America in that entire chain, turbines, generation, transmission, distribution. And many of these companies are available at PEs lower than, say, the Nifty. The second is defense and aerospace. I don't think I need to explain to you why every single aircraft manufacturer in the world, has order books full till 2040. They could work 365 days a year, 24 hours a day till 2040, and they still wouldn't be able to fill up the demand for fighter jets and commercial aircraft. So we're investing in the entire value chain, jet engines, seat belts, the components, the 12,000 components which go into a plane. Again, valuations are cheap. You can get the world's largest seat belt manufacturer for 15 times, and they compound earnings at 15%. The third theme is the ancillaries around AI, not so much the LLMs, but the data centers. The world needs 6 times more data centers than is currently installed. It's not just NVIDIA GPUs. You need circuit breakers, you need sensors, connectors. And the fourth is a theme which will appeal to people here, ultra luxury. Whether we like it or not, this boom in the last 5 years is creating a new wave of very rich people across the world, including in Mumbai. Now, those people want to drive Ferraris, they want Patek Philippe's, they want Hermes handbags, and we, with our middle-class investments, are locking into the need for the ultra-rich to have status symbols.
Very, very interesting. And I think the takeaway from this panel is don't go chasing individual geographies or individual countries. Go after themes. Borderless themes that are here to last, that are here to stay. I think that's the big takeaway and a very, very interesting thought point. Thank you very much.
Thank you.
Thank
you
very much for taking this up. Thank you. All right, so investing here in India, investing overseas, but how can we limit or restrict this conversation only to equities? No, not at all. Now, 2 years ago, the crypto conversation at a summit like this would have been a very peripheral one. Maybe we would have had it somewhere in the corridors, or maybe, right towards the end. But things are very, very different today. Today, crypto is mainstream. It is very much a part of day-to-day conversation. The reason is actual data. It's not just enthusiasm or FOMO. Institutional participation on India's major crypto exchanges is growing quite rapidly. We've seen that in terms of numbers last year itself. Taxes, of course, are still high. Regulatory clarity is still evolving. So we are not quite close to the finish line just yet, which brings us to the key question. Is crypto finally coming of age? Can we expect it to become a real full-fledged, thriving asset class here in India? Well, to take that conversation forward, let me welcome back on stage my colleague Chandra Srikanth. Chandra.
Hey Surabhi, I hope you had lunch. You've been doing a lot of sessions back to back.
We've got equity bulls, we've got equity bears, but I'm really keen on knowing what your crypto panel is going to have to say, because that one always stirs up a huge debate.
Do you invest in cryptocurrencies?
No.
Okay, so let's see.
Nothing till the RBI, regulates and gives an all clear. But then I'm very conservative by nature. There are lots of others who are not.
Okay, let's see if some of our panelists manage to convert you by the end of it.
You never know.
But Bitcoin is 25% down from its peak. No recommendations, but that should give you a cue on buying the dip, as they say in cryptoverse.
No risk appetite. Very low on the risk quotient here. Okay.
For someone who breeds markets day in and day out.
Only do what you understand. I'm prehistoric. I'm like grandmother type. So I'll leave it to you.
Great. On that note, it's an absolute pleasure to invite our panelists, Vimal Sagar Tiwari, the co-founder of CoinSwitch, one of India's largest cryptocurrency exchanges, Edul Patel, the founder and CEO of Mudrex, Vikram Subaraj, the CEO and co-founder of Gaitis, and Siddharth Sogani, founder and CEO of Blue Aster Capital. Interestingly, a crypto hedge fund based in Bahrain. We are very lucky that he managed to come back to Mumbai at the right time. Thank you all very much.
Looking forward to this one, Chandra.
Thank you all very much. Siddharth, let me start with you. Till 3 months ago, all the crypto bros in India were relocating to Dubai and Bahrain, and you also relocated. I think you were shuttling between Bahrain and Dubai for a very long time. Have you decided to come back to India for good? What are you going to do next?
Hey, hi. Of course, India is a big market. Would love to relocate and do crypto here, but we are still waiting for better regulations. Bahrain and Dubai people have moved for doing crypto because Their regulations are more, people are more receptive towards the idea of crypto. Whereas here, apprehensions are still there because regulations are yet to come. So, yeah, I keep shuffling between India, Bahrain, Dubai.
Will that continue, you think? Or will people come back now? Is this a good opportunity for all the crypto guys to come back to India?
Even if they come back, till the time regulations come in, large-scale operations in crypto is very difficult because institutions will not get into crypto in India till the time the regulators regulate it. Most of the exchanges here are self-regulated, but till the time a centralized regulatory body is there, crypto is still far away from coming into mainstream. I mean, institutions won't come in. Corporates could definitely come in, but regulated institutions, they will not come in. Because we are a fully licensed and regulated hedge fund based in Bahrain. Now, if you ask us to open an account in an offshore exchange to trade crypto, we cannot do that. We have to trade with only those exchanges which are fully regulated, and we have to have a custodian in place. So we have centralized custodians, not on-chain, but centralized custodians which are fully licensed and regulated and recognized by the regulator. So we put our money over there, and those custodians, they mirror it on those exchanges because one of the largest exchanges also got hacked, right? So because we are dealing with clients' money, it's a mutual fund structure. We have to make sure that entire pipe is watertight.
Got it. Right. Just show of hands in the room, how many of you invest in cryptocurrencies? Show of hands. Okay, I just see one here.
I think we have to increase the number, guys. We'll also raise our hands here.
Okay, a few more going up.
I think.
How many of you will be open to investing in crypto in the next year? Okay, not bad. How many of you will never invest in crypto? Okay, that's not actually an overwhelming number.
We have convincing to do. We have to convince.
Great, let's hear it from the exchanges, and I'd love to get Vimal, Edul and Vikram's views here. Edul, like we were saying, Bitcoin has fallen 45% from its peak. It's sort of been seesawing. At one point it crossed 100,000. Now I think it's back to the 70,000 levels. How have all the geopolitical factors impacted crypto? Because in between it seemed like, Trump's presidency also seemed to be giving cryptocurrencies a boost. But how are things now? Vimal, if you can start and the others can chime in.
So first of all, I just want to make a comment on the questions we ask. I believe the kind of audience we have, the number is good because the way people from the traditional market think about crypto, there are few people who have already invested and there are many people who are willing to invest. What we need is some clarity on regulation side. That will definitely help them invest in crypto. Now, we come to the question. In today's world, if we definitely Bitcoin has fallen, there was a huge correction. If we talk about the peak it reached in October 25 till it has come to around $64,000. But if we see from the context of some macro context, right? It's not only the crypto market which is falling currently. Like if you take today stock market, global stock market, not only Indian stock market. If we talk about currency, they are all fluctuating, and the most stable asset classes like gold and silver, like 5% up and down in gold, we have never seen in decades. Right, it is happening now. So crypto has an inherent nature of volatility. Like it's volatile because it is it's a very new asset class. Also, the current geopolitical situation, the war which is going on in Middle East, actually just adding some fuel to add, and this is the impact of this, right? If we see from the different lens, there are two aspects. I believe first aspect is the market aspect, right? How we see the traditional investors crypto market, right? So US has approved ETFs for Bitcoin, Ethereum, right? Those ETFs, there was some outflow in Jan and Feb, but we see the net flow again in March. It believes that the prices which has fallen is a kind of rebalancing the people are doing, because in the kind of turbulence time, people always try to take out the money from the risky assets and they want to put it some stable asset, right? So those kind of things we are thinking what is happening now. Another aspect is crypto is not just a financial asset. Crypto has a technology aspect of it, right?
The
blockchain aspect of it. So if we see from the technology point of view, if we talk only about Ethereum, Ethereum has seen the highest activity in the month of Feb 26, which we have never seen in the peak of 2021 when when the last bull run came. What it signifies? It signifies that people are actually building silently on blockchain and on crypto. And when this turbulent time will end, things will definitely become much better.
Got it. Edul, from an India perspective, we did a story a few months ago on how it's not just equity SIPs which are rising, but also crypto SIPs. Is that trend continuing, or are people pulling back now because they are moving more towards safe haven assets amidst all the uncertainty? What patterns are you seeing when it comes to retail investing in crypto in India?
Yeah, so from an investing perspective, we saw this trend most of early last year, where there was a lot of SIP-based long-term investing that was catching up in India. A lot of that was being driven by institutions, by large family offices who wanted to get exposure that they were not able to get, similar to what their foreign counterparts were able to get in US, etc. We saw some part of that dip in October, November, December, again consistent with what Vimalya was saying in terms of profit booking happening. And that trend has now started to reverse, where we are seeing again institutions and HNIs come back. The SIP trend continues. Most of that investing is happening in almost surely in Bitcoin, some part of it in Ethereum and a few other assets. But we are seeing that recurringly happen again and again and again. In fact, we are seeing some institutions double down on crypto, average down their price basis what they had bought last year.
When you say institutions, which institutions are, have crypto as part of portfolio? You mentioned family offices, interestingly.
Yeah, we are seeing mostly HNIs and family offices participate. Corporates are still far away in this investing space. And as regulations become more and more clear, we expect that also to come in over time.
Right. A lot of discussion on regulation whenever we talk about crypto. What else needs to be done? Because if you look at crypto, it is an asset that is taxed by the government, which gives it some sort of legitimacy. You then had the FIU regulations where people had to register with FIU. Binance did it, Coinbase did it. What else are you expecting from a clarity perspective? I mean, my colleague Surabhi said, she will not invest in crypto till it has the blessings of the RBI.
Exactly that, right? So, see, ideally for any asset class, you want the institutions to come trade with you.
Which is already happening to some extent.
Yeah, so that's family offices, HNIs, that's the part, right?
And that's like the top of the cream which is willing to take risk. You
want larger funds to come in, right? You want larger people to bring in liquidity into the space. And that happens definitely when there is a regulator who's giving a blessing, because at the end of the day, when these funds are investing into crypto assets, they're also answerable to the LPs to say that, okay, they're not putting in something which is unregulated and which is backed by some team, backed by a regulator if something goes wrong. So when we talk about what needs to happen, it is much more than AML and CFT. It's much on the lines of when these large institutions put in their money, are they considered a safer investment? So that bridge has to cross. And we are seeing a lot happening in that aspect as well. 2-3 years back, if you had asked us, HNIs and family offices, are they looking into this side? No. Maybe no, right? But now, yes. Suddenly, there is a good understanding that the sovereign hedge that has to happen with an asset class, crypto is also entering into that space. And it's very, very relevant at this point in time. When you want to hedge your asset from any sovereign conditions, it's not only gold anymore, right? Oil is becoming the new gold, crypto is becoming the new gold as well, right? So that is being seen across the globe. People are at least allocated 1 to 5% outside India into the crypto space. In India, that can happen only when there is a blessing.
So,
right?
maybe like I can try and I can also add some my 2 cents over there. The idea is that once you have a regulator, there is a formal process of consumer protection. And there is not only a formal process of consumer protection.
But there's always this question, who will bell the cat? Will it be SEBI? Will it be RBI?
I mean, that's a completely separate question to answer and ask, and I would rather not go there. I was trying to answer the question of what are you asking for or what are you looking for, right? Like, your question was that there is FIU, there is taxation, what more do you want? Like, what you want is a body that entities can report into, that creates market structure, that defines policies on and decides who can do what, and that helps create a market. Without that, creation of a market is difficult, and without that, participation of the broader audience becomes difficult.
How far away from a proper regulator?
I think first I just want to add what Idul has said. So I think he raised the point of consumer protection. Definitely this is needed. Why there are so many people sitting in the room? They blindly invest in Indian stock market, mutual fund, capital market. Why? Because they trust SEBI. There is an organization, there is a regulator where they believe that, okay, I'm protected from any kind of wrongdoing or say any kind of, if I say, policy point of view, right? There is a regulator who is taking care of all those things. These things are missing in crypto. The second thing is that, like we talked about, what kind of regulator. The first aspect of that is, okay, there are multiple kind of cryptos. One is like simple L1 where you just store it for value like Bitcoin, Ethereum. There are cryptos like asset-backed cryptos. Suppose I'm tokenizing a real world asset on blockchain. What kind of regulation we need for that, right? So this clarity is actually needed for when we see the larger fund or larger institution to come into in crypto space, right? So along with consumer protection, we need clarity on how we are going to deal with different kind of assets as well.
Right. Siddharth, a broader question. Do you think Trump has helped or harmed crypto?
That's a very good question. I think Trump came in with very pro-crypto, approach. His family is very, openly involved into crypto. I mean, I saw some of his family members in Singapore, in Token, they were all there. They have their own World Liberty Token Foundation, and they have their cryptos as well. What he's trying to do is to bring crypto mainstream with upcoming Clarity Act, and he's made certain legislations which allows the Federal Reserve to hold crypto in their books, and making the listed companies own crypto in a right manner. So the apprehension around crypto 3 years ago, where people used to look at it as if it's something illegal to have in your books, that has totally gone away. Now you see on the mainstream news channels, you'll see a ticker which always shows Bitcoin prices. There are news articles like about 5-7 years ago. A lot of news channels were apprehensive about talking crypto, right? Now this has changed. So with him talking, there are a lot of eyes and ears which are now looking at crypto mainstream. And after that, we see that a lot of American organizations like the JP Morgans, Jamie Dimon was against crypto long time ago. Now, after all these legislations, people have started buying Bitcoin using JP Morgan structure. Fidelity has come in, they've launched Benji token, Franklin Templeton. Custodians are now dealing in crypto. So, not a lot of people know, but since I'm heading a fund, what is important is a custodian whenever you are dealing in any asset class. So for example, if I'm dealing with your exchanges, I cannot directly deposit money into your exchanges. There would be a custodian. The custodian will take care of the settlements between the exchanges. They act as a broker. I place the order, but the settlements would happen through custodian. So a lot of institutional money moves via custodians, and 3 years ago custodians were not dealing in crypto, but now the larger custodians like the Morgan Stanleys and JP Morgans, all those guys have now started dealing in crypto. which has significantly increased the institutional entry in crypto. So I think Trump is pro-crypto, but crypto's price fall has nothing to do with Trump. It is very, it's like how Vimal mentioned, it's everywhere. We are all seeing a drop in liquidity, not just in crypto. And obviously, crypto's market size is very small. It's just $2.5 trillion compared to the global economy of $130+ trillion. So, yeah.
So, Chandra, if I may add, looking at prices and talking about what's happening in the US is actually a very myopic view of looking at crypto. Crypto is not about Bitcoin price. It's about changing how the world moves money. What we are really seeing happen in US post the passage of the Genius Act, which is the one act that has been passed, is an upgrade of the entire financial infrastructure over there. Every single bank is starting to move towards a faster payment method using stable coins. Almost every single large financial institution is incorporating some format of this new crypto asset into their infrastructure, either to move money, provide deposits to users, help them get access to financial services that was not there. And I think that is the change that we are witnessing. Crypto is not about Bitcoin prices, I would say. It is more about how the world handles money, moves money, does transactions, and gets access to investing, trading, and so on and so forth. And I think that is the large impact that we are seeing. And that for sure has happened.
Right. How long before you see that happening in India? Are we moving in that direction based on the taxation, based on the FIU move?
No, I think for sure the intent is there, and India has always spoken about all of these things in the past as well. The problem today is that all of this is too tightly coupled. Just like how Vimal was saying, right? Crypto is an asset class, it's a financial technology infrastructure, it is investing products all coupled together. And that is wherein lies the problem. You cannot ask for one single regulator because it's not a security, it's not a commodity, it's not a property, yet somehow it is all of them in the same place. So what needs to happen is decoupling needs to happen, and the approach that's being taken in the US is probably the right approach, right? Where they're saying that, okay, we don't care about the rest of crypto, but stable coins are not crypto, they are payment infrastructure. Let's talk about stablecoins as payment infrastructure and then build on top. And that's what actually the difference between Genius Act and Clarity does. Genius Act gives framework for stablecoins as payment infrastructure. Clarity gives market structure for crypto, tokenization of assets, securitization of assets, which is a completely different piece. And I think the first part that needs to happen is that mindset change needs to happen before we can even talk about a regulator coming in and regulating crypto. Right? So that mindset is the part that needs to change first.
Right.
One thing, if I may add here. So if we see the India market, we always talk that, okay, this is not regulated, or many people don't invest as well. But if we see from a different lens that, okay, the guideline for FIU registration for every virtual asset service provider came in 2023. And it's just 2 years since then. And we have over 40 companies registered with FIU. Those 40 companies actually, and those are local and global companies. Those 50 companies. Those 50 companies actually want to serve Indian consumers. It means that they see India as a huge market from the crypto investment point of view. So this is actually a very big number. In
the fact that 50 exchanges have
Yes,
registered.
50 exchanges and crypto service provider has registered with
Which
FIU.
actually brings me to the next part of my question. Binance has registered with the FIU. Coinbase has, and they've also picked up, they've also invested in one of your competitors, CoinDCX.
Okay.
What's going to happen to Indian exchanges when Binance and Coinbase set up here with deep pockets? That's the first part of the question. Second part, can we expect more consolidation among Indian exchanges?
Okay, so I will take the first part of it. It's a very interesting question you have asked. So currently, like there is a, if you see, there is a kind of a regulatory arbitrage, I would say, that okay, there are few people invest in Indian companies and few people invest in foreign companies because there is a TDS and those aspects of it, right? But if we directly compare with how normal consumer think of financial investment and the platform, right? If we see banking as example, right? There are multiple foreign banks also, they have similar license to operate in India. There are multiple local banks, Indian banks also have a same license to operate in India, right? But if you see normal Indian consumer, they always trust local players. They invest, they do banking with the company like HDFC, SBI, right? While there are multiple foreign players also exist like Citibank, Stancy, right? So the local consumer mindset is always that whenever they are putting their money, whenever to whom they are engaging for the financial transaction, they always trust local player. Currently, I believe once this tax rationalization and the regulatory arbitrage will clear out, people will always believe and start investing more with the local player, because they always see the face, they always see the people who are running those platforms, and in case of money, they always trust local
Coin
players.
DCX is run by Indian faces.
Sorry?
I said even Coin DCX, in which
They have
Coinbase-
invested
yeah.
in that. I think that is that is a separate aspect of it. Coin DCX is a local player today.
Edul, more competition, more consolidation.
Amazing for everyone. Like, I don't see a reason why more people coming
How is
in.
it amazing? You'll have to spend more to acquire customers.
That's all right. The market grows. I would actually
It'll
argue that we
widen
have
the
to spend.
market.
Okay, so let's talk about something called as Jeevan's paradox, right? When the cost of doing something goes down, the scale at which it happens increases, and that's what we are seeing with most things in the world, right? Including AI. I think a similar thing happens when markets expand. What happens is that once new players come in, they help grow the markets faster than what you would normally grow. That market expansion brings more users in, which actually then rather reduces the cost of acquisition for a normal company like ours. It's more education out there for everyone.
Vikram?
Yeah, when we talk about an exchange in the crypto space, unlike how it is in the equity space, we're talking about an exchange and also a depository, a clearing agent, and also an investment providing company, and also so many things. A crypto exchange is not an exchange per se. At this point in time, it is a compressed package of anything that you want to do in the crypto space, you enter through a crypto exchange. So this concentrated entity in future can be divided into multiple parts, right? One can play the pure play part of an exchange, other can split into a broker, or there's so many options that are there. Now, at this point in time, there's still more space is what we are trying to say, that people can do all these activities and still stay as the exchange what we are at this point. Now, yes, a lot of these global players are entering into the Indian market, but they also bring in the fact that now we have more muscle and power to talk to the regulators as well, because they bring in the experience of dealing with the US regulators, and their examples are definitely helping us out. Now, when this opens up the
So
market,
you'll be able to present a stronger case together.
oh yeah, see, like Edil was pointing out Genius and Clarity Act, right? These are very, very critical acts. Sitting in India, we are also closely watching these acts on how it is going to pan out. Now, as simple as what's happening right now with the Clarity Act is the banking forum is fighting against crypto stablecoin providers giving an yield on their token. They don't want them to do it. Why they don't want them to do it is they're suddenly seeing a lot of money being transferred to these stable coins for the investors to earn the yield. So the banking ecosystem is worried about the crypto ecosystem there in US. So that is the critical funda about all these acts getting passed there. Now we definitely want all those talents to come out there and help us out with the Indian governments as well, right? So the market expands is ideally what we're seeing.
So that the exchanges will say the market will expand, but what's your take?
Yes, definitely the market will expand, but just wanted to add on the FIU aspect. So, because we've given several representations to our government as well, and I have experience of working with 7-8 governments in getting policies and everything regulated. FIU over here is just taking data. It's not regulating crypto. So that is, so if you are a foreign, offshore service provider, not just for crypto, for anything which deals with money, you agree by registering with FIU to provide data if they ask for it. So it's not regulating. It's not telling you to give data or maintain your books in a certain way. It's not regulating. It's just taking data because, and especially crypto, because it can be used for a lot of purposes, right? And so they are collecting data. They are not regulating it. till the time we have somebody, so we had proposed this name called DARA, Digital Asset Regulatory Authority, back in, I think, around COVID, you know. We asked our government to set up a regulator specifically which understands crypto, which has good coordination with SEBI, and which has good coordination with RBI. Because these two regulators in India need to be in the crypto space, and you know, a separate regulator must be set up. Consolidation? I don't think so. Consolidation is something very near future. It all matters, after the regulation comes in, it all matters how liquid your exchange is. The more liquidity, the more users will flock to you. So instead of, for an exchange, instead of acquisitions, until and unless, like a very significant exchange acquisition happened between Coinbase and Deribit. So Coinbase was always focused on retail, spot markets, perps, but they did not have options. So they acquired Deribit, right?
Got it.
So consolidation won't happen in terms of acquisition, but consolidation would happen in terms of liquidity providers, market makers in that particular exchange. And the higher you have, the deeper your order book, the more people you will have. As simple as that.
Got it. We have exactly
Chandra,
2.5 minutes.
Just one thing I want to add what Siddharth
in
said.
10 seconds.
Yes, in 10 seconds. So with FIO registration, basically from AML CFT point of view, we have the similar status what any bank or any financial institution in India has. Like if they also observe any wrong transaction happening, they can report to Financial Intelligence Unit. Similarly, crypto platforms can also report to it.
I would argue that we do more than that.
Yeah, we do more than in some cases.
Got it. Okay, 2.5 minutes. We're going to do a very quick lightning round. All yes or no answers or an option answer. What do you think is the biggest impediment to the next phase of crypto growth in India? Is it regulation or lack of trust?
I think regulation brings trust. So
Okay.
Regulation.
Edu?
I would think it's actually investor education.
What was the question? Sorry, I missed it.
What is the, what is stopping crypto from sort of scaling to the next level? Is it regulation or lack of trust among public?
Actually, nothing is stopping. It's actually in a very, very good spree. We are actually happy that A is doing well, because the only thing that can take care of A agents paying each other is only crypto. So A grows, we are going to the roof. We are very clear.
Siddharth?
I think regulation, like Vimal said it right,
Which will in
regulation
turn
brings
foster trust.
But even Edul is right, because until and unless there are a lot of products which are regulated out there, but
Okay.
till the time you have the knowledge, you will not buy it, right? A lot of people don't understand crude, they are just not buying crude.
Okay.
Even if it's an obvious trade.
Okay. What percentage of your wealth is in crypto today?
I think quite high.
Give me a percentage.
I invest in crypto.
Okay. Edul?
10% of my wealth and 100% of my time is in crypto.
Okay. Vikram?
All in. My wife would be cursing me when she sees this video.
Siddharth?
Significant exposure in crypto, yes.
Final question. I know you told me crypto is not about Bitcoin prices, but prediction for 2026 Bitcoin levels.
I think we are in a turbulent time. It's hard to predict, but I believe once situation will become better, prices will definitely recover.
Which level? Give me a level.
I think to what around the peak.
100,000.
Yeah.
120.
Yeah, around the same.
Edu?
It will oscillate between where it is right now to 120.
I think everybody will talk about Bitcoin. Take a step back. Think about Ethereum as well. Ethereum is at $2,000 and they're all talking about AI here, right? I think
That's
you guys
the real
really need to
sweet-
look at, yeah, it's a very sweet spot.
That's the dark horse.
Vikram is giving us the alpha.
Okay, watch out for Ethereum. Don't be over-indexed on Bitcoin. Siddharth?
2026 is too short because we are going through a global geopolitical issues, right? 2020, but I still think after June, July, we should cross the all-time high once again. I think roughly between 120 to 150 is
Great.
easily achievable. But 2027, 2028 would be fantastic because we have always seen a 40 to 60% correction in crypto, and it always makes a higher high every time. So that correction is ongoing right now. Probably we could see a bottom of 55K as per our technicals, and upside then it usually makes another top, which should be due in end of 2026 or 2027 first quarter.
Great. On that note, thank you all very much, Vimal, Edul, Vikram and Siddharth, for very candid thoughts on crypto. And hopefully we will get more clarity when it comes to regulation.
Thank you.
Thank you. Thank you. Thank you to our panelists for deconstructing where crypto is, and for being very candid as far as the potential is concerned. But like we said, the Global Wealth Summit is not focused on just one asset class. We've been covering equities, we've covered crypto, and now it's time to go for gold. Because gold has had a strong run over the past year, with silver rallying sharply alongside it. But recent geopolitical shocks that rattled energy markets and risk sentiment have once again reminded investors how quickly the landscape can shift. Interestingly, even as tensions rise, gold prices have softened, raising a new question for investors. So the real debate today is this: are gold and silver still reliable safe havens, or are they becoming far more complex assets in modern portfolios in moments of ongoing conflicts like the Middle East? To take us through all of this, please welcome Surbhi once again on stage. So, Surbhi, before I let you introduce your panelists, before my crypto panel, you said you're a very conservative investor, very grandmother-like. That means you have a house full of gold. कितने तिजोरियों को भरा रखा है सोने के?
Can't disclose that. Public event. You will talk behind. No. What I really meant, and that was a great panel, Chandra. What I really meant to say was that I think as long as you can spend some time understanding the security, the asset class, the push and pull factors, just devote some time on research. And then whatever you invest in, at whatever time you invest in, make sure that you're taking calculated risks. I think that's the only thing that one can hope investors here in India follow.
Okay, so are you bullish on gold and bullish on silver?
It's not my place to be bullish or bearish, but it's my place definitely to ask a lot of questions, given the fact that, Chandra, can you imagine in January, and I've been tracking mutual fund data for a while, I think my eyes popped out of their sockets when I realized that in that particular month, January, equity funds had pulled in about 24,000 crores or 23,000 crores, I think, net equity flows. Gold ETFs alone pulled in 24,000 crores. Silver ETFs pulled in around 9.5, 10,000 crores. And that really made us wonder what's going on. Is this
follow
just
the
FOMO?
money.
Is it just FOMO? I mean, subsequently, the latest data, the inflows have cooled off a little bit, but I think it sets us up for a really good discussion on what is happening. Is this sparkle for real?
Great. On that note, I'm going to let you introduce your panel, Surbhi. Looking forward to it.
Thank you so much, Chandra. So let me, call on stage Swaroop Mohanty. Yeah, Swaroop, can we have you here? Swaroop, Vice Chairman and CEO of Mirai Asset Investment Managers. Kalpen Parekh. Kalpen, can we have you here? MD and CEO of DSP Mutual Fund, and of course Vaibhav Porwal, who's the co-founder of Deserve. Vaibhav. Anyway. Yeah. Thank you so much. See, when I first got to know that Swaroop and Kalpen are on my panel, I'll be very honest, I was like, wow, I mean, typically I've only had equity conversations, largely equity conversations with both of them. And I said, this is a sign of times. Now Kalpen and Swaroop are here to discuss precious metals. Surely something is changing. But before I get to the two of them, Vaibhav, I actually want to start with you. What Chandra and I were just discussing. And given that, obviously, you're part of the fintech world, and fintech has made it so easy to, at the click of a button, to invest anywhere, whatever you want, whatever asset class. What are the trends that you observed as gold was skyrocketing, silver was doubling all through 25, there wasn't even a war, and yet these precious metals were doing what they were? What did you observe on the Deserve platform?
See,
in terms of buy and sell trends and just investor behavior.
Of course, we don't run a trading platform, so investors don't come to our platform and trade. We run a
wealth tech platform, so where we offer discretionary solutions to our investors. And one of those discretionary solutions is investing in precious metals. So suddenly we started seeing surge in inquiries, which was happening around September, October of 25, and which led to a situation where in December and Jan of 2025, 2026, people wanted to switch out of equity and get into gold and silver. And that for us was a bit of a red flag. It's pretty much like people chasing momentum and reacting to the price movement instead of reacting to the fundamentals. So that's something that we observed very closely. As looking at the data for last year, not just in India but globally also, the demand for investment in gold and silver has doubled. Out of total 5,000 tons of demand, 1,000 tons incremental demand came from investing. So which obviously speaks a lot about the way complexion of the market has changed. People have cut down their jewelry spending and more money has started coming from investors who look at gold as a safe haven and also as an opportunity to make quick money now.
Okay, all right. So, I mean, there's definitely a lot of interest. But let me ask the other two gentlemen. Is it FOMO or is it measured investing?
No, first of all, Surbhi, thank you so much for having me. And Kalpen, I think our career is taking a definite progression to be sitting on a gold panel, as you rightly said. But yeah, I mean, if you look at the present status, and here's my submission, it is these equity investors who are buying gold. Otherwise, in this room, everybody buys gold in a very different objective. Nobody has bought gold till now over generations, keeping price in mind. And that is what my fear is it will spoil the whole thing. We've over generations gone and accumulated gold on a certain day in a country without looking at price, and that day would have been the most expensive. And we've accumulated over it over the years and not sold it. And that's why it's become a safe haven. Now, Gyanis like us have entered the field, and hence price has become relevant. Hence this incredible buying behavior or investing behavior, I fear, can be destroyed for good. So my humble request is, please buy equity the way you used to buy gold, and don't buy gold the way you buy equity. We are about to spoil this whole party.
It's all become interchangeable, interoperable. Ye nahi chalega to wo nahi chalega to wo, kuch to chalega. Kalpen, your thoughts?
See, firstly, you invited us to talk about gold. Is a sign of froth. Mostly, this asset class has been there since ever, right? 2,000 years before us and maybe 2,000 years after us.
No, we invited you to talk about gold because investors are pouring in 30,000 crores in a month in gold and silver products. So we had to invite you.
All I'm saying is since 98 to 2026, this is the first or second time I'm doing a panel on gold. And that's again a sign of times. Secondly, we cherry pick data depending on prices. So now everyone says central banks are buying. But did you know for the last 5 years, central banks have been buying? And this year, central banks, their purchases have reduced by 21% than the last year. Number two, from 2022, 23, 24, and half of 25, ETFs had negative flows in gold. Only in the second half of 2025, ETFs have got 500 tons of incremental flows. So ETFs are late buyers. So they sold all through when gold prices were cheap. And ETFs are not an entity, right? They are basically a collection of all of us. So I think it is basically like any other asset class. There is no intelligence behind, in a way, buying this. It is prices which are driving purchase. Now, also, I'll just give you one more statistic. 1971 is when the Bretton Woods system was disbanded. And, gold prices fell sharply. And then they had a first year, for the next 10 years, because after they fell very sharply, the next 10 years return for gold was 32% CAGR. Then the next 2 decades, the first decade was minus 5% CAGR for the entire decade. And the next decade again, minus 4% CAGR. So absolute loss of 50-60% for 20 years. 2001 to 10 again, 18% CAGR. 2010 to 20, only 3% CAGR, less than savings account. And this year so far, this decade, 21 to 25, is around 16-17%. So it's as violently volatile as anything else. Till 3 years back, the long-term CAGR of gold was around 8% in dollar terms, and S&P 500 was 11%. In the last 1 year's 150% jump, that 8% CAGR has suddenly become 14%. So there is a huge endpoint bias Today, all data analysis we do for the last 20, 30, 50 years shows that gold has done better than 30 markets. The top 30 equity markets have underperformed gold is the first inference I can make. And now when you do rolling returns on a rolling 5-year basis, the data shows that only 25% of times gold does better than equity in India. Around 35% of times gold does better than equity in the rest of the world. So what I'm saying is that there is place for gold because it solves for geopolitical turmoil. It solves for loss in central banking and paper currency. And rightly so, the way the world has behaved in the last 10 years, people have to get nervous. So it deserves an insurance weight in the portfolio, not an investment weight.
I can hear, a slight caution and fear in your voices, and I hope people are listening into it because even I wondered over the last so many years, 15 odd years since, we've been having conversations on personal finance and asset allocation. And then you see this kind of behavior at I'm not saying it's the top of the market, but I mean, after a severe escalation in prices, and then you see investors coming in and you really wonder, whether there is some thought process behind it, there's some modeling behind it, or whether it is just return chasing. I mean, my question really is that are people beginning to look at gold not as a hedge against inflation, not as a geopolitical, sort of place to go in risk, but as an alpha creating asset? In which case, I mean, is that even right? Should you be even looking at gold in that way?
So let me just respond to this. There are so many of these easy statements which are fundamentally mathematically provable to be wrong. So gold as a hedge against inflation, if you just do correlation of inflation and gold prices, 40% of times in inflationary period gold has done well, 60% of times in inflationary times gold has not done well. So you can't truly say. There are many other dimensions at different points in time. Or, gold is a safe haven. How can something which for 2 decades, which has fallen 50, 60% be a safe haven? So both these statements are truly speaking wrong. But what is true is gold has huge negative correlation to equities. So just to give you a data point and take the last 1.5 year away because it distorts a lot of data points. If you take the last 1.5 year away where gold was in normal cycle and equity was in an up cycle, the last 25-year returns of equity was 12%, of gold was 11%. But if you blend the two in a portfolio, the final return is 13%, higher than the individual because they behave in opposite directions. So I think the last 2 years in India, equities have drifted sideways and trending downwards right now. Maybe it might continue for some time. Gold has risen sharply. Again, it's demonstrating its low correlation to equity. But there will come a time when the correlation will continue to show up. So I think it will be volatile, but it merits place. So the best time to think of gold is when stocks have risen up very sharply and gold has gone nowhere for 5-10 years. This is not the best time. This is a time if you want to give 5-10% as a hedge against geopolitical uncertainty. And just last data point I'll say, in the last 10-15 years, barring the last 2-3 years, only emerging market countries have bought more, their central banks have bought more gold, not the developed world. And one data point interestingly that I saw today morning was countries against which there are odds of sanctions by Europe, US and Japan. Those countries have been doing more of gold purchases because they want to be, safeguarding their ownership of dollar assets by replacing that with gold.
Interesting. Lots of interesting data. Yeah, Swaroop?
So at the beginning of 2026, I stand at a space where I'm questioning all these biases, all these rules, all these so-called grids of asset allocation. All rules have changed. At a time when sovereign reserve is higher than dollar in gold, you need to question this whole justification that gold is a hedge. You need to question, because I don't know. When you look at a price perspective, please bear in mind the incredible Charlie Munger had called Bitcoin rat poison at $430. So let's not get into gazing what it is. It is true that it is no longer the asset it used to be. I am firmly believe, and there's a reason why Europe invests 80% of its money in multi-assets.
I take your point completely, and especially as a hedge against inflation. Look at the last 15 days. What is the biggest fear in the world right now? An inflation shock.
I mean, the two currencies have changed, right?
The gold market is stuck in a range.
Dollar is changing. Oil has obviously gone through a different thing. I don't know whether people will buy equity or not, but at a sovereign level, people will buy gold. This looks a very certain asset right now. So I'm not saying whether one should. And see, it's never about allocating. You lose money when you over-allocate. That's the key.
Therefore, I ask the question, are people beginning to play gold as if it's an alpha asset?
People have always played gold, not in this form. Let's face the truth, right? We fought over centuries, over the last 20, 30 years, trying to tell them to buy our side of gold and not jewelry. Last 2-3 years, the Gold Council has come up and put up hoardings saying that buy gold ETFs. Gold Council and not jewelry. So we fought this battle for. Maybe we are winning now. But it's not that people will not buy gold in Dhanteras even after this. They will buy. We are encouraging, saying that don't buy jewelry, buy gold ETF. That's the only discussion we bring to the table. To say that anybody in this room does not buy gold in India is a flawed statement. So they've always bought. My grandmother had bought, my mother had bought, my wife thankfully had stopped buying, my son may not buy. But people in India will always buy gold. We are encouraging them not to use the bank locker, use us as lockers in the form of gold ETFs. That's the only request we are making. Asset allocation is at their end. Me saying, you're saying will not stop anybody from buying gold. This is Dhanteras. Mark my words.
Well, I think the endeavor has been finally successful given the kind of flows coming through. You know, Vaibhav, let me ask you, have fintechs had a big role to play in this? Just because it's far more easier now, right? Obviously, it's all become driven on the exchange. You can buy ETFs at the click of a button. You have funds. So I'm not saying our fintechs to blame. I mean, the job is to offer alternatives. But is more education and more awareness still needed?
See, education and awareness is needed. Most of the people that invest money in different asset classes, and that's what we have been discussing about, they react to price movement, they don't react to the fundamentals. So that's the first distinction that we need to make. You spoke about ETFs getting disproportionate amount of money, almost 33,000 crores in the month of
January 26. Yeah.
26. Nobody invested that kind of money in September of 24. Everyone wanted to invest money in equity, which clearly tells you that people are reacting to price movement. There is no fundamental thought process behind it. Now, for fintech, and not just for gold, for every asset class, it's become very easy to trade in and trade out when you have these kind of tools available. You can quickly get in, get out. We no longer hear stories of people finding stocks in their suitcases after 15, 20, 30 years, because you see prices on daily basis and your demat value is increasing or decreasing on daily basis. So that removal of friction has made it easier for people to trade in and trade out, which has both advantages as well as disadvantages. You can be active in the market, but at the same time that hyperactiveness can cause you a lot of return losses also. So from fintech's point of view, obviously there are platform players which provide execution support, but we are not an execution support platform. So we actively educate our investors on merits of asset allocation. And as
clearly no one's
said,
listening. I'm saying clearly no one's listening to the podcast. I think all of the mutual fund, the manufacturers are putting on their websites what media is doing, what you're saying.
But okay, but that still remains our job, right? So we can harness.
If disagree to you, we'll discuss this after that.
Yeah. So, but still that remains our job. So without that, people can buy whatever they want to buy. And a very interesting study that we carried out, and just trying to create the correlation between this average holding period in real estate in India is 9.5 years. Average holding period in equity in India is 2.5 years. And that explains the difference in multiple. Real estate, a lower CAGR, is able to offer much better multiple compared to equity. And that in some sense is a function of how easily you can sell or buy any security. If you don't see the prices on daily basis, Swarup said grandmothers never looked at the prices because there was no option to look at the price, and that was not the criteria.
On that note, okay, let me bat for the investor as well. And that's exactly the point, that households in India have always had gold, there's always been jewelry, but that traditionally was never seen as part of a portfolio. It's family legacy, it's rarely sold, or if it'll be interchanged, mother will pass it to daughter, and then you'll go and buy some new jewelry. So it never came out as part of a systematic asset allocation plan. Perhaps now investors realize that they cannot have all their eggs in one basket, which is the Indian equity basket. They need to diversify. They're watching the price move. They've been patient with their equity SIPs, but they're feeling the pain of returns not coming. And they now want to build asset allocation. The problem is the price is already shot up. So then, you can't really fault people either. What's the way out here? Kalpe?
See, I think there's always a way out. If you want to be greedy and late, there is no way out. I think investing cannot be easy. where we earn 15-20% return by being late and have an excuse that, okay, prices have run up, so main kya karu? We launched our gold fund and silver fund in 2022, and we barely got money. In 23, we came up with a data point that in 24 out of 25 emerging market countries, gold has done better than the stock market. And the only country where it was not true was India at that point. Today, that also has changed. I think investors can do whatever they want to if they want to. There are enough investors who have been doing SIP in gold for the last 5 years, not 10 years. There are enough investors who invested in multi-asset funds 3 years back, where these funds had 25% in gold and silver. And today they have brought down the exposure to 10%. So investors have a choice. I think our job as responsible money managers is to guide them, not by giving binary calls of buying or not buying, because every decision is personal. I cannot tell you what should be your exposure or Swaroop's exposure, but we can guide them where are we in the cycle. We are at a point in the cycle where if the last 5-year returns is 400% CAGR, 400% absolute. For an asset class, we should have done 50% absolute from a long-term point of view. You should know that you are slightly on the higher end of the cycle. You could have disappointment. In spite of saying this, tomorrow, next 1 year, it could still go up. But all I'm saying is that there are reasonable chances of being disappointed if you go overweight right now. If you are underweight, by all means, take it up to 10%, do your SIPs every month. The last 45 days have seen 10-15% correction in these precious metals. Start with an SIP. There is no hurry to, chase what is running very fast. You can get into a train or in a plane only when it is, on the station or not on the runway or not when it is in the sky. Only in investing, after all the education collectively we do, but if you want to chase an asset class after it runs up, then we can't blame anybody else.
I think that's a really good analogy. Don't try and board a speeding bus. Chances are you'll get hurt. Swaroop, you want to add to it?
No, I was referring to the asset allocation thing. See, asset allocation happens on Twitter. In real life, people buy past assets, right? To be fair, if the advice of the industry is based on past return, more often than not, investors will buy past returns, right? That is the truth, whether we want to face it or not. The difference between mutual fund advice and broking advice is this. The broking advice is this stock will do well tomorrow. The mutual fund advice is this stock mutual fund folios. That's the truth, right? Till that does not change, investors will buy past returns. And that is what we are seeing. But over the years, till 2017-18, people bought only large caps.
But let me try and argue a different point there. Yeah. While I know all of us have been part of investor awareness campaigns, conversations, personal finance, obviously very close to all our hearts. But somewhere the conversation when it comes to mutual funds in this country has been really dominated by equity. And this is the point that we made earlier as well.
It is time we broke that bias.
We don't talk enough about fixed income funds. We don't talk about systematic investing in gold or precious metals. Now Kalpen has just spoken about SIPs in gold. It's always been equity, equity, equity. So why blame the investor?
No, I'm not blaming the investor. I'm blaming myself is what I'm saying, right? My advice has been that, right? If on this podium, I would have said equity is a growth asset class, not a problem. But I've come on shows with you and said equity is the only growth asset class. And that's the bias we have to break. And all of us are responsible for that. I'm counting myself in that. But if we don't break it now, and I fear what happens is with a near-term return, an asset class gets attraction. Till 2018-19, small cap was not a touched asset. 2 years of good return, now small cap is part of everybody's portfolio. Maybe gold will become part of everybody's portfolio with this near-term asset. So from here on, we can talk serious asset class, and I'm looking at the space very constructively. Finally, I fear, and Kalpen runs a very successful multi-asset fund. When you look at the next 5-10 years, I think it is time people talk more of multi-asset funds as core portfolio over any other fund. That's the truth. You cannot predict cycles, but you have to sit invested to catch the cycle, and multi-assets probably will take the space which they deserve in clients' portfolios.
What a privilege it has been to see the conversations move from equity, only large cap, or total momentum mid cap. And now when we have two of the CEOs here saying balanced portfolios, maybe multi-asset, well diversified, maybe that's the core approach.
It's not now. I want to clarify.
Okay, you've been saying it for a while.
Yeah. And it's not about me. We did a campaign 2.5 years back on many airports, which had 0% return on it in red. And it said, what if your hero asset class earns 0 for many years? And hero asset class keeps changing, right? In that period, 2 years back, what was the hero asset class? Was equity. And that was actually a campaign to talk about multi-asset investing, not even about the fund. It's important that you do multi-asset investing, and that could mean global equities, it could mean Indian equities, it could mean bonds, it could mean precious metals. I remember on television, people who are invited are the one who do chest thumping and, non-stop bullish conversations, because that sells. Those clips can go viral, but a data-driven clip never goes viral. And I try this, okay, by the way, on Twitter, I try one with data and one with all this chest thumping. The second one gets more views. But that's the reality. So what gets more views gets less returns.
No, but I think at least a start is being made. I mean, the conversation is being broadened, and as they say, the market is the best teacher. So whether it's FOMO investing or whatever, but the fact you see an asset class rise 100%, you might chase it, you might get burned, but it will put the conversation on center stage that you need to be better diversified, and we've seen that in the last 12 months. One more point on tax, gentlemen. And again, it's something we all have to admit that tax ends up driving a lot of investment choices here. So one is price is anyway, driving you to do what you want to do, and then there is tax. And I mean, together they might be a bit of a lethal combination, aren't they? Anyone wants to kind of... So how to move beyond it? How to move to scientific investing, not just because this is tax efficient and this is done very well in the last 1 year.
In the last 7-8 years, and you mentioned this before, that a large chunk of AUMs have been built in as, dynamic asset allocation funds. And they have a large component. We should talk right now that as the market is going through a 10-15% correction and stocks are down 30 to 50%, a large chunk of dynamic asset allocation funds are having 70% in cash and arbitrage. Their portfolios have 30% only in equities. But no one is talking about it. No one is interviewing a dynamic asset allocation fund manager because it is run on a formula, because that fund manager doesn't have something interesting to talk. So while markets are down 10 to 15%, these funds are down only 2 or 3%. So there are enough products which are available for investors. A pure proxy fixed income product is an arbitrage fund or an equity saving fund where equity component is very small. So this entire range is available for investors to tax efficiently do asset allocation and contribute to safer asset classes also.
Vaibhav, as someone who's representing fintechs on the panel, as we go into the next phase of investing, and I think the Indian investor is maturing every year, every day, right? What role will fintechs have? Will they at all even want to play the role of an educator, or will they want to remain simple platform providers? We're giving you the options, you decide.
I think platform providers are already there. There are enough platform providers are there. The role which people like us aspire to play and continue to play is to educate investors on the way they should invest. See, investing, one good thing when I was thinking about this conversation is there is a rule that we think good news and good prices never come together. Right? So that is something that we need to educate investors about. Unfortunately in gold, when bad news comes, good prices go up substantially. So for gold, we need to wait for the bad news. And similarly for equity also, if the news is bad, prices are good, you have to go and buy. And that's the education that we need to impart. Plus, investing is a probabilistic game. Deterministic, it's not a deterministic thing. None of us sitting here can assure anyone of any returns over next 1 year, 3 year, 5 years. Things change. And that's why you look at asset allocation, look at which asset class has odds in favor, and then you go overweight there. Campaign brought up a point of dynamic asset allocation funds. And simple and very dumb thing like just rebalancing your portfolio periodically can generate alpha for you. So that's the role that we need to play. The biggest victory in investing comes if you are able to keep your investors stay invested. If your investors are not staying invested, that's the biggest suffering you can cause to your investors. So our role is to make sure that our investors stay invested. If they stay the course, they will realize their returns.
Okay, so last 30 seconds to everybody. Now we've discussed all the, the theoretical part of it. Now the more active part of it. So Swaroop, personally for yourself, or let's say if you wear the hat of an advisor, just for now, for friends and family, what's the best asset allocation mix for the next, 2 to 3 years?
On the equity 50-50, 50 to large cap, 50 to mid and small. My asset allocation will be 70-30 at this moment because my debt has, my equity has done well. 10 to debt and 20 to collectibles.
Only 10 to fixed income.
Because, I mean, there is enough accumulation I can redeem from there. That's my asset allocation. 20 will be to commodities.
20 to commodities. And if you have to start investing now, then SIP.
No, I am a lump sum guy. See, the best time to buy is when you have the money. And SIP is a market, unless it's a cash flow too.
Even at current prices?
Yeah. We are, as a fund house, we are fully invested. We don't take cash calls. If we knew, I wouldn't be a salaried individual. So I don't know. If I get money to buy an asset, I'll buy an asset.
Fair enough. Kalpen, your asset allocation?
Currently, my current asset allocation is 35 rupees Indian equities, 25 rupees global equities, 25 bonds, and the balance is gold bonds and gold. So it's confused. I could have said intelligently it's multi-asset.
Okay, let me ask you, for every additional 100 rupees you have to invest,
Every
where will
month
you
the
put it?
salary that I get, so far I am doing a multi-asset SIP for the last 18 months or so. At some point, if gold continues to rise and stocks continue to fall, I might stop that and start doing an equity fund SIP. I don't get as much salary as Farooq to do so many. I have to choose only one fund. You can add one more DSP.
He's not saying anything.
Let's just go into the public figure and check who's salary.
We'll do that.
The data is available for both of them.
Yeah.
So, Weber, what about you? Asset allocation and your call. Where are you investing your additional 100 rupees?
So 70 equity, 50 India, 20 overseas. That's the limitation that we have to live with. 30 is non-equity, out of which 50% is pure fixed income and 50% is hard assets, including real estate and commodities.
Yeah, if you could just hold the mic up a little bit. Swaroop is willing to buy gold even now at current prices. You?
I'll continue to buy, but I'm not expecting it to deliver alpha. I think gold and silver have borrowed some returns from the future, so I'll have to live with a period of low returns, and I'm happy to live with it.
And Kalpen will book some profits to invest in equity.
I told you, over the last 3 months, the gold exposure had gone up to around 20. It has come down to, I have booked profits to around, back to 13, and I'm wrong. It continues to go up.
I think the bottom line is that we all need to have exposure. We need to build it a little systematically and hopefully, be well diversified across all of these asset classes. That's what the market is teaching us, and that's definitely what the panel's views are at this point in time. Thank you so much for this conversation. Thank you.
Really appreciate it. Thank you so much.
All right, so there you go. Gold, silver, crypto. We've got you covered completely. No matter the asset class of your choice, you will find the sharpest views right here in this room. So let's move on now. We're moving to the new consumer economy where most successful brands are no longer being built as purely digital or purely offline businesses. I mean, it's neither physical nor digital. The next wave of breakout companies is blending distribution, experience, trust, and data across both of these worlds. In other words, the future is increasingly phygital. And many of the startups which are preparing for their public market journey are being built exactly on this model. Let me call Chandra back on stage to take this conversation forward. Of course, Chandra is looking at this startup world for so many years with such close proximity. And I think, Chandra, the conversation I remember around COVID was all about just pure digital. Everything is going to be digital. And now you realize so many of these brands, consumer brands, whether they're in, makeup or whether they're in, even in the finance world for that matter, they're all talking about having, or food delivery or, any of these spaces, they're all talking about having a physical presence as well. And what's interesting is at that point, the idea was digital, higher margin. Why go physical at all? But that seems to be changing. What's happening here?
What's happening here is what the panel will tell you. But Surabhi, I have to tell you, you were talking about portfolio allocation. And the only thing I was thinking of is we can do all this portfolio allocation only if we get good appraisals. So let's hope the Iran-Israel war doesn't have an impact on corporate salaries for, FY27.
See, 1 year it's trade war, 1 year it's geopolitical war, 1 year is COVID,
1 year India
1 year
lost
is
the World
global
Cup.
slowdown. I think the audience gets our drift. I think they know what we're talking about. But we live in hope. Yeah,
Right.
it's a growing
But,
economy.
No, but talking about this panel, these are brands that all of us would have used at some point, from beauty to ceiling fan to mixer grinder to protein bars to protein shakes. It's all around us, and it's only come up in the last decade, which is quite remarkable. We've been so inured to the HULs and the PNGs of the world, and these new age brands are giving all of them a run for their money.
And
So-
getting acquired at top dollar valuation.
and planning to IPO without getting acquired.
Also.
Great. On that note, it's an absolute pleasure to welcome our speakers, Manish Taneja, the co-founder and CEO of Purple, Shashank Mehta, the founder and CEO of The Whole Truth, and Arindam Paul, founding member of Atomberg. Ladies and gentlemen, a huge round of applause for all three speakers. More importantly, all of them are Mumbaikars. So startup action is not just happening in Bangalore. A huge round of applause for these Mumbai-based founders. Thanks. Thank you very much, Manish, Shashank, and Arindam for making time. So, you know, the scope of this panel, we called it Fidgetital because that is what increasingly every startup is today. From Atomberg to Whole Truth to Purple to every other important brand I can think of, from Licious to everyone has to have an omni-channel presence. So what is happening? Does it mean that there is only so much you can do with digital, or, you know, even in a digital world, do people need to see and feel their products? Does that increase trust? Maybe Manish, you can start and the others can chime in.
Well, thanks, Chandra. You know, we started 14 years ago as an online platform. We moved offline on the back of our data about 2 years ago, and currently that business is growing at roughly 400-500% year on year, although it's still small. Look, my sense is...
So for the benefit of our audience, tell us about Purple in maybe 60 seconds. People who haven't
You know, Purple
visited
is an
Purple yet.
omni-channel beauty retailer in India. We retail many brands across Unilever, P&G, L'Oreal's brands. We are a very unique retailer because roughly half of our business comes from our own brands. So we've been brand builders along that journey. Our data tells us all the gaps that exist in the system, and then we kind of either work with D2C brands to create those products, or we end up creating those products on our own. And so that journey began about 14 years ago. We are 3 IITians. We are 3 men who started a beauty business, quite unheard of then. And then we went offline about 2 years ago. Today we operate about 180 stores in India, primarily focused on 2 geographies, which is Kerala and West Bengal. We are market leaders there by a big margin. And, you know, my reason of going offline was, I think a lot of premium products deserve experience. It's hard to buy them online. People want to touch and feel those products. I don't think online we have still been able to make headway in certain categories like which need very, very high color precision like foundations, compacts. And I feel it's best to experience those products offline. So we started with a few stores. And, you know, coincidentally, they deliver similar EBITDA as our online business delivers in those geographies in a very short period of time. So we kept expanding. And this month we are opening 25 stores in India, out of which 13 are opening in Kerala and about 10 are opening in West Bengal.
Why do you love Kerala so much, or why does Kerala love you so much?
You know, I think Kerala is a very unique geography. So one, you know, it's there is no urban-rural sort of concept there. I think there's a lot of remittance that comes from outside. It is usually a premium sort of economy to operate in. So if you are selling products which are not extremely mass, but I would say slightly on the premium side, mass premium, I think that geography takes it up quite beautifully. And look, our data was telling us that we were doing extremely well in Kerala 3-4 years ago. And hence, you know, we started doubling down on it, and it's never disappointed us, I would say, till date. I mean, many cities in Kerala continue to grow at 100% year on year even today.
Great. Arindam, Attenborough is a very interesting story because still a few years ago, none of us cared about what brand of ceiling fan we were putting in our house. And now somehow it is very aspirational to say, you know, I have an Attenborough fan in my house. I have an Attenborough mixer grinder. I have an Attenborough this and an Attenborough that. So tell us about that.
Yeah. No, I think two things have happened fundamentally in consumer durables and home appliances. One is a lot of the categories which were earlier push categories, say which were driven by trade networks and dealers, became pull categories. With people spending more and more in their homes, they started caring about which brands they are using, what the features are. And the second is, I've often mentioned that good supply creates demand. So the category had not seen a lot of innovation for 40, 50 years, and because of that, brands didn't command a premium or become aspirational. So the moment you address that consumer need, the latent consumer need of different designs, smart fans, energy efficient fans, I think the demand got automatically created. And so I think that's the reason, that's why we have been able to scale up a lot of our categories which we have launched in the last 10, 11 years. And also I'll come back to your previous question which you asked Manish around omni-channel, right, of why brands go omni-channel. In my view, is that it takes a lot of money to change a consumer's channel preference. And in fan as a category, 99% of the category was offline. When we started 10 years back, today it's about, it's still about 85% is still offline. So if we are present only online and trying to acquire customers online who typically buy electrical appliances offline, it would have cost us a lot more because not only you are convincing him to try your product and your brand, you are also convincing him to change his channel preference. And that typically costs a lot of money, and unless you have hundreds of crores to burn, I think, say for example, Flipkart and Amazon would have done it for books. Today, a lot of the books buying happens online. People have done it for headphones, earphones, but a lot of monies have been spent to change consumer channel preference. In India, predominantly, most of the country still wants to buy offline, and if you're not present in the channels where consumers buy from, it essentially becomes a higher acquisition cost for that consumer.
So what would your share be? How much are you selling through online channels vis-a-vis, you know, your presence in all the electrical stores that we visit?
So broadly, our split would be about 70% of it would be from offline channels.
Wow.
And it's a digital first omni-channel brand, largely offline brand, but most of the demand generation happens digitally.
That's like a digital first omni-channel is like a paradox in itself.
Yes.
Would the breakup be similar for you, Manish? Like 70% on offline?
Look, today it's because, you know, we are not a single brand company. We are a online retailer. So obviously our market online was quite large. So we are today, so look, 3 years ago we were 100% online. Today we are about 70% online and about 30% offline. I completely agree with him. You know, it's very hard to change channel preferences. So, you know, there are women who drive 18 kilometers on a scooter to come into our stores and buy. I mean, this happened in Kottayam in Kerala. You know, she genuinely wanted to experience all our products, and we are able, we are also able to premiumize the experience in stores. You know, 10% of our revenue comes from Korean beauty products in Kerala.
Wow.
These products are typically priced at, I would say, 5 or 6 times the average price of a Unilever product. So, you know, there is this latent demand for people to experience premium products, premium textures, premium brands, premium features. It's best to experience it offline first before you sort of end up buying online.
Right. In a sense, if I look at the three of you, you also embody, you know, the new Indian customer. I remember Snapdeal's Kunal Bell used to say that, you know, if you look at Gen Z, Gen Alpha, they don't want to use brands used by their parents, which is why they navigate towards new brands. It's opened up a whole new opportunity. And Shashank, you have managed to very successfully tap into this whole wave we are seeing in terms of awareness of protein, clean label, healthy label, you know, that kind of trend. I don't know if it's a trend or if it's a very strong secular direction. And you come from a background in FMCG. How has it been for you to unlearn the traditional way a huge FMCG operates with, you know, a lot of distributors, trade channels, to building a protein brand from scratch? And you're very clear that you're only going to be in protein. So it'll be protein bars, protein powders, protein shakes, and so on.
Actually, I'll start with the correction.
we'll always be a 100% clean label food brand.
Okay.
We just happen to be selling protein shakes right now, protein powders right now, but we make muesli, peanut butter, chocolates. In the future, we'll make cookies, sauces, anything in your pantry where you feel your current brands have been lying to you and your trust is broken. We'll try and come in and rebuild that trust by giving you 100% honest food. And hence, to answer your question, I think protein is a wave. It'll come and go.
But clean label is the overarching theme.
And even behind that is the need for honesty and truth from your brand, which I think is a 100-year, 200-year, 500-year fundamental human insight, which will not change because once no one likes being lied to. And we've been lied to by our food brands for decades now. That's fundamentally what we are trying to fix. The food we make is just the medium through which that promise manifests. Yeah. And on your question of large companies se kya sikha, like honestly, I think we are still in that 100-year-old business, right? Like we are making food somewhere and we are selling it to someone. Only some channels of reaching that consumer mentally and reaching that consumer physically are changing. So only the conduits are changing. Fundamentally, the business is the same. We are the manufacturer, we are the marketeer. There is some middleman through whom we reach our consumer and give them the product, right? And the fundamentals of FMCG don't change. You increase mental reach and you increase physical reach. If these two things increase at a similar rate, your brand will grow. What I had to unlearn was, unfortunately, all big companies and big brands which were born 70, 80, 90 years ago were born in an era of information asymmetry. So brands and companies knew things that consumers neither knew nor had any way of knowing. And then you put a star, like, a celebrity in the middle who came and said, listen, buy this soap, this is amazing. And you bought it.
Or drink this fizzy drink. Yeah.
Or, which I will never touch. Look at my six pack, but you should have it. Or a cricketer will say, buy this Saria for your home. And I'm like, dude, why do you know which Saria is the best Saria for or which tire is the best tire for my car? Those times have changed. And, we are building for the top 3-4% of the country. We are not building for the remaining 95. We are very clear about that. And that is this room. And this lot is, we just happen to have been born in Delhi, Bombay, Bangalore, but our experiences, our influences are the same as a New York guy or a San Francisco guy or a London guy. But our retail shelf and our brands are as if they're stuck in the 80s. So that's all that we're doing. We're talking to consumers as if they're smart, well-read, well-traveled, intelligent people, which is who I would like to believe I am. And why don't I have a brand that talks to me like my friends talk to me and tell me the whole truth and not, skirt around issues and sell it through a celebrity. That's what we're trying to do.
Right. You're very clear that you will only target the top 3-4% of India.
Yeah.
Because in India, the tendency is, oh my God, 1.3 billion people. Let me go after all of them.
That's a huge problem. And I don't know, I think half the people who say that are lying to the audience and the other half are lying to themselves. Because most large brands in the country, if you see in the last 2 decades also, no matter what they say about hum duniya mein sabko bechenge, 70% of their top line would be coming from the top 5% of the country. Because that's where the wealth is. Unfortunately, the income disparity is high and it's going even higher, right? Like we don't really have a middle class. We have a top class and a bottom class, right? So we are very clear that we are making for the top 2-3% because the rural tier 3 parts of India, they have a problem of undernourishment. They actually need cheap, calorie-rich food to reach them. And the Parle-Gs of the world are doing a great job of that. No one in the world has a Parle-G. कि 5 रुपए में एक बिहार के लेबरर को 4 बिस्किट अपनी चाय के साथ मिल जाएंगे, वो दुनिया में कहीं नहीं होता. यहाँ पे किसी ने क्रैक करा है, great. But why do I need that? Like I am sitting in front of a computer for like 14 hours a day. I am not.
You don't need a Parle-G.
Yeah, तो मैं तो overnourished हूँ. मेरे को too much calorie का problem है. Why isn't someone solving for me? That is the real insight that we are going after. That you need something else.
Got it. The other commonality between the three of you, apart from the fact that it's a new age brand targeting the new age aware user, rooted in Mumbai, is that all three of you have IPO ambitions. Arindam, I don't know how much he can tell you, but we know that they have mandated bankers, so expect an IPO soon. Arindam, anything that you want to say? You're allowed to say.
I think I will not comment on this.
Okay, Shashank and Manish, tell us about your plans. Because you do have plans to list.
Well, look, I think there are massive benefits of being public. Obviously access to capital becomes one of them. I think personally as a founder, I feel it's great to be public at some point in time because, if you look at like all companies built in India, most of them which are very large were built while being public. So there is no reason for us to delay it beyond a point. I also think, when you have private investors on your cap table, you end up sharing a lot of information with them, which, at some point in time, all information will become public and hence transactions will become much easier. So, look, we will go public at some point in time. We don't have a hard timeline in mind in terms of when, but, maybe in 24 to 36 months is what I feel it should be. If it's earlier, great. If it's in that time frame also, it's great. I mean, it's not a milestone that I am eagerly looking forward to. But I think it's an important milestone that all of us will have to go through in our journeys at some point in time.
Right. Shashank, if I look at your space, you're clear about an IPO because there's been so much of M&A, you had HUL buying Minimalist, Marico has been buying brands. Why not take that exit opportunity? Why do you want to list on Dalal Street and then do this QSQT cycle?
Because for me, the mission matters more than the company. And I'm very clear that if I sell it to any big company, they will kill the mission. So it cannot be sold. This asset is not for sale. It's very clear. So, and since we've taken VC money, we have to return that money. The only option is go public or find a pool of capital which is, very patient, very long term, very large check. And they give returns to my early investors and then they stay invested and keep us private for a long time. Those are the only options available. It's very first principles for us. And actually, we are inherently, our promise is that we have nothing to hide. So, hum inherently public hai. Matlab, we just show you everything. I'm happy to show you anything in the company. You can come see my factory, you can come see my people, you can come see my P&L.
We can come see your recipes, everything.
Sorry?
I said we can come see your recipes, everything.
We write our recipes on the pack. We are so stupid that we write all ingredients on the front of pack and the exact percentage of each ingredient on the back of pack. That's the recipe, right? So, when you have nothing to hide, public or private, or we are operating that same way only. And yeah, selling out is
What timeline are we looking at?
I think, as Manish said, I think it will be 3 to 4 years for us. But we are not timing it. We know what shape of P&L we want to have before we go public. That can happen in 3, that can happen in 5. I think
that can happen in 2.
Sorry?
That can happen in 2.
I don't think so unless last 2 years have surprised me beyond my wildest dreams. So I can't count on that happening. But if that happens, then maybe, yeah, who knows?
Great. Okay, Arindam, don't worry, nothing on the IPO. But let me talk about, the growth and margins of running an omni-channel company vis-a-vis a purely digital online company. The public perception, at least, about purely digital online only companies is that they need to keep burning more and more capital to acquire customers. The path to profitability is pretty difficult unless they reach a certain scale. How is it for you? Because the expectation of any digital business is also that the pace of growth will be far higher than a traditional bricks and mortar business. But how does this stack up when you're running an omni-channel company?
Yeah. No, I think traditionally in our categories, I'll tell you the fundamentals, right? In offline, power is with the brand because there are tens of thousands of retailers, right, who are selling electrical products. So margin power lies with the brand. In online channels, there are 4 or 5 players like the quick com players, the Amazons and the Flipkarts.
Who dictate distribution.
So the power, margin power lies with the channels in the online world. And that's also the reason if you look at the US market. So most US FMCG brands will not be trading at the same PE multiple like how Indian brands trade. And the reason for this is in India, the power lies with the brand. The HULs, the PNGs of the world, they have all the margin power. And if you look at their EBITDA margins also, the EBITDA margins in India will be a lot higher than what they are in the global markets, where trade is organized, where you have modern trade, which is again organized. You have e-commerce and all of this, we are organized. So as distribution becomes more and more organized, the margin power moves towards the channel and less towards the brands. So inherently, any business today in India whose like good chunk of sales come from offline channels, they will be slightly more profitable than online only brands. I think that's the fact. The second thing is, again, if you are running an online only business purely reliant on performance marketing and acquiring customers on a daily basis, it also has a point of diminishing returns. So beyond the point, it's very difficult to get to economies of scale, which again, if you are building brand, if you are building distribution, if you are spending on ATL, wherein your brand, your baseline sales keep on increasing and you are not dependent on ads for a good chunk of your sales, the profitability increases. So any good omni-channel brand, I think the profitability should keep on increasing as the dependency on performance marketing and the dependency on online only channels keeps coming down. And I think we have also seen that play out in our journey in the last 5-6 years.
Great. As we come to the last 3 minutes, Manish, the other thing that I want to also ask you is, should new age companies do more in gaining the trust of mutual funds, retail shareholders? Because if you look at most of the IPOs, in the last year, except for 1 or 2 which are still doing well, most of them are below listing price. Many of them have come back to raise capital. Profitability timelines have been pushed out. So in such a scenario, has it become more difficult for the next wave of new age IPOs? How does one sort of repair that trust?
Look, to your first part of the question, should you educate investors well in advance about what your company is and how you're faring against what you promised? My answer is yes. I've been meeting public market investors for 2 years now. Although we never had an IPO in mind immediately. I've done rounds in Singapore, I've done rounds in Bombay, I've done rounds in Hong Kong. I genuinely feel that if somebody is going to write you a big check, 200, 300, 400 crores, it's always good to know that person for 3-4 years, and it's always good for them to know you for 3-4 years, and for you to be able to show the track record that this is the kind of top line and bottom line growth you showed, and this is what you delivered. So I'm in the camp that, it's good to keep people educated, because they have so many companies to track. Why would they know about you when you come at the time of the IPO? It's best if you've met them 2-3 years before. Look, I've not looked at the statistic of which companies are below IPO price and which ones are above. I thought many of them are above. Ixigo is probably above. Cartrade is above. Grow is above. Meesho is above. Zomato is above. Lenskart is above. So Policy Bazaar is above. I think there are great companies, and then there are okayish companies which will also become great at some point in time. I don't have any reasons to doubt. I think these are the only companies that will provide faster growth opportunities for investors. So my sense is interest will remain quite high. I don't see it to be lower, although I haven't met anybody in the recent time, like in the last 2 months. So I don't know what impact Anthropic or Iran war has had on their sentiments. But I think these things come and go. I mean, you can never time it. You go for your IPO when you're ready. People will give you a price. It's a one-time thing. At some point in time, you will feel, "Arey, ye to kam mila hai." But market will re-rate you once you start performing for 3-4 quarters. So why worry so much about one event? It's not like I'm going to sell in that event any which way. So if people want to sell, it's up to them whether to accept that price or not. I mean, beyond the point, isko aur belabor karke koi fayda nahi hai. This is a milestone you have to do. Just go ahead and do it. And then after that, there are smart investors on the other side who will see the value, and then the stock will re-rate, or it will re-rate down, if you are performing bad. So both ways, I think it's just a event in your life. It's like one fundraising event, and then just move on. Like it just takes effort, and I know it takes a lot of effort, but probably takes twice the effort of a private round. But look, it's just one event. Just get done with it. That's how I would be.
Okay.
I mean, that's how what my personal feeling and my advice to myself is.
Right. Time up. But since we are talking wealth, we should also talk health. Health is wealth and all. So quick fitness or health tips from Arindam and Shashank. Shashank, don't just say buy whole truth.
I can tell you Arindam's, he eats our protein, that's why he has these muscles. But I think sleep 7 to 8 hours a day, that's where it all starts.
Okay. Arindam?
Again, sleep and work out 3-4 times a week and do it regularly.
Sleep how many hours?
7-8 hours a day.
Great. On that note, thank you all very much and all the very best for your IPOs whenever they happen. Thank you very much.
Thank you.
Thank you very much, Shashank, Arindam and Manish for a fantastic session. We now turn to an asset class Indians understand instinctively but are increasingly evaluating more strategically. Housing demand remains strong, office leasing has surprised on the upside, and new structures have made real estate far more investable than it once was. But this is no longer a uniform market. The real question today is where will the next surge in real estate come from and where is the real value? To lead this conversation, let's welcome Surabhi Upadhyay from Moneycontrol back on stage. So, my theory is Surabhi does sessions where she has money on the table, gold, real estate, equities.
Couple of billion in each one of them. Yeah, Chandra. I'll tell you where all of it is after the event is over.
Great. So with that, best of luck with your panel, Surabhi. Looking forward to the next real estate surge. I'm sure some of these founders sitting here will lead to that with their ESOP buybacks, creating and minting many more millionaires in Mumbai and Bangalore.
All the founders sitting here are using the grade A office space that is really driving the India office market, the commercial real estate market, and now there is a REIT sort of play to it. So I think the times have been never more exciting for real estate as an investment class. So yeah, looking forward to this one.
Great. Best of luck, Surabhi.
Thank you.
With your panel.
All right. Well, with that, let me call on stage Ashank Kothari, MD Real Estate at Brookfield. Ashank, thank you for coming. Ghulam Zia, who's the International Partner and Senior Executive Director at Knight Frank. Ghulam is an old friend who's been telling me for the past, I think, 10 years not to invest in real estate. The only person who's from a real estate consultancy who's been saying, no, don't bother with residential housing. I'm sorry, I just put it out as a caveat before we can start. And of course, let me bring in our third panelist this evening, Abhinandan Lodha, founder and chairman of the House of Abhinandan Lodha. So I'm wondering whether they say save the best for the last. We've done equity, we've done crypto, we've done private markets, we've done private equity, gold, silver, and now here we are, real estate. But I must say that, as someone who's been watching and tracking markets for several years now, like I said, I think the times perhaps have never been more exciting from an investor perspective when it comes to real estate. What we've seen post-RERA, a sea change in the way the sector is regulated, what we've seen with the anvil of REITs, formalization of a market that was earlier fairly scattered and fairly sort of geographically split, with regulation being hazy in parts. So I think we've come a long way. With those opening thoughts, let me get some initial thoughts going. So as someone who's a very big institutional investor, how are you looking at things, Ashank? I was looking at some stats. I think capital that flew into that came into the Indian real estate sector was around 6 billion a year in 21. As of 2025, it was 14 billion. You yourselves at Brookfield, you folks are managing, I think, assets of close to 12 billion, right? Here in India, just in India alone.
Yep.
What have you made of this massive transformation in this market?
That's a great question. When I look back, so Brookfield entered India in 2009, and we did our first real estate investment in 2014 when we acquired Unitech's commercial real estate portfolio in the north and Calcutta. And this was in 2014, and we're in 2026 now. So I'll give you a little bit of a lens in terms of what has changed, both from an occupier standpoint as well as from an investor standpoint, especially on the office side. From an occupier standpoint, in 2014, the occupiers were looking at India as a cost-saving strategy. They were thinking of India as, where they can relocate people or hire people to, save cost from anywhere else in the world. Today, that same occupier is looking at India as a mission-critical strategy, where, the same GCC that had taken space from us in 2014 and was doing payment processing, for example, that same GCC today is running the global AI strategy for that company out of India. So it's a very interesting transformation in terms of, the talent force itself has evolved a lot. The requirements from these tenants, as the high value innovation work has increased, the requirements they have from the buildings itself has changed quite a bit. And from an investor standpoint, when we did our first investment in 2014, there was very limited institutional activity, I would say. There were no REITs. Governance was limited. It was a very fragmented ownership. Today we have 5 REITs. You have 14 billion of institutional capital that has come into the sector. More than 50% of that institutional capital has actually come from domestic investors, which again shows the maturity of the market in terms of how the asset class for office and for other commercial real estate sectors is being looked at by investors. So it's been a significant transformation in that sense. And from our perspective, we see the runway being very large because the best, most optimistic estimates for commercial real estate, which includes office, retail, warehousing, everything put together, is close to $40 billion in India, in a $4 trillion economy. In the US, the same sector, commercial real estate, put together is $20 trillion in a $28 trillion GDP. So in the US, you're at about 70% of the GDP is what the sector represents. In India, you're less than 5%. So we see the runway being massive in terms of where the growth will go.
The AI disruption notwithstanding, the worry that you'll just need lesser people in offices, so lesser office space.
That's a great question. So I have a slightly different take on this. I think it's a bit of a, I was talking to somebody the other day and they were like, "Thoda Videshi anxiety hai ye. This doesn't translate well in India." But if I really double click on that comment, right, it's AI, generative AI, effectively took the world by storm in 2023. We had 85 million square feet of leasing last year.
Yes.
So that's 2 years after the fact that generative AI came onto the scenes, that you had a record-breaking, 85 million square feet of leasing that's happened in the country. If we were to see any headwinds, we would have started seeing the cracks already by now in terms of just how AI has, taken over. So when we double click on this and we talk to tenants and we talk to actual users that how do you think about India in the context of AI, they actually are looking at India as a better value proposition because AI is making the talent much more productive in India and they're trying to create AI capabilities and analytical capabilities in India, leveraging what AI is doing. You still need a human element. So that makes the expansion story of these GCCs a lot more, interesting in the Indian market versus anywhere else. So I personally think that, this 85 million figure will go to 100 million, not despite of AI, but because of AI, right? And because it will be a very positive force to the overall thing.
I really, really hope so because we need jobs in this country and we need that human element for sure. So let me come to you, Ghulam. The office market, doing really well, but give us your bird's eye view. Where are we at? Middle of the cycle, early, things are just starting up like Ashank is saying. What's your reading?
First of all, Surabhi, giving only 17 minutes to real estate is not fair. Starting with where Ashank left it from, he spoke
because
about
this panel is more or less in agreement that things are going very well. You need more time when there's disagreement about what is happening.
Yes. So while Ashank, painted a very rosy picture for commercial, and I'm not going to contest what he's talking about. And one last piece of data just to add to whatever you said, the Q1 of this calendar year is going to be better than the Q1 of last year, where we did 85 million. So if there is any further hope to add to what you're saying, that is where it is coming from. However, the job losses that we are talking about have started mounting. So let us not turn our face from that these are things which are happening in real time. Yeah, there are a lot of those in-depth debates going on that AI would add more jobs. There would be a few jobs which will be left redundant, but you will have more jobs added, and the net of it will give a benefit to real estate, commercial real estate. However, let's not just completely, ignore the signals around the corner which are very, very pronounced. So while, as I said, the Q1 this year has been fantastic, so had it not been for lots of these global headwinds, etc., we would have perhaps touched, if not 100, at least 95 million this year, because if we have done 85, but 3 more quarters to go, and I would say we need to be cautious. I don't want to, for no reason, create so much of a, positivity. While I am myself down under, we are worried, and I'm sure if we separately said, we would actually share some kind of concerns on which way things are moving. But let us not ignore the evident signs of AI impacting commercial real estate. But so far, things are going good.
I really appreciate your candor, and that's how you've always been, Ghulam. You've called out what you see. But is some of that uncertainty showing up in conversations already? When clients talk about future leasing, their plans ahead for this year, we're in a new calendar year. Is some of this hesitation already showing up?
Yes, yes. So the first sign of that is delays. Most of the transaction in Q1 of 26 I'm talking about have begun at least 3-4 quarters back. That's how long it takes for a transaction to, be signed on the dotted lines. So whatever happened this Q1 is not something which was started on 1st of January 2026. It's something for which preparations were going on, sightseeing, analyzing, comparing, negotiation, and whole lot of things go behind it. So now whatever is happening, the impact of this will be seen in Q3 or Q4. Even second quarter, Q2 will also be something where you would have enough of momentum, because of where we started last year was a great year. 85 was outstanding, unbelievable, because that was almost 20% growth YOY. Unforeseen. And here we have already a very large base. So here we have to be extremely cautious with whatever numbers we're talking about. And I would say let's wait for at least 2 more quarters, because the slowdowns are already coming in. A lot of people are taking a little more time than what they would have taken otherwise. So I would say let's wait and watch.
Fair enough. All right. Abhinandan, you represent that part of real estate which traditionally has been the go-to area for Indians, right? Much before the equity cult kind of dawned upon us, and we had ETFs and all these financial products. It was always real estate for Indians. Now, in a far more complex world with a lot of financial investment choices, how is physical real estate actually competing with those choices? And what do you see ahead in a year which is fraught with risk? We discussed AI, there is the macro risk of the war. How do you see things playing along?
So I think Ashank and Ghulam Bhai have made very pertinent points on commercial real estate. As far as land goes, or as far as real estate goes, I think the base level of looking at real estate has to be through the lens of land. And inherently, Indians have loved the concept of buying land. The Zamindar concept in our mind has been extremely powerful since forever. As far as the change in financial assets goes, I think today with the kind of structures available, with the REITs available, with digitization happening, in my mind, the ability to tokenize land is around the corner. The ability to tokenize real estate is around the corner. It is not if it happens, it is when it happens. The Indian today has shown that the desire to participate in land and real estate in any structured manner is actually extremely high. What we saw till probably 10 or 15 years ago was a desire to participate in real estate only either as pure long-term investment or as consumption in residential real estate. That's changed now. If you see most people, the allocation to real estate has moved from consumption real estate alone to investment real estate. And that too is actually moving more and more towards tier 2 India, rising India. And the kind of returns people are seeing in rising India, along with the wealth which is compounding there. You'll be surprised to see places like Ayodhya Ji, Vrindavan, Amritsar, Nagpur, etc. In these places, the land prices for the retail buyer have gone up by 4 times the last 4 years.
In the last 4 years?
In the last 4 years. And these are places where today infrastructure is getting built, local money is available to consume, people are wanting a lifestyle upgrade, founders are getting created in these areas, and now institutional players are looking at, that these are places where we should not be missing out on. So what was actually seen as, the back of the beyond is actually becoming front and central. People are recognizing the trend that it's great to be a part of Mumbai, Bangalore, Delhi, etc. But if you really want to multiply your money in Indian real estate, you have to be a part of the rising India story.
But are valuations still, at least within the periphery, the boundary of palatable, or have they now started reaching the excess zone? I mean, 4 times in 4 years, you said.
But you have to see the base, Surabhi. Started, for example, Nagpur, you could potentially buy land at 1,000 rupees a square foot 4 years ago. At 4,000 rupees a square foot, prime central land available in Nagpur, 0 mile area. It's very, very difficult to go wrong. And the kind of projects getting announced there, close to $20 billion of investments have been announced in that city in the last 9 months. Most of it will fructify. When this kind of investment comes into an area which is already quite rich, and Nagpur, you must see what Mumbai is to Maharashtra, Nagpur is to Vidarbha. So most of these places, be it Vrindavan, be it Amritsar, be it Nagpur, be it Goa, etc. There's a very, very logical reason for people to remain present in these areas, for infrastructure to get built in those areas, and now wealth multiplication is happening. So my personal sense is digitization, the ability to look at rising India is going to be the trend in the future as Indian real estate grows, and it's an essential part of what every urban Indian is going to do.
Now, I want the panel's opinion now on what the current geopolitical situation and what this war could imply for Indian real estate, and obviously there are different segments to it. So, Abhinandan, let me start with you. Now, if this prolongs and if Indian macros do become challenging and, equity market sentiment is anyway what it is, how closely are the two markets linked purely in terms of sentiment? When equities go through a prolonged bear phase, post-COVID, I mean, are you actually seeing people move to physical real estate, to buying land? Would you expect that to continue if we continue to see a prolonged war?
So 2 things, Surabhi. First, on the war perspective, for the last 10 years, Indians have on an average been buying close to $80 billion of real estate over the last 10 years in the GCC. Last year alone, Indians invested close to 1 lakh crore in the GCC for buying real estate. That's essentially as large as the size of the 3rd largest Indian real estate market. Now that money was going there for safety, it was going there for appreciation, it was going there for the safe haven status of those places. I think that is significantly under question now. This surplus money will get redirected to some extent into Indian real estate. And that's actually, if this continues for the short to mid term, you will see more and more people investing local money into Indian real estate than otherwise. What if the equity markets come off? My personal sense is you may see some slowdown at the super luxury end of the market, which is why we Mumbaikars are more used to seeing. But you go to a Surat or you go to an Ahmedabad, they are not really concerned too much about how much the stock market has come down today. They are far more clear their business is making money. If the consumption story in India is strong, if the macroeconomic story is okay, I don't see any part of the Indian real estate market slowing down except the absolute top end of super luxury.
Interesting. And I'm glad you brought up that point as well, Ghulam. I think a large number of investors in Dubai's real estate markets were Indians. So whatever is happening there, first of all, your thoughts on whether it's going to be temporary or whether it really shakes up the market and there's a bit of at least a medium-term issue that crops up in pricing, in interest. How does that play back into Indian real estate? Be it on commercial, be it on, I'm talking purely from an investment perspective.
Well, first of all, please excuse me if I'm not using that D word. There is a ban. We can't talk about that city that you want me to talk about. Yes, the concerns are there. Why from Middle East people are looking at some better investment opportunities, that lifestyle, etc. That question of a peaceful life is challenged. So there are alternative investments discussed, and openly quite a few may be actually taking that call of relocating or looking at other assets. But what is the impact on Indian real estate? If that is a question.
Will that money look at in real estate investment opportunities now in India is my question.
See, first of all, you actually saw a flight because they wanted to go away from India, so they landed up in one place or the other. So if you are forcing them to get back, that's a big question. Will they? I would rather say they will look at elsewhere, or they will talk about some other better markets to invest. And this money, look, repatriation, if that is a question, I'm sure there are experts sitting over here who can tell you that if you have taken some money out and then RBI was chasing you, getting that money back is going to be even bigger of a problem. So the question is, you had some money here in India, you are buying something here is one thing. But if you are an NRI, if you are living in other countries, be it Middle East or anywhere else, I don't think it ever made sense. I do see a lot of these developers claiming that hamare paas NRI buyers aate hain, but buyers know here this currency is going down at 3.5 to 4% every year, if not 5. So there is no sense of bringing in money from abroad and buying real estate in India, where you know that even if the property prices are going up 7-8%, the money itself is coming down 3-4%. And that also, the 4-5% or 7-8%, or even, I'm sure last 3 years, we always talk about the rosy side of it. So last 3 years, the prices have shot up good, very well. But prior to that, almost 9-10 years, there was no appreciation. So if you look at a net long-term growth of real estate, even residential, it will not be more than 7-8% per year.
So you don't see the money coming, running back to India in a hurry?
I doubt.
Okay. Let's talk about this. The impact of war, if at all, Ashank, on the office market, which has been so steady as you just described. Will we see any sort of, price, I'm not saying damage, but any price impact, any demand impact at all?
In India?
In India, if the war prolongs and if we have real macro issues here?
Yeah, I mean, look, we have to take a step back. One, it's too early to really make a comment in terms of what the overall economic impact it will be. The world is a lot more connected than it used to be. But just taking a step back and looking at India as a whole, we have a lot of structural drivers in India that are not going away anywhere. Our demographics are the same, right? We have a very young country. You have 350 million people that are expected to be urbanized over the next 25 years. So to Abhinandan's point, right, these cities that he's talking about, there are real structural drivers that, in urbanization that is causing the demand for these things. Now when 350 million people are moving towards cities, that's the population of the United States of America. The consumption of real estate that happens, the build out of real estate that happens when 350 million people move to cities is massive. Even if a fraction of that is going to be office using employment. And again, we have to make a distinction between grade A office, institutional office, and then the rest of the office. Today we have 1 billion square feet. So to Ghulam Bhai's point, right, why I'm a little bit more optimistic than maybe he is because I'm making that distinction in my mind of what is institutional grade A office versus the rest of it. Institutional grade A office today is a scarcity product. It's not Still. It's not a commodity product. Out of 1 billion square feet of operating office real estate in India, 70% of it will be obsolete because it doesn't have the right ESG compliances, it doesn't have the right, power requirements, it doesn't have the right technical specifications. Out of 1 billion square feet, 20% is owned by institutions. And we're talking about a massive wave of people still requiring offices as the economy continues to grow. So from that perspective, I think we will still be able to make good waves on institutional office. And the commodity office is something that will get impacted and will get replaced by AI and by a lot of other things in the long run.
I think we have 2 bulls and maybe half a bear on this panel. So quick last 10 seconds. If I were to ask you best real estate investment in India for the next 5 years, what would it be?
Today I would say hospitality, right? A little bit biased. Abhinandan's a partner in hospitality as well, so I'm taking him into my corner to answer this question. But I would frame it this way, right? Office is more like, Dravid, and hospitality is more like Kohli, right? So, there is a lot of structural difference in the demand and supply drivers in hospitality, and it continues to remain structurally difficult to build, good quality, high-end luxury hotels versus the demand continuing to grow at a much faster pace. So that's where I would focus on.
Hospitality, got that. Abhinandan, best real estate bet next 5 years?
Rising India land.
Sorry, you missed that.
Land in tier 2 India.
Okay.
Absolutely. I think the kind of wealth multiplication is going to happen there. 20% compounding return over a 20-year period in any of these cities is absolutely on par for the course.
Ghulam, invest at all or no, sit on the cash?
Well, you know my views for a long time, nothing has changed, and you called me a half bear, I would say I'm a full bear. And there I would also, be worried about the last 3 years at least. We have seen real great time for real estate. Everything was, red hot. Somewhere some, sensibility has to come in. So whether you call it correction or whatever, any of these asset classes, I would definitely, my view for last 10 years or maybe more is the same. Residential real estate is definitely not for investment. Land, I would agree, but land is again, if most of these developers who sell land as options for gated communities, etc., typically a developer would have squeezed the last drop of profitability out of it. If you have guts, go and buy raw land, improve it, and then see it growing. A raw land where you know that a future piece of infrastructure will give you a direct benefit. That is where you should jump in, because that's where a huge profit is there. Typically, 1 ka 10 hota hai land mein, but typically developers would have taken at least 8 out of that 10. So 2 hi bacha hai, usme aap kitna survive karoge? So to me, I continue to be a bear again.
I'm happy with the bear because till the time we have bulls and bears, the market is in balance. Otherwise, frothy market running away, never a great story, right? Not for the long term. Thank you very much, gentlemen. Very interesting conversation. And definitely it's an asset class that's here. It's going to stay thriving. And I'm sure it will keep offering more opportunities and at least options to Indian investors. Thank you.
Thank you.
Thank you so much.
All right, thank you to our panelists. So there you go, real estate, compelling case, but maybe some caution is also warranted. Let's now quickly move on and come to one of the most closely watched fault lines in Indian markets. And I'm going to make a pivot back to equities for this one. The rapid rise of derivatives trading. Now, what began as a sophisticated institutional tool is now, let's face it, a massive retail play arena, if I could call it that. It's increasingly being shaped by complex strategies, algorithms, speed. The question is, are we entering a new derivatives battlefield? Algos versus retail traders. And how should regulation evolve to keep markets fair and resilient for whoever chooses to participate? To lead this discussion, let me welcome Mahalakshmi back on the stage. Emil, I remember last year's GWS, the first edition, this remained one of the hottest subjects then. It remains one of the hottest subjects now. So I am eagerly waiting to hear your panelists.
Oh, absolutely. So am I. It was one of the hottest debated topics last year. I don't think it is as hotly debated now because the markets have also sort of played a part in reining in some kind of, exuberance or excessive speculation. That was the fear last year and the year before. But nevertheless, we have a wonderful lineup for this discussion.
So let's straight away get to the panelists then. I think we've got Ananta Narayan with us, a former whole-time member of SEBI. He was on this conversation last year as well. I remember listening to him very, very carefully back then. We have Sundaraman Ramamurthy, MD and CEO of the Bombay Stock Exchange. Dinesh Thakkar, Chairman and MD of Angel One. And Anirudh Chaudhary, founder of Lama Capital. We also have with us Nitesh Khandelwal, co-founder iRage and CEO of Quant Institutional. Emil, over to you.
Thank you. Thank you so much, Surabhi. This is a wonderful panel, not because this is a hotly debated subject, but because we have got all the stakeholders in the derivatives market on this panel. Please, gentlemen. Here. You can, I'll go to the center. I'll come to the center. So I was saying we have, all the stakeholders in the derivatives market on this panel. To represent the regulator, of course, now he's no longer with SEBI, but totally understands the regulatory perspective, and that's what he brings to the table now. We have one of the leading exchanges in India. We have a
leading broker, we have a prop trader, and we have somebody who's also into derivatives education. So you can't ask for, if we were to have, a committee of sorts to decide what should be the policy direction for derivatives. Well, we have all the stakeholders right here. Thank you so much, gentlemen, for sort of making time for this discussion. This discussion is important for two reasons, what has happened over the last 2 years in the derivatives market. First, red flag was, the amount of derivative trading that was getting done, which SEBI was concerned about, RBI was concerned about, and then SEBI put out some kind of a study to gauge what was it really doing to people. And they came up with this number of 1.1 lakh crore loss by retail traders. Based on that, SEBI took some initiatives to ensure that, that excessive speculation, of course, people can dispute that, whether it was excessive or not. And then we sort of reined in the market to some extent. And then the next big news point was the Jane Street order, which sort of opened everybody's eyes to what is the power of technology and HFTs in cornering a lion's share of the money that can be made in this market. It was, SEBI talked about 4,600 crores of unlawful gains by just one firm. And finally, the order was passed. Now it is sub judice. So that's another point. So if this is going to be a technology game, which is what it looks like, it's about speed, technology, a lot of math, algorithms, etc. And if retail traders are anyway in this setup going to make losses, how should we really think about it and respond? Anand.
So first of all, thank you Mahalakshmi for having me, and lovely to be in part of this this great panel. And compliments to Moneycontrol. Look, I'll quickly summarize. I'm no longer SEBI, by the way. I don't speak for SEBI. SEBI is not bound by whatever I say. I'll quickly summarize what the regulatory concerns or thought process really was. There were three sets of concerns. First is, as you mentioned, the high degree of retail losses. So FY25, we had over 1 crore unique investors trading. 91% of them made losses. And the total losses, including the profit makers, was well over 1 lakh crores, 1.06 lakh crores. So that was one concern that was there around investor protection. The second concern, which I have to emphasize, was around the market structure. On expiry days, what you saw was that the delta or the cash equivalent being traded in options market on expiry day, index options, was 700 to 800 times the underlying volumes in the cash market on the constituent stocks. Now, this is almost like smacks you of LIBOR, where a very small market, determines the fate of a much larger market in terms of consequence. Now, that is a very unstable situation, which no regulator, whether first-line regulator or second-line regulator, will ever like. The third issue, which is a more generic issue, and in fact, even I saw a tweet from Nitin Kamath around this, and I've been saying this for a long time, which is that generally, look, derivatives are required. Let's face it. Speculation is needed. Derivatives is needed. You need that for price discovery, for market depth, for hedging. But typically, the structure which makes a lot of sense for all of these things is when you have 60 to 70% of your contracts beyond 1 month. In the case of India, even today, a huge majority of the contracts mature in the next week. Forget about, beyond 1 month. So the tenor was not great. So these are the three concerns that we've always had. On the flip side, to be real, a regulator has to be very thoughtful when they come in between willing buyers and willing sellers. With the best of intent, we can be a bull in the China shop, taking steps which actually has unintended consequences, which brings down the entire market. So we have to be very careful about whatever we do. Second counterpoint, we are also aware, and this is a real politic we have to be aware of, whether it is exchanges, clearing corporations, brokers, there's a whole ecosystem that depends on index options. I've seen cases where 60 to 90% of top line comes from index options. So if you suddenly say, I'm going to come like a ton of bricks on this, it has consequences. So this is the lay of the land which we had to, grapple with. A quick point on this point about technology.
Yeah.
Look,
you do need market makers in the ecosystem. And the reality is when you have a colo, when you have a model-based, market provider, risk provider, that helps bring the liquidity in the ecosystem, and they have the advantage of being able to see the prices from before, and the advantage that they have a model telling them what to do at very, very short intervals, right? Now, the way I would put it is the following. If you are a small trader trying to play that game, which is a very, very short time frame, I want to buy and sell and get out, then your odds are stacked against you because you're fighting against a model which has access to immediate data. But if you're a normal investor looking for medium-term investments, even if it is a matter of weeks or whatever, this liquidity is good for you because it helps to bring down the cost of the transactions. And therefore, as long as you're playing the right game and not playing the game that the HFTs are playing, you're in the right space.
Right. Fair enough. You've made so many points, it's hard for me to remember and, ask questions around so many things. But, one of the important points and the hotly debated point that you made is even now, significant part of the volumes is in weekly. But I'd want to come back to you in terms of why did you not think about scrapping it completely and keeping one? But before that, are you concerned as an exchange that this market structure, do you think is it skewed? What is your defense for having weekly options, apart from the fact that you're a listed company and you have to make money? Quarter on quarter, you're being asked questions.
Yes, indeed, we are a listed company. We need to make money. But before that, we are actually a market infrastructure intermediary. So we have a larger responsibility to the market as well. If a simple question is asked whether weekly options are needed, the answer will be yes. Whether the weekly options only should be there, if that question is asked, the answer is no. A derivative market is supposed to help people take a view on the market on a future period of time. If everybody is going to think only about the next day and next week, that does not look like a healthy mix. So therefore, clearly you want people who will be having views just not on the next week, but also on next month, next to next month, next to next to next month. Fortunately, in these type of equities type of market, the backwardation, what you would see typically in terms of commodities, do not exist. Therefore, amenable for many people to have views on the longer period. So clearly that would be the need for the hour. The question is, do we have enough facilitation for that to happen? And if we need to have, what more should be done? So probably in terms of products, in terms of participants, in terms of cost of trading, how do we differentiate and encourage a longer term? Because simply extrapolating the cost of a weekly to a monthly and to a bi-monthly or tri-monthly is going to make it exorbitant and not interesting for anybody to trade. And if institutional participants do not have a product which is worthwhile and a capability to participate in a longer term option, unfortunately the market microstructure will narrow it down to weekly, and we will continue to have what the situation we are currently having.
Right. Dinesh, first of all, does it concern you that predominantly retail investors, because yours is a retail broking platform, end up making losses? In any place, if people are going to continuously lose money, it's not going to stick with you as a business. And how would you respond to the fact that, still predominantly volumes are dominated by weekly? And what are your thoughts in terms of, is a behavior shift possible at all? What more needs to be done?
Definitely it concerns us when retail make losses, because none of the organization can sustain by just acquiring customer and they are making losses. And again, we have to go back to the market to acquire more customer. So not that I am educating or endorsing this kind of behavior, but usually what I have seen from my 30 years of experience in market, we are dealing with young population. So they are impulsive, they have very high aspiration, and they want leverage product. It is not they wanted a weekly product. Before that, BS used to have that Badla trading, which was banned after Ketan Parekh. So when we introduced future and option, it took almost 1 year to 18 months to become popular. So what does retail want? We believe that they are doing some sophisticated strategy and all that. But most of the people who are coming with an amount of 20,000, 30,000. They want to try it out. They have heard about lots of wealth can be made in capital market. So they want instant kind of gratification. So they want leveraging in whatever they are doing so that they can check what is happening. But if you look at kind of like numbers, what SEBI has produced, that 93% lose money, that you are looking at a very narrow time frame, 1 year and with just one product. But if I take a balance sheet of an investor who started their journey trading in weekly options, first year they make losses. Slowly, gradually they learn and they start moving towards SIP, moving towards mutual fund, buying ETFs and all that, where they make money. See, data suggests that, data clearly shows that in 10 years we have seen a phenomenal growth in investor population. From 2 crores today we are around 22 crores. We may feel that, okay, we have seen an immense rise in volumes in option. But at the same time, if you look at SIP, people who were doing SIP were around 72 lakh in 2015. Today it is 11 crore. At that point in time, I remember SIP used to get around 25,000 crore in an annum. Today we are talking about 3 lakh crore. If you look at retail holding in equity, that has gone up from 11 lakh to 82 lakh crore. So that means if I take all the combination in terms of what losses they have made and what kind of an AUM they have made, I think it's the same generation, same population who is investing in multiple products. All said and done, what I believe is that it's a regulatory role to see what is happening 360 degree, and wherever they find excesses, that should be reduced. I believe they should come out with lots of kind of like ideas how to build volumes in cash market. That is where a retail investor should start their journey, either in cash or ETF. They should work out how we can provide a better leverage in terms of intraday. Not that I want them to do it, but that is how the nature of this young population is. Right. If you are able to divert that kind of like youth towards cash and ETF, they can build a long-term portfolio.
No, interesting you make this point that, you're essentially saying that options is like the first touch point after which, investors experience equities and then become savers and investors in equities. But, isn't the mindset completely the same when you are a derivatives trader? You're really looking at, as a retail audience, this is my perception, I could be wrong, that you want to make quick money. That is what you want to, that is why you want leverage, as opposed to that, like SIP is like, put in money and sometime it will double or
Mahalakshmi is like saying, I want all the people to start drinking healthy drink, but they start with Coke. Which is not a healthy
here they're
drink.
starting with liquor.
So try to understand young person, like he has a high aspiration. He has heard about lots of stories, people have made like lots of money. So they want leverage. At young age, know what they are going to lose. I'm not know, exceptional cases are there where they have over leveraged and burnt capital beyond what they can afford to. But a young person, what kind of salary they have, how much they can invest, for them to learn, at least we can like give some product where there is a learning and long-term kind of, from trader they become long-term investors. I've seen like all these 30 years, I've seen lots of people, majority of the people I would say, they start as a trader, then they convert themselves into long-term investors. But as I said that I don't endorse this, but that is the behavior of a youth.
Fair enough. Anirudh, some interesting points made. One is the fact that, weekly continues to dominate. And weekly's utility as a hedging tool, which is, originally the argument was that funds, we need, better hedging tools apart from monthly, and that was one of the points for launching these. What difference does it make to prop traders like you or HFTs if this product were not there? Sometimes, it's possible that if you don't have weeklies, you might end up losing some of the retail investors. Would it be compensated by more and more HFTs coming into the market, even with monthly options, or does it radically change the structure of the market?
So I think the short answer is no, Mahalakshmi. The more products means more opportunities for arbitrage and revenues for everyone in the ecosystem. One of the things I would say, just to preface this and not to beat this weekly options thing to death is that the statistics that Mr. Anand pointed out, 90% of the retail traders lose money. And so this is exactly true in US as well. And the participation of US retail traders in S&P options, daily S&P options, is greater than that of India. I mean, this is, it's a statistical principle. It's a power law. It exists in every capitalistic system. It exists in VCs, it exists in mutual funds, it exists in AMCs. 86% of the mutual funds don't beat the benchmark if you look at 10 years. 76% don't beat the benchmark if you look at 3 years. In zero-sum games like options trading, it's more stark and it's more exaggerated. So I think the regulator's North Star is to identify these zero-sum games and try to create more friction so there's more redistribution of capital. And that's what I think the government's larger policy is that they started noticing that the GST collection and the consumption started going down. It was coincidental with a lot of other things. Leverage was being taken. But these statistics hold true, and no matter what you do, 90% of the retail traders will lose money in any game. I mean, it's the same 10 people who end up at the World Series of Poker final table. When you have enough iterations and you have an edge and you have the infrastructure and you have the quants and the PhDs, you will win against a retailer who doesn't have the data, doesn't have the infrastructure. So that doesn't mean you kill the game. What it means is that you create more friction for games and systems that are zero-sum, like options trading. Equity is not zero-sum. Equity is positive-sum. I don't have to lose in order for your equity to go up. But still, those systems also reflect the Pareto principle. And it came from the Italian economist Pareto, who basically observed that 80% of the olives were coming from 20% of the farms in Italy, and it applies even in seismology, in earthquakes, everywhere. It's a natural principle. So I think, and I think SEBI was identifying this correctly and moving in the right direction. So this is something that will remain. One of the things that the regulator, the government, the policymakers, Niti Aayog and everyone can focus on is how to get more risk capital in the system. I mean, if the statistics of US options trading, we have around 20 crore demat accounts, they have around 200 million, it's exactly the same. Everything is exactly the same. It's a democracy, we're a large democracy. So we can compare apples to apples with the US. But even in China, as you see, Chairman Mao's old saying that let 100 flowers bloom. So what the government, I think, is pushing to do, and the regulator is in line with that, is in general, especially with this AI age, just create a Cambrian explosion of new products, new exchanges, new AI-based technologies. Code is a commodity. Anyone can create anything really fast now. So that should be the focus. And I mean, specifically speaking about these zero DTE options, it's a small dent, but yes, there should be more friction, and eventually all systems do become zero sum. Right. So as they become zero sum, you start creating more friction, and I think that should be the North Star.
Fair enough. It's interesting because equities is not zero sum, derivatives is. So my next question to you, Anant, is then why are you fussing that retail investors lose money? Because even in cash markets, they lose money. This is the question I want to ask you, but before that, you, Nitesh, also run Quantity, which is, which imparts education for retail traders. But that's not the, predominant market. People in the derivative, the participation in derivatives is not really ones who want to understand the nuances of the trade and develop strategies and do it. How big is that market at all? You've done quite some certification. You run a certification course. How big is that market? Is the market mature enough to even tend towards education?
So, I think when we look at education from our side, from Quant Insta, I think it's more on quant and algo trading, so which is even more niche than the derivatives piece. And I think over there, what we have seen is that the people who are coming in, most of them are coming in that, okay, how can I make quick money?
Yeah.
Right? And we, as a rule, have just a policy where we just say no. Okay, we can't help you with that. We can help you with the concepts. We can help you with the frameworks. It's up to you how you are going to create those things, right? So we are not going to give our. Say we also we are a HFT hat, so we have a HFT business, and I tell them that we are not going to give you our working strategies. That's foolish of anyone to expect that. But what we can definitely do is
that market is so much smaller than the ones who give strategies and tell you can make
5%,
loads and loads of money.
That's 95% just filters out because honestly, I think there is a bigger problem here, and the problem is that, and maybe it's linked with the emerging nature of the market, which is that people who are coming in, they look at that. Okay, I have say 1 lakh rupee or 2 lakh rupee to invest, right? And I would like to make good income on this. Now, if you tell them that, hey, on this 1 lakh, you will get 15-18% return, which is great return, honestly, right? They do the math, and it's like, okay, 1,250 rupees per month extra. That's not going to solve much, right?
Yeah.
So they become like, no, I would like to have like 2x, 3x every month, or something like that. And that's what attracts all these people to option, quick money through option buying and all those things, because it is theoretically possible to do that. In equities, it's very difficult to do that, 2x, 3x in a month. It's theoretically possible, but it's essentially what Mr. Anand said, 91%, 93% will just lose all of it. Right, so that's where we are, and that's the real problem. And I think the problem here is really not much to do with the products or what kind of features these products have, because it's a market, product innovation needs to be there, and each and every product, be it weekly, monthly, 0DT, everyone is playing some role, right? The problem is more of how do we ensure there is a reasonable access. Right, so reasonable access in terms of access to reasonable people, right? So if the people who cannot afford to lose and who do not understand these things, if they become a significant source of volume, I think that's a dangerous situation, and that's what the problem that needs to be solved, to be honest. And
that's precisely the question for Anand. So you understand very well that this is a zero-sum market, and 50% of the players, or the composition can be different depending on the fact that small number of players can make disproportionate amount of money. That majority of traders are going to end up losing money anyway, right? So, of course, you said that actions have consequences, and you have to look at the market ecosystem overall. The kind of what is SEBI's thinking in this? Why have they not taken very radical calls when the writing on the wall is that predominantly retail traders are going to lose money? Is this some kind of a jor ka dhakka dhime se lage kind of thing for markets?
So let me try and answer that, and also try and synthesize all that I've heard into saying what could be a reasonable way forward. On your question of why did we not do a jhor ka jhatka or whatever you said, and stop all weeklies, for instance, we follow the Hippocratic oath, first do no harm. As I said, with the best of intent, you could end up creating more problems than what you sought to solve in the first place by taking very drastic action. So unless there is some real systemic issue which requires a drastic action, we will not take drastic action. By we, I'm speaking on behalf of SEBI.
Right.
We will always do consultative. Whatever has been done so far has been completely consultative with a lot of back and forth. Now let me try and quickly add a few things and then tell you what I think would be a good way forward. To Dinesh's point on this being a life cycle journey for investors, we studied this in SEBI. So in fact, in the study that we did and put out a couple of times, what we found is the following. People who have lost for 2 years in a row, 75% of them trade in the third year as well. So it is not a straightforward thing of, I trade for 1 year and then I go on into mutual funds and SIPs. It is not entirely visible. To Anirudh's point about, 90% is a loss everywhere, not true. So we checked. Now, it's true that the analysis is not done the way we do it in most exchanges. That's true. But we did speak to a few experts across various geographies. We found that a more reasonable ratio is 70%. Okay, now I'm not saying 90% is because of something nefarious. I'm simply stating a fact. And by the way, when we looked at intraday trading in cash securities,
the ratio is 70%. 70% of the time, retail loses when they buy and sell the same day in cash. Now, the reason why it is 70% is natural, because you have transaction costs, you have STT, you have to play a bid offer. So the system, there are transaction costs which make sure it's not 50-50, and therefore you will have a loss. But 70% is a more reasonable rate that we saw globally, not 90%. That's a quick, just as a jointer. Now, let me try and put all this together on the way forward. One thing which has not been addressed, the point I mentioned, if your cash market volumes are 1 by 700 or 1 by 800 of the volumes you see on settlement day, and the volumes you're seeing at 2:30 to 3:30 is such that people then start saying, oh my God, something is happening on Tuesdays and Thursdays. It's not a great situation for the system to be in. There could be nothing wrong happening. But the fact that people are speculating and saying, oh my God, something is happening, is not a good thing for us. And this 1:800 is a headache for Sundar Raman. Imagine what his surveillance team has to be looking at to make sure there's nothing nefarious happening. And it could be 10 random people coming together in the background and doing something which you can't see otherwise. So it's not a healthy situation. Now, I think the way forward is the following. What Sundar Raman mentioned about the need to develop cash market, I think Dinesh also mentioned that. There is a definite need to develop the cash market further so that the ratio improves not by dragging derivatives down, but by taking cash markets up. Second thing, for instance, on the longer term contracts. For a GIC, a Temasek, Adia, they need 3 month, 6 month, 1 year contracts for hedging. Even normal retail people require that. I think Sundar Raman is right. We've got to make sure that we create the conditions for this market to grow. So for instance, can the margins that we charge for longer end contracts, are they too large? Are they too conservative? Can we look at bringing it down? I think that's something we can explore. In fact, before this, we were discussing other products that can be introduced to try and bring some controlled leverage into the ecosystem as well. And the last bit, which I know many market participants have been thinking about, is suitability appropriateness. Now, Anirudh mentioned the US retail. In Singapore, retail is not allowed in derivatives. When I spoke to my counterpart in MAS about derivatives, she fell off her chair saying, why do you allow retail in the first place? So I think some form of suitability appropriateness discussion has to happen at some stage. And my request to the ecosystem is don't wait for SEBI. Suitability appropriateness is something that exchanges have asked for the last 15 years. Brokers are required to ensure that people who enter markets are supposed to be suitable and appropriate. Now, don't ask us to specify necessarily how that is defined. You define it in a manner so that people who are aware are the people who are coming in, because these are complicated products.
No, but how is that possible? I mean, how can you come up with a suitability as a broker if it is not defined by SEBI?
Sorry, I know I'm hogging some time. I'm saying we'll do this collectively. You can co-create this. I know what Sundar Raman will say. Pehle us aadmi ka sign leke aao jisse mere haath mein likha hai, and you get everybody else to sign, then I will sign. Is what he will say. The same thing, Dinesh will say as well. I can't do this in isolation. I need everybody to do. I'm saying let's work on that. Now, the suggestions that we have seen either are that everybody will trade. For instance, one suggestion given was anybody who has filed a tax return should be allowed to trade. That's 9 crore people. Do you really want that many people to be allowed to trade? Is filing a tax return, is that equal to being aware of what a delta in the option is? So I think having a reasonable filter which does not destroy businesses, which is gives a glide path so that there is no sharp cliff off. At the same time, hand on heart, we should be able to say that this is ensuring that people who are aware are coming into the system with a glide path. I'm saying I agree with the point that you need the entire ecosystem, and this is a golden goose, goose that's laying golden eggs. You don't want to kill it. At the same time, keep it healthy. And the experts here, don't wait for SEBI. SEBI doesn't understand these things. The experts here know what
you can't say that. Anant, you can't say that. SEBI understands everything. So what does the suitability framework really look like to you?
See, one is, sir talked about a glide path. The moment we talk about a glide path, what we are saying, we are not interested in preventing anybody. We want people who understand to trade. That's what we say, right?
And how do you gauge that?
And we also talk about a glide path. Maybe people who have been trading in equities market for X number of years, or maybe people who have a minimum amount of equity holdings in their demat, or maybe some people who are having at least some mutual fund assets already there, could be a starting point. I'm just thinking aloud.
So you're saying ability to lose, or affordability for losses
experience
should
with
be
capital markets. See, any product, be it equity or equity derivatives, should not happen because my neighbor is trading or somebody else made money, so I want to make money. That should not be a starting point. It should start from, I understand this product, so I want to trade, right? So the basic presumption you can make, if somebody is regularly trading in equities and has some equity holding, maybe he will have some exposure to the market, so he may understand the nuance. That is one way. Another way is expecting him to pass some exams and come. That is another possibility. Another possibility is he regularly investing at least in a SIP, so that he understands. If nothing is there straight, he comes to the option market. So we jocularly say something. It's called as hero or zero. Right? We don't want heroes or zeros, right? We want a consistent set of people playing in the market with a clear end objective in mind, which is not just making money because my neighbor is making money.
So what, there were several suggestions. Experience in stock markets, how do you gauge that? SIP, I'm also an SIP investor. I know nothing, even being in Moneycontrol, on derivative strategies. It requires a different kind of mindset and skill set to ace that game and make money. What does a practical suitability framework that is implementable look like to you?
See, I believe derivative as a product is not a wrong product, but we need to work out a risk management system. We need to work out a procedure where regulator, exchange and broker has to play a big role. As a broker, definitely we have to create constant nudges and constant reminder to customer what kind of an exposure they have taken and what is their status in terms of loss and profit. But if you look at, as I said, youth now to control them, it is difficult. So we have to really work hard to create that kind of education to a customer who says, I want to trade, but how do we nudge them towards a kind of long-lasting product? That is what we have seen. Digital brokers have been good at in terms of nudging customer toward SIP product and all that. But having a strict kind of entry point for retail, I think it is not going to work in India because ticket size is low. We have to work on how do we educate them, how to make them aware about risk associated with this. Where regulator has done an excellent job, we flash that. What are the chances for you to win? See, in any zero-sum game, it can be weekly option, it can be cash trading. Zero-sum game, one person is going to lose, another is going to gain. Who is going to lose? Less educated, a new person. Retail are new to this market. Whatever customer brokers are acquiring, this market is acquiring, almost 65% are new to market. So if they do trade in any instrument, forget about weekly or cash market, initially they are going to lose. Are we able to nudge them towards long-term investment products?
Yeah.
That is what is our responsibility.
Right.
So I would say that derivative as a product is not wrong. Trading is a zero-sum game which retail has to understand.
Right. That's all the time we have, but it was a really useful, engaging discussion. Thank you so much, gentlemen, for this wonderful. I'm sure this conversation is going to evolve and multiple runs of discussion before we finally settle down in terms of what policy holds for the derivatives market. Thank you so much.
Big thank you to all our panelists. A big thank you to all our panelists. What a scintillating session. But the action doesn't end with that because we've saved the best for last. And I'm going to request Mahalakshmi to stay back on stage. Now we meet at a moment of active conflict, disrupted energy routes and trade policies, reshaping supply chains faster than most portfolios can adjust. Across conversations today, one question has kept surfacing. Is a storm investors simply navigate or a deeper reset markets must adapt to? And to share insights on how to invest through uncertainty without losing conviction, please welcome Ramesh Damani, member BSC and chairman Avenue Supermarts, Madhusudan Kela, founder and MD, MK Ventures, and Amit Goela, managing partner, Rare Enterprises. Like I said, ML, we've saved the best for last.
Thank you so much, Chandra. Indeed, I mean, we have three gentlemen. Please. Indeed, we've saved the best for the last. Thank you so much, Ramesh, Madhu, Amit, for joining me for this, what promises to be the most awaited panel of today. And what a note to sort of, what a panel for a closing session. All these three men have navigated many, many ups and downs, have also had the privilege of, one of the greatest India bulls, Rakesh Jhunjhunwala. And, every time there was turmoil in the market, the one face and voice we're all used to as a voice of reassurance for faith in equities has been Rakesh. And, over the next 45 minutes, I just want all three of you, and we can keep it absolutely free-flowing, in terms of, what these, there have been several testing times, several downs in markets over the last 25, 30 years, the dot-com era, the Harshad Mehta, boom and bust, the financial crisis, even the 2024 elections where there was so much volatility, but it required quite some faith in Indian equities to sort of, build and, get rich, so to speak. Let me start with you, Ramesh. Can you recall some of the most testing times for you in markets? What gave you the confidence to stay invested, assuming that in most of them you did stay invested?
Sure, Mahalakshmi, thank you so much for your kind words and welcoming us here. I was maybe 28, 30 years old when one of the great crashes of the world unfolded in front of my eyes. And I was a novice, not understanding markets. It was on October 19th, 1987, when the Dow fell 22 points, 22% in a single trading session out there. And that seared into my mind as a young analyst, as what was happening. I was in the software business, not really understanding, but I knew something dramatic had happened. And I had this impression that maybe the Great Depression was around the corner, markets don't fall like that otherwise. But then I realized that human resilience and technology and productivity are all game changers in this world. And something that I will always thank Amit's boss, that he always taught me when I came back to India and started my career in the financial markets, that be bullish on India, don't be cynical, be bullish on India. And that has held me in good stead, because I realized that every bull market ends, a new bear market starts, and then a new bull market starts.
Right.
And you remain invested in great quality companies is the surest way to be wealthy. So I learned a lot from him, of course, but I also remember that October 87 crash, even today, how vividly impacted me.
Sure. Madhu, what has been the, the period that tested you the most? Did you feel nervous? How did you navigate it?
So, Mahalakshmi, again, thank you very much for having, and thank you very much for remembering Rakeshji. I think more than anyone else, I miss him the most, because he was like always a call away. Bhaiya kya lagta hai? And he will always be, reassuring whatever his views were. So we really miss him the most in this kind of time and otherwise as well. So I think for me, I would say 2008, in the global meltdown, when I was managing money for Reliance, and we just raised the fund, and the way things were crumbling, and also the COVID time. Yeah. These were two really testing times, wherein, see, if you face a crisis, wherein at least you know the outcome of how things will shape up, or you can visualize an outcome, then you are not so much panicked. But when there is no end game, and what is happening, what is going to happen, that is when really the panic sets in. But as you said, by 2008, we got ingrained so much about India bullishness that everything which came across to us really looked like an opportunity. And I think that is the single most thing which has really worked for all of us, I would say, that we have not thrown in towels in these difficult times, and rather treated all of this as an opportunity, right? And we have whenever possible, whatever possible, we bought good companies. And that's what has made money. And it's been 35 years. And I don't think this time again will be any different.
Right. You know, Amit, I remembered a conversation between Ramesh and you, where you said that, you know, during the 2008 meltdown, you had all the data, like as usual, you would go and present the trade setup to Rakesh. And during that time, I think on one particular day or whatever, you went with that data and you said that he said, you know, he didn't want to sell anything. And he said, we'll be able to navigate this. Recall that moment and what gave him that level of confidence? I mean, you know, to sort of have the entire portfolio, seeing that this is going to get much worse and yet holding on to your investments.
Yeah. So as Ramesh and Madhu, thank you for having me here, Mahalakshmi first. And then as both Ramesh and Madhu and Ramesh have said, see, the underlying theme which Rakesh ji always believed in was being bullish in India. Like, so he was very clear that I'm bullish on India and I'll remain invested in India. He never invested overseas. He never looked at anything. It was just Indian equities period. And see, till 2008, there had been periods of ups and downs. 2004 to 7 had been a glorious period for him. So he was like at his peak in terms of confidence. And yeah, but for some reason, I was feeling very bearish, and I had some data which I had collected. He became a little bit bearish, but then the markets didn't support him, and then he said, let it be, like, I'll remain bullish. And I was surprised. He said, like, even we didn't think that the markets will correct the way it did. In that year, the markets went down 60%. Yeah. And his bullishness in India is what let him stay invested. So it was very tough those days, like it was a very hard time, but he remained invested. But the flip side of that was that when the market turned, everybody had been so seared by that bear market that very few people were able to invest. Whereas he, with the benefit of having remained invested, was able to get a very nice advantage of the move of the market. Yeah.
Right. Ramesh, you know, what does it feel like to go through a 60% correction in your portfolio? Today, you know, people say that they are nervous because the market is down 10%, 15%. In those days, we've seen 50, 60% down. How was that time different from this? Is this something to be, I mean, should we be hoping for?
Still feels horrible. Nothing changes.
Even at 10, 15%, it feels horrible, you think?
Horrible squared. I mean, it doesn't get better. Losing money is never fun in the markets, and I hate doing it. But I realize the intellectual process that, you know, trees don't go to the sky, and that you're trying to compound your money. That's all. You know, trying to compound it, trying to double it over a few years period. I think that's all we're trying to do. I think that keeps us sane at the end of the day. But losing money is never fun.
But how do you know this better than anyone else, that, you know, stocks and businesses are two different things. Markets are a different animal, businesses are different, Absolutely. Right? And stock prices can go down, and it requires quite some nerve to sort of hold on to your stocks, even if you have the perception that, you know, it could go down 30, 40%. How do you navigate a scenario like this? And today, what do you see? Do you see more downside to this market? Because as it is, a lot of people are not very comforted by at least people who have been in the markets for a long time, are not very comforted with the kind of valuations we have even today. We had a panel in the morning where people didn't say that this is a very compelling opportunity to buy. Valuations are not cheap. How do you navigate?
See, I think more than trying to figure out the valuation, which most people spend a lot of time, I don't waste my time too much on that. I just look at valuations. More important is which cycle are we in? Are we in a bullish cycle or a bearish cycle? You know, and how the market reacts to news is very important indicator of that news. For example, we're all now concerned with oil. Everyone in this hall is concerned with oil, gold, silver, whatever. And the reason ascribed by television journalists, by analysts, oh, oil has gone to 100, that's why markets are down. I'll remind them that in the Ukraine crisis, oil went to $139, and yet the market went up. So it's the market reaction to news that's more important. So there is some suggestion, there's some thought process that the bull market that began post-COVID is nearing its end legs, and that we're going in for a more sustained bearish phase in the market. The leadership will change. I have absolutely no doubt the market will reemerge stronger, bigger, more vital after this phase. But in the meantime, you have to navigate that phase. And the way you keep your stocks, to answer your first question, is you do your homework. You understand what you're buying, understand the valuation you're buying it, and understand the future of the business. I think there's no substitute for doing your homework. Give me an example of Warren Buffett. He's held Coke for almost 30 years.
Yeah.
And in the gains were made in the first 15 years, and then for 10 years it went sideways. And I always ask myself the question, this is the smartest stock picker in the world. Why has he kept the stock for 10 years without any appreciation? And then I got the answer, because it was dividends. Let me give you an example. 10 years ago, Coke was $40 stock, giving a 3% dividend yield. 3% dividend yield in dollar terms is a lot of amount.
Yeah.
Today, the stock has doubled. It still gives a 3% dividend yield. So Warren Buffett understood the value of cash flow in that business, not necessarily of price appreciation. He understood the value of that business. I think we should all try and do that, understand what we're holding, not speculate on price, but speculate on the underlying. What is this business? Is it worth more in the future than it's today? Then I would hold on.
Right. Madhu, one of the statements that Rakesh used to make was that, the mother of all bull markets is ahead of us, and everybody would feel absolutely comforted about that. Today, that retail participation that he used to hope for and talk about we've seen it happen over the last few years in the post-COVID era. Today, do you get the feeling that the best of Indian stock markets is still ahead of us?
I have no doubt about it, otherwise I would not be here. If I feel that the best is over, if I feel the best is over, then I would not be here. Right? The fact that I am still invested, still looking for opportunities. I think the best is still to come. We are only at $4 trillion, and we are aspiring to go to 20, 25, $30 trillion over the next 25, 30 years. So I have no doubt about it, that the best for the markets and for India is ahead of us, and it is not behind us. The other thing is, how do you navigate the times like this? And what have we learned?
Yeah.
So, Mahalakshmi, most of us, what we learned from Bhaiya also is that, if you don't have leverage, leverage is your biggest enemy. Right? In times like this, let's say if you are leveraged 10, 15, 20% of your portfolio and markets falling every day 1,000 points, there is no way in the earth that you will not panic. But if you're not leveraged, that is a good starting point. The other good starting point is that if you have bought companies really giving a lot of thought, he always used to say, think 20 times before buying, and think 50 times before selling. So if you have done really a detailed thought process before buying, then price fluctuation is something which you have to get used to. So I think all of us belong to the era wherein obviously we have committed more than our share of mistakes, and we are yet committing, right? But I would say the portfolio construction is strong, and this price fluctuation you have to go through. And you have to look for opportunities in this kind of market. The third thing which I would say, Mahalakshmi, is that, let's say, again talking about him, if he was around, he would say, चुपचाप बैठ. तेरे को मालूम है ईरान में क्या होने वाला है, तेरे को मालूम है इजराइल क्या करने वाला है, चुपचाप बैठ. But he will try to catch that turning point. That turning point will come. He will get like Ramesh ji said, when the negative news will come, but the market will really not go down. And in a market, 10 stocks will rise. I remember the COVID time. He was so sitting on the sideline, but one day suddenly he called, कुछ भी बीबी का बंगड़ी बेच के लगा दे, कुछ नहीं होने वाला है, टाटा टेलीकॉम बढ़ गया, ये बढ़ गया, वो बढ़ गया, वो बढ़ गया, ये पैसा शेयर लेने का टाइम है. So I think again, if you indulge every day trying to say that I am bullish on India, that also doesn't work. In times like this, you have to sit on sideline.
Right.
And wait for that moment to come when market really starts reacting, not reacting to any bad news. That is the sign that we can be confident that the market is turning. And today's market, as Ramesh was saying just now, every day bears are having a gala time that you go in the morning, the market is down 1,000 points. It's a no-brainer, next 25, 30, 40 days, there will be no market if market continues like this. But it doesn't work like this in life.
Right. Amit, the beautiful point, Madhu, that, how would he really get, he's saying, he would say, he would call out these points where you would say, aa gaya time, this is a turning point. Was it intuition, gut feeling, and what was it? You worked so closely with him on a daily basis.
I would attribute a little bit to definitely a sixth sense which he had. But that sixth sense also was happening because he was very, very well prepared every day. So it was not that he would take his eyes off the market. While he would be okay, one interesting point was so that way he was very unique in that sense that he could manage drawdowns with leverage.
Sorry, Amit, the leverage which he will carry will be insignificant portion of his portfolio.
But it was still there.
And when he will leverage, when he will leverage big time, that was also the biggest sense.
Yeah. So he would carry some leverage always. So that made him, he was very sharp, in the sense he would always be tuned in, irrespective of however much the portfolio damage was, irrespective of he was always optimist on the country. He would always maintain that the mother of bull runs is yet to come, irrespective of however bad. Whether it was 2008, whether it was demonetization, whether it was COVID, it was always that the big bull market is still awaited. And as a result of which he was very focused and constantly looking at, when the markets were falling, the whole process in the office was, you keep digging deeper and deeper into your companies, get a better understanding. I hope we are not making a mistake. Whatever our thesis or our hypothesis was, it still holds. Don't worry about the price so much, but are our underlying factors in place or not? That was one thing which helped us through. And the other one was be fully aware and very clear this. We are holding on for the longer term. So, see, if you look at it, our average holding period is almost 10 years here. So that is the kind of patience you have to have that kind of ability to make that kind of money here. So time was the biggest edge which he had. And I think to all investors, I can say that the only benefit or the only edge you can have is finally time. Because time in the market is what makes money for you here. When you are trading, timing is important, but when you are investing, it is time in the market. Nothing else matters here. Because companies take time to grow.
Right. So, Ramesh, this is very well said, and it's a lesson often repeated, but a lot of investors don't follow it. The question is, when in times like these, for example, this Iran-Israel war that is happening, or an AI disruption, nobody knows how these things are going to play out. We had two people in the morning. One of them thought that, in a week's time or 10 days' time, we should have peace and this will de-escalate. There are other people who are saying this could now go on for months. At some points, fundamentals or looking at fundamentals don't make sense because markets can sort of be irrational. How is this time looking to you? Is this something that people should be focused on valuations, or how should they navigate this?
Yeah, Mahalakshmi, the answer is always the same. You just do your work, buy your companies bottom up, and pray to God that you're right. There is no substitute for that. Markets will always give you the opportunity. It's not like a T20 game that we are so used to that every ball you hit out or get out. It's more like a test game that if you don't want to touch a ball, don't touch it. Let it go back to the wicket keeper. Wait to the soft ball outside the off stump, you can hit for a 6. And markets will occasionally throw those balls to you. Not very often. I'll tell you one thing that one of my regrets has been that a lot of my friends like Madhu are billionaires and I'm not. I think the reason for that is that when the time comes, when the great pitch comes fair outside the stump, you have to put your money on the table and you have to take that big swing to get where you want to go. So I think that the exercise needs to continue, especially hard in a bear market. Great fortunes are made in a bear market, not in a bull market. When you buy things cheap, rupee cheap 10 paise mein, aapko bearish market mein hi milegi. Aur us time dekhne. So if this time you're the kind who wants to fold up and move out, you're not fit for the stock market. This is very hard to do. Yeah. But the most important thing to do is to keep looking every day, and occasionally you'll get that soft ball outside the off stump which you can hit for a 6.
But 10 paise to a rupee, are we going to get those prices at all? Or does beauty lie in the eyes of the beholder?
Go back and study any bull market that's taken place. You see the 2000 bull market, see how many inflows went up, I think few thousand times, not percentage, few thousand times it went up. This is hard to believe for people. Today it's about, what, 4 lakh crore, 5 lakh crore Infosys market cap, Amit? It was, at that time, believe it or 93, it was 30 crores. Yeah. That was the market cap of Infosys, 30 crores, not 3,000 crores, not 30,000 crores, 30 crores. How many times has it gone up out there? Every bull market will have leadership. So a lot of the stocks in this bull market are up 20, 30 times already. So, my feeling is that you will always get opportunities, whether it's in global markets or whether it's in Indian markets or whether it's even in the West Asian markets today. There will always be opportunities for the sharp analysts to find stocks on the cheap, because markets occasionally make the mistake of throwing the baby out with the bathwater.
Right.
And it is our job as analysts to figure out the difference between the baby and the bathwater.
Sure. Madhu, again, a very pertinent point that, it requires a lot of courage and conviction to grab an opportunity and build a sizable position that makes you rich. What is your framework? And in today's, in hindsight is always 2020. In 2002, you could have, seen that the markets were really cheap. Today, it doesn't look like that compellingly cheap by any stretch of imagination. How easy or difficult is it to show that level of conviction in today's markets?
Yeah, I think is always relative, right? Markets may not go down to that valuation, because you have to also see gold has gone up 10x or 15x, right? Real estate has gone up 10, 15, 20x from those prices. You can't always wish that you will get equity at 2 or 3 or 4 P multiple. So you have to always look at it on a relative basis. Where is equity vis-a-vis other asset classes? So we are not looking at it in absolute price. Will we get it at 2P or not? What we are really looking at, what is the real disproportionate risk reward? Can I lose 10 rupees and can I get 100? That is the risk reward which we are looking for. And I think, forget, आप इंडिया को छोड़ो ना महालक्ष्मी, अमेरिका में इन्वेडिया जैसा कंपनी में 50 गुना पैसा बना है लास्ट 10 साल में. The largest company in planet Earth has made you 50x return in last 10 years. In America, you have had at least 100 baggers in the last 10 years. So I think in every market you will get the opportunity, and our framework honestly has also evolved over a period of time. So first we only used to buy very cheap companies, very aggressive entrepreneurs. Over a period of time we realized what is the value of corporate governance, what is the value of balanced thinking, what is the value of really valuing people. So over a period of time it has evolved. So where I stand today, I would like to bet on first an industry which is likely to have tremendous tailwind, right? And then look for possibly a good company, and if I can get lucky, if I can get the best company, that will be the best reside. Because I have seen very, very good companies in the last 5 years have given zero return. Yeah. And it ticks all boxes. They are best corporate governance, they are generating cash, they are huge ROE, ROC, everything is ticked. But they are not generated any return in a 3-5 year time frame. But if you catch a really good industry at the right time, and if you are able to even get an average company in the good industry, you have made good money.
True, true. That's a Warren Buffett quote also, when the reputation of a business is pitched against the reputation of management, it's the reputation of the business that will hold. But ऐसा industry आज क्या है secondary market में, जिसका इतना strong tailwind हो that it can...
thinking out of the box. 10 days back, I think energy security will come at the fore of India, in my opinion. Imagine we are talking of $5, $10, $20 trillion of our economy size. And on a 2-week war, 30% of Indian households do not have gas. Right? But this is such a nerving experience to even experience. So I think whatever is holding the reforms, specifically in the gas sector and the power sector, on the energy sufficiency, in my opinion, the government should go and will go all out to clear all the hurdles, and we will have to become energy sufficient. See, I can survive without importing gold. I can survive without importing Apple phones. Yeah. But I can't survive with this basic need. We have 1.4 billion people. Just imagine the crisis which the country is facing today. And it's not that we don't have enough gas. It's not that we don't have enough oil. It's not that we don't have 30% of coal reserves of the world are in India. But a lot of these coal mines which are there, they're not being extracted. I think there will be a massive reforms in this sector, and I'm quite bullish that there will be a lot of opportunities to look for bottom-up ideas in this sector.
Cool. You know, Amit, interesting energy security as a theme. You know, in a market where there is so much uncertainty like we are seeing today and we've seen in the past, what one thing is which all of you say is stay invested, stay the course, and that's the way to long-term riches. But you do look at the portfolio and make changes, you know, in terms of, you know, what should you hold? Should you liquidate something, keep some cash on the side? If prices go down more, you can, you know, build positions in newer opportunities, etc. What does that framework look like to you? What has been your lesson on how do you view or restructure your portfolio or think about your portfolio during times of uncertainty?
See, these times of uncertainty keep happening. It's just that we had this last 4 or 5 years of compounding, in like the markets compounded at almost 22-23%. So we've forgotten about this volatility and that things can be troublesome. If you go just 12-15 years back, 2008 the markets corrected 60%, 2010 the markets corrected 20%, 2012 the markets corrected 20%, 2016 the markets corrected almost 15%. Here the markets have corrected 8-9%, and we are completely like panicked situation that there is so much of uncertainty and how do we do things here. So while I'm not trying to make light of the uncertainty, you need to keep your expectations and your what kind of return expectations also in mind here. Like we've had a really serious bull market since COVID. Since COVID, every year our markets have compounded at 23%. It's not a joke. So if there is a little bit of correction, you need to be calm and cool about it. And then secondly, as far as portfolio construction is concerned, look, from where we are coming, if we have to sell stocks to manage our portfolio at this point of time, then I think we've done something wrong here. Normally we wouldn't be selling stocks in bear markets. Right. We would have tried to manage the situation much before that. Not that we always figure out every market, what is right or wrong. But normally you always, the way you've constructed your portfolio, the way you manage things, is that you know that these difficult times can come anytime and you know how to. Yeah, if you have leverage, then you have to sell it irrespective, whatever you do, because you need to get rid of that. But otherwise, normally like...
No, I'm asking, because for example, if the crisis is on oil, you know that there are certain pockets that will go through pain. But that might also be the opportunity when the prices go down where you want to buy. So how do you think about these, you know, things that you may think are transitory changes which will come back to normal? Do you try to get out if there is acute stress? Do you get back in? I mean, how do you navigate it, or just hold it?
So see, in our firm, like we were not a mutual fund, so it was not like Madhu was receiving like money every day kind of stuff, that you always have money to invest. So there was always like Rakeshji would either leverage or like there was some trading gains, like, but very rarely would the stock be switched in a bad market, that unless and until we've got completely wrong in the stock, very rarely would he switch one stock to buy another stock here.
Right.
There have been some occasions where he has done it very successfully, but never in distress.
Right. You know, Ramesh, what has been, you know, your loneliest decision? Any decisions or investment decisions during, you know, meltdowns that you've taken where you felt that you were on one side, the rest of the market, or even people you had faith in were on the other side?
Yeah, Mahalakshmi, the recent decision I made made me quite happy. We got bullish on the public sector stocks during COVID. And as someone explained, they were available at 5% yield, 5-year visibility outlook and 5 PEs. And no one was willing to touch them for whatever reason. And the stocks have given very handsome returns over the next 3 to 5 years. So when I made that decision, it was a very unpopular decision. But today it's more frontline, the mutual funds for the defense sector, mutual funds for the, and people look forward to disinvestment coming. So, I mean, that decision I'm happy because it also made me some money, so I'm happy.
So that was a valuation call? That was largely a valuation call?
It was a valuation call and also, not just, I'm not saying it just in terms of earnings.
Yeah.
For example, one of the shipyards in India was available for 2,000 crores, which is cash value. It didn't make any sense to me. How could you get a shipyard that makes a destroyer or a frigate worth 5,000, 10,000 crores be available for 2,000 crores? And just because the name was a government-owned company. So it just, sometimes market throws these softballs, they say, across the off stump, which you hit out, and that was one of my calls. So that made me happy.
Sure. Madhu, your loneliest decision, where you thought, your call was contrary to the rest of the market, even people in this circle, what has been that decision?
So there will be many, because I'm a loner always when I invest, because I'm very unpopular investor in that sense. Because
I guess that is a lot of it. I think most successful investors are lonely investors, independent investors. Yeah.
And a lot of the times when I invest in these companies, I have my own conviction. But one thing which really comes in my mind is when I bought 10% of Radico Khaitan for 100 crore market cap, way back when we were starting mutual fund, right? At that time it was so unpopular that after I bought, at least 10 people from Delhi called me, "Kya kar diya tune ye?" Right? As if I had really committed a crime. But I must say that, I held on to my conviction and we held the Radico stock through our Reliance Mutual Fund days, and it's very happy to see it's become 40,000 crore market cap company. And of course now 40-50% of the company is owned by institutional investors. So there will be many such decisions. But one thing very clearly, Mahalakshmi, if you have hit a jackpot, you have to be a loner. You have to be absolutely unpopular. There is no way that you can have a consensus and you would have hit a jackpot.
True that.
And the other thing, in terms of really regrets, I would like to, for the purpose of this audience, I think it took me years to understand that the financial loss in the market is a very small loss. The real loss is the opportunity loss. Sometimes you get biased, you get into FOMO, and you buy a company and you hold it for years with that bias, right? Realizing, ठीक है, 100 का 80 हो गया, क्या हो गया? But you don't realize कि कहीं पे और 100 लगाया होता तो 1000 हो जाता था. So it took me actually a lot of time to understand this. But when I now make a decision, I'm clearly keeping that opportunity cost of money really at the forefront. And whenever I'm making decision, if things are not working out the way we are thinking, I'm very happy to change very quickly, then spend years on those decisions. And then eventually we have to take whatever the decision which is right?
Right. Amit, looking at that you regret a lot and why, and how do you correct it? What is the big takeaway from there?
One, see, the biggest decision which I regret, and I got seared the most, and I think it was the biggest. One was a regret, it was very painful, but at the same time, big learning was when 9/11 happened in 2001. I had barely started in the market, and I thought I was trading aggressively, I had leverage, and I got caught in that very badly, and I didn't realize what it was. So that is when suddenly you realize that this is a very serious business, and you better pay attention to this. It's not fun and games here. So personally, that was a very tough experience for me. So if you talk about being lonely and taking a decision again, for stocks we have done, both Madhu, Ramesh, Rakeshji, they've all been lonely warriors at that point of time. They have got enough war stories. For me, there was a time when on the trading side, I took a very big call in 2008.
Sorry, on what?
On the trading side, I took a very big call, when I became very, very bearish, and that was the call which I got right on the global financial crisis. So that was very lonely and a tough time here, like for me.
It was a right call or a wrong call? Was it a regret or a big?
No.
Huge...
So we made personally it was a satisfying call. We ended up making no money out of it.
Okay. Any decisions that you regret, Ramesh? Apart from not sizing up your positions, which I've heard many times you say that, you had all those multi-baggers in your portfolio, but you didn't size it up. Apart from that, any regrets and therefore takeaways for people?
Yeah, I mean, it's a very difficult question that I ponder myself what to do. And just to re-emphasize that point, yeah, it does bother me that some of my friends became billionaires and I didn't. And the reason is not because I want the money, but it's because how you measure yourself in the market.
Right.
And that opportunity was available to me, like available to everybody else. And so my call to other people is that don't limit your ambition. I mean, this is a great field. You can express yourself creatively and make tons of money. So it's not if you make 20 points in a bull market where stock goes up 20x, you're fooling yourself. Or if you don't size up your position properly, you're fooling yourself. So my regrets are that I did learn the lessons, but I'm an incremental learner. I don't learn it right away. So it gets better from each bull market, and now I'm just out of bull markets. So that's what bothers me. But it's okay. I hope through this conversation, through other conversations, that other people will get inspired. That this is not a business that you should limit yourself. This is a business you should expand your horizons.
True that. One last question for all of you. What is the one advice you would give to all the new investors post-COVID who are experiencing, this kind of uncertainty and correction for the first time?
Don't watch television every day.
ऐसा मत बोलो यार, हमारा धंधा कैसे चलेगा?
नहीं बोलो, don't spend too much time on social media.
You're saying TV मत देखो, website देखो, Moneycontrol देखो.
Don't watch too much, I'm saying. I'm not saying not to watch. And the other thing is that you have to stay completely away from all of these noises. Yeah, markets, Nifty लेके क्या होने वाला है? मैं बोलो, even if I can predict precisely Nifty is going to go down by 2,000 points, what will I gain? I may have some trading position, I may have some marginal gains. But the real money is made in these kind of markets only when you are able to buy something out of consensus and buy it with conviction and buy really truckloads, right? And really be able to hold. Mahalakshmi, I have had so many good identification in my life. I wish that when I identified divis, I had only 10 crores of rupees and just left it. It would have become 20,000 crores. Just living nothing, doing nothing. I'm saying, but this wisdom has come many after years and years of these experiences. And that is one reason why we want to participate in forums like this. That at least people can learn out of what we missed out here. You don't commit the mistake which all of us have committed. You are allowed to commit a new one. But don't repeat the one which we have committed already.
Right. True that. Amit?
Yeah, I echo what Madhu says. Yeah. This is the time when, because see, the noise levels are so high now, and it's almost become by 24/7, because there's so much of social media, there's so much of YouTube, there's so much of noise. And for almost all the headlines, again, nothing against Moneycontrol or, fear sells. So unless and until the headline or something is such that there is a problem or something, nobody will go and read it.
महालक्ष्मी, अभी टाइम ऐसा है ना, अभी का टाइम हाथ पकड़ के कोई आपका शेयर बिकवा देगा, ही द वेल विशर ऑफ योर्स, और वो बोलेगा 3 दिन बाद, देख मैं तेरे को बोला था ना बेचने को, देख भाव घट गया है, रोज फोन करके बोलेगा. But when it turns out it goes up 2x, बोला क्या, अरे नीचे घट गया था, लिया क्यों नहीं तू? मैं तो बोला ही था. तो बोलने वाले तो बहुत मिलेंगे ये टाइम पे, but what you want to do is something very different. What makes money is something very different.
Right. No, I agree to both of you. My only question is, the conviction that one could have shown in real market meltdowns. Are we ever going to see that kind of a meltdown?
Why do you want to see that kind of a meltdown?
No, I don't want to see. I'm saying, is this the worst that can happen to our markets?
I don't know. Anything can. How do I predict?
No, then how do you get the conviction that 15% is a compelling buy?
Pardon me?
How do you get the conviction that
what?
a 15% correction in Nifty signals that the market is in a zone where it's a compelling buy? How do you get that conviction?
See, it depends on the way
because some of the stocks that you talk about and you've made riches were really cheap, when you bought them. GSW when you bought, or when you bought Titan at that time, or
that was again
Karur Vysya Bank. It was a different era where you could have bought and made loads and loads of money. Not that it was ever easy, but I'm just saying.
He had the most sterling call of his life 4 years back, not 30 years back. Like when he bought all these shipping companies and shipyard companies, he have gone up 100x.
Yeah.
Who knows that whether they kind of, only after 10 years we'll know that there were stocks like this in this market. Yeah, abhi thodi pata chalega.
Fair enough.
See, it's like this in 2001 when I really started investing after the problem, or we came to the markets. Tech boom was at its peak. And we had just entered the markets and we were thinking कि अब तो कुछ मिलेगा नहीं है, tech boom तो हो गया, all the stocks have gone up 100, 200 times. We'll remain poor for the rest of our life. There are few lucky people who have invested in Infosys, Wipro and all. But since then, in the last 20 years, you've got so many opportunities. So similarly, in the next 20 years, you'll keep getting opportunities.
Absolutely.
You just have to follow a particular method. If you are investing through mutual funds, then trust your fund manager. If you are investing yourself, then do your homework and invest. That's what you have to do.
Fair enough. Fair enough. Last word, sir.
Yeah, Mahalakshmi, my favorite thing, which I always give free advice to people, is that the eighth wonder of the world is compounding, okay? And that's what everyone, especially the young people in the audience, need to understand that. You have a 30-year professional career, so that if you get 10 doubles in that period, so if you can double your portfolio every 3 years roughly, you'll get 10 doubles in that period. Whatever you have, whatever amount you start up with, become 1000x. So you start with 1 crore, you'll be worth 1000 crores at the end of the period. So the math is all there. How do you get rich in India? You can be worth 1000 crores, you can be worth 500 crores, depending on what your starting point is. So find stocks that can compound over a long period of time. It is the secret to wealth. There's no other secret. Buy great businesses and have them compound over time. So my advice to especially the younger audience is learn to find stocks that will compound.
Thank you. Thank you so much. So unanimous decision from everyone that keep the faith, stay invested, buy more. Thank you so much.
Sure,
thank you
thanks,
so much,
Mahalakshmi.
Ramesh, Madhu, Amit. Thank you so much.
Thanks, Mahalakshmi.
Session to end the day, and that's a fitting close to the day. The power of compounding, the last word from Mr. Damani. That's a fitting close, as I said, measured, experienced, and deeply relevant. Thank you very much to our esteemed speakers. Thank you, Mahalakshmi. Ladies and gentlemen, that brings us to the end of the second edition of the Moneycontrol Global Wealth Summit. Thank you to all our speakers and to all of you for being part of the conversations today on the future of wealth and investing. A special thank you to our partners, IDFC FIRST Bank, our presenting partner, and Reliance Industries, our associate partner. And as we wrap up this edition, let's hope that when we return with the next Moneycontrol Global Wealth Summit, we do so in a world that is a little calmer, more stable, and full of even greater opportunities. On behalf of Moneycontrol, thank you for joining us, and we look forward to seeing you again soon. Have a wonderful evening ahead, and please join us for dinner. Good night, and have a lovely weekend. Thank you for being a wonderful audience. Thank you.